Okay, sir. Good morning to all of you. We are going to start our first Ind AS, Ind AS 16. Actually, in the material, first we have given Ind AS 8, accounting policies, changes in accounting estimates and errors. It's basically a theory kind of Ind AS. We are going to cover it later. First, we are going to focus on the most important accounting standard, very engaging accounting standard. And if you see the past examinations, Ind AS 16, definitely you can expect one 7 marks question. They're asking a 7 marks question, and one MCQ is also possible from this Ind AS. Okay, let us discuss Ind AS 16, property, plant, equipment. See, actually, relating to assets, we can say broadly there are two categories of assets. One is tangible fixed assets, another one intangible fixed assets. Relating to tangible fixed assets, they have given Ind AS 16. Relating to intangible fixed assets, we have that standard also in our syllabus, Ind AS 38, intangible assets. Ind AS 38. See, first if you learn Ind AS 16, the same provisions, majority 50 to 60% of the provisions of Ind AS 16 is there in Ind AS 38 also, because both are basically what? Assets only, na? Whether tangible or intangible, basically both are what? Assets. So relating to assets, there are some common provisions, common principles. So first you need to learn Ind AS 16, sir. Obviously 50% of Ind AS 38 is completed. Okay, now this is the first thing, sir. Now let us focus on the Ind AS 16, property, plant, equipment. See, first of all, what is covered in Ind AS 16? See, the entire journey of property, plant, equipment. Basically, property, plant, equipment means tangible fixed assets. The entire journey of tangible fixed asset, right from defining what is property, plant, equipment, scope of this Ind AS, object of this Ind AS, recognition criteria, initial measurement, subsequent measurement. One of the key concept relating to tangible fixed asset is what? Depreciation. All concepts relating to property, plant, equipment is covered in this standard. So in this standard, what we are going to learn? All the aspects relating to property, plant, equipment we are going to cover. Starting with the definition of PPE, then we will see the objective of the standard, scope of the standard, recognition criteria. First time when I want to recognize PPE, how I am going to recognize it. In balance sheet, subsequently how I am going to recognize it, measure it. Relating to PPE, how I need to provide depreciation. Relating to PPE, derecognition criteria. And there is one concept called component accounting, which is very important for examination point of view. They're asking this component accounting. So all the important concepts relating to PPE is covered in this standard, sir. So basically in this standard, what we are going to cover, sir, if you see prima facie, the most important areas is, first we are going to see the PPE definition part, sir. What is PPE? We need to understand. Then we are going to cover the objective of the standard, why the standard came, what it is going to achieve. So every standard has its own objective, right? And also the scope of the standard, very important, sir. Sir, standard may not cover all types of items. Like for example, you take tangible fixed assets. This standard has its own limitations. So that is covered in scope. Very, very important. Then we need to understand the recognition criteria, recognition of PPE. Suppose first when you want to recognize PPE in the books, when you are going to recognize it, upon satisfaction of which conditions you need to recognize the PPE in the books, that is also there in the standard. And the most important topic is measurement topic. Measurement. At what value you are going to measure PPE? See, when it comes to measurements here, there are two things. One is initial measurement. Next, subsequent measurement. Initial measurement, subsequent measurement. Important area. This we are going to cover it. Next, there is one concept, depreciation concept is there. Relating to tangible fixed asset, generally we provide depreciation now. Relating to depreciation, all the aspects are covered in this standard. And also there is one concept of component accounting. Important, this is also a question can be tested from this area. Component accounting. Next, there is some other concepts like derecognition of PPE, and of course impairment loss. Actually, regarding impairment loss, sir, there is a separate standard. Ind AS 36. Ind AS 36. One of the very important standards, sir. If you see last 4 or 5 attempts, every attempt there is a question from impairment loss. I know why they are asking that standard, because nobody is going to cover. That's why. They know that. Majority, 99% of the students, they won't cover impairment loss because they feel impairment loss is one of the difficult standard. But trust me, it is not that much difficult as students are thinking. So in this standard, sir, I will give you brief idea about how we are going to calculate the impairment loss, but detailed discussion will be done in the respective Ind AS. Okay. So impairment loss topic. So these are the major topics, sir, in this standard we are going to cover. Apart from this, there are some small items also, but they are not that much important. That much important in the sense we are going to cover it, but the major things are these things. Okay. So let us cover each and every item, sir, relating to property, plant, equipment. I told you what we are going to cover in this standard. So first we are going to start with what? PPE definition. Let us try to understand what is property, plant, equipment. See, the standard says property, plant, equipment or PPE are tangible items. Tangible items. Which are held for. There are two conditions here. Both the conditions must be satisfied to become property, plant, equipment. So PPEs are tangible items held for. Why we are holding them? Held for use in production or supply of goods or services. Any assets we held for use in production or supply. of goods or services. Tell me some examples of assets which are tangible, physical, nothing but, which we held for use in production or supply of goods or services. Suppose we are doing production. In production, we are going to use the factory building. So we held factory building for use in production of goods. So factory building is what? PPE. Machinery, plant and machinery, we held for use in production of goods. So plant and machinery. Or services. Suppose we are a service oriented company. Suppose we are offering a consultancy services. This building we are using for providing our services. So this building is held for providing services. So this is also PPE. So what tangible assets, what physical assets you held for use in production of your goods? If you are a manufacturer, you are going to do the production. For production of items, what are the assets you are using? Any factory building, power generation units, any warehouse, okay, what is that, just now I told, plant and machinery, any turbines, missions, all these things. Or supply of services. If you are a service provider, for supplying your services, what assets you held? That is also PPE. Right? Next, for rental to others. Rental to others. Important. Rental to others. Sir, any assets held for rental to others is also PPE. Rental to others. For example, see, we have purchased a building. This building, our main intention is to earn rental income. This building we want to give it for rent, and from that we are going to get rental income. Right? So for rental to others. Rental to others. That is also covered under the definition of property, plant, equipment. But there is one standard called investment property. That standard says if you purchase any building or land not for the purpose of use in business but for the purpose of earning some income or for capital appreciation, that is called investment property. And for investment property there is a separate standard. So that standard we need to apply. For example, sir, very interesting, I am in renting business, sir. Come on, tell me. See, my business is renting business. Renting business. Okay. Now, we purchased one building. This building anyway, we are going to give it for rent because our main business is what? Renting business. Now tell me, this building is PPE or not? Is this PPE or not? Yes. Just now we have seen PPE are what? Tangible assets held for use in production of goods or rendering services. If your service is providing rent, I mean giving properties for rental basis, this property you held for providing the services, right? So therefore obviously it is PPE. Obviously this is PPE. Suppose for example I am doing mobiles business, right? We purchased a building. This building we give it for rent. Now tell me, is this PPE or not? Is it PPE or not? See, any PPE means what? Any tangible assets held for use in production of goods or supply of services. Is this building I am using for production of goods? No. My main operations is what? Mobiles. I am not using this building for mobiles business. I am not using it for services. I am not using it for production. But I held it for what? Rental to others. But remember guys, here the concept of investment property comes into the picture. There is another standard. See, whenever we have any specific standard, we need to follow that standard. Don't follow the general standard. Relating to investment property, there is a specific standard, investment property. See, in this case, this will become what? Investment property. Because you purchased a building for which purpose? Earning rental income. So there is a specific standard which says if you purchase any land or building for the purpose of earning rental income, then it will becomes investment property. Accordingly, the accounting will be done as per investment property. And but remember, if any aspects relating to the tangible fixed assets is not covered under that particular standard, then we need to apply this standard. Okay, anyways, my main intention is very simple. What is PPE? PPE means any assets either you held for use in the production of goods or supply of services or rental to others. When you held any assets for the purpose of renting to others, that is also PPE. For example, you purchased a machinery for giving it on lease basis, that means rental to others. But there is a specific standard relating to leases, then we need to apply that standard. Even though it satisfies the definition of PPE, but if there is a specific standard, we need to apply that standard. Don't apply this standard. Hello. But see, investment property is applicable only for what? Land, building. But apart from land and building, there are so many other assets, na? They are not covered under investment property. So if any other asset I purchased and gave it for even for rental purpose, if I purchase, they are all PPEs only. For example, we purchased a for example one machinery. Our main object is what? Earning rental income by giving that machinery. So machinery is not land or building, so it is not covered in investment property. So obviously it is covered here. So this rental to others. Why we held it? Rental to others. Because if you held land or building for rental to others, there is a separate standard. Investment property. Okay. But investment property is not there in our syllabus, so no need to bother. Okay. So PPE means tangible items. First one, tell me, which is held for what purpose? Use in production or supply of goods. So that means whatever business I am doing, whether I am a manufacturer or whether I am a service provider, in my manufacturing, in my service providing, whatever assets I am going to use, they are all what? PPs. Like for example, I am a manufacturer, I will use vehicles to distribute my goods. That means I am using these vehicles for what? Production or supply of goods. Supply. Production or supply of goods. So they are my PPs. Rental to others. Any assets I held for renting to others is also PPE. Subject to other standards. Please understand. And next one, for admin purposes. Administrative purposes. Admin purpose means like remaining purpose, like for example, any assets we use in accounting department, office buildings, fax machines, scanners, printers, office equipment. For example, right now where I am teaching here, right? This building, for example, I am not, for example, here I am providing services. So this asset, if I held it for providing my services, this is my PPE, right? When we call this as an administrative purpose, for example, here I am maintaining one office. In this office, I have furniture, right? Computers, ACs, equipment. These are all also PPs because administrative purpose. Administrative purpose means it includes selling and distribution. Okay. Any assets relating to administrating, general administration of the office, all those things are covered. For example, we purchased a bus for employees transportation. That is also PPE because we held it for what purpose? Admin purposes. For example, we purchased cars for providing transportation to employees or board of directors, admin purposes. Like different types. For example, ACs we purchased in the office. They are also covered here. But the most important thing is expected to be. Condition number 2 you see, which is expected to be used more than one period. That means used, which is expected to be used for more than 12 months, 1 year. Then only it will become PPE. So these two conditions must be satisfied to become PPE. So you understand what is PPE? Can you tell me what is PPE? To become PPE, how many conditions are there? 2 conditions. Basically PPE is what? Tangible item. Tangible item which is held for which purpose? Production, use for production or supply of goods or services, or rental to others. Any assets you held for rental to others, or administrative purposes. So, and which is expected to be used for more than 1 year or more than one accounting period. Then it will becomes automatically what? PPE. Now, there is one note point, sir, important note point. See, any spare parts, standby equipment, next service equipment. See this, spare parts, standby equipment, service equipment. Spare parts means what, sir? Bolts, nuts, bearings, small items which we will use in the factory. Regularly we will replace it, right? Suppose there is a large plant and machinery is there. In that plant and machinery, some items frequently they will lose their value. We need to replace them, right? Like how we are doing services for our cars, vehicles, engine oils we will change, whatever the small equipments will change. Na? Similarly, in the organization, in the factory, there are so many plant and machineries are there, right? In this plant and machinery, small equipments need to be replaced regularly. They are called spare parts. What organization will do? They will purchase these spare parts and keep it there, because whenever we need the spare parts, we will immediately take it and we will replace it. Otherwise, what happens, sir? Our machinery will stop, production will be stopped. It's a very difficult situation, right? So, on the spot, we will not buy. We will buy and we will keep it. That's why they are called what? Spare parts. Spare parts. Sir, spare parts PPE. Yeah. These molds, dies, jigs, bearings, small equipment we will carry, whether they will become PPE. If they satisfy this definition, then they are PPE. Otherwise, they are treated as inventory. Otherwise, they are treated as what? Inventory. There is one standard called Ind AS 2, which talks about valuation of inventories. So, in respect of spare parts, if they satisfy the definition of PPE, then they will be treated as PPE as per A16. If they don't satisfy, then they will be treated as inventory. Similarly, standby equipment. Any standby equipment we will carry. For example, fire extinguisher. Suddenly fire may come, right? So therefore, we will have this fire extinguisher items, equipment. Standby equipment, that is called. Standby equipment means we keep it stand. Whenever we want, we will use it. Right? Any standby equipment in the organization is also what? PPE, provided it satisfies this definition. If it doesn't satisfy, inventory. Similarly, service equipment. Any service equipment we carry in the factory or in the organization. So, if it meets the definition of PPE, then PPE. Otherwise, inventory as per accounting standard 2. So, please remember, any spare parts, standby equipment, service equipment, if they meet the definition of PPE as per Ind AS 16, recognized as PPE, otherwise treated as inventory as per accounting standard 2. Okay. So, we have completed the definition of property, plant, equipment. So, now we understand that the organization, if you take any business organization, what is property, plant, equipment? All tangible items, which we held it for which purpose? 3 purposes are there. Either you held it for use in the production or supply of goods or services. Directly in your main activities you are using, you held it. Or rental to others. You want to earn some rental income, that's why you keep these assets. They are also PPE. And for administrative purposes, that means for running of the business, for different activities you purchase different assets, they are also PPE, provided they must be useful for more than one accounting period. Okay. Next, I told you spare parts, standby equipment, service equipment. If they meet the definition of PPE, then PPE, otherwise inventory. Now, next comes the objective of accounting standard Ind AS 16. Sir, every standard will have its own objective. And in fact, if you see every Indian accounting standard or every accounting standard, it has some basic structure, like first objective, then scope, then recognition principles, then measurement principles, then presentation principles, then disclosure principles. Like this, every standard will have one fixed format. Most of the standards will cover this. So what are the contents of accounting standard? Basically, how accounting standard will be drafted? What is the basic structure of accounting standard? First, every standard you see will have what? Objective. Second, every standard will have scope. Third, every standard will provide some definitions. Like just now we have seen PPE definition, right? Every standard will give you definitions. Fourth, recognition principle. Every standard will prescribe the recognition principle of that particular item which that standard is dealing. Recognition principles. And every standard talks about what? Measurement principles. At what value that particular item is going to be measured. Measurement principles. Next, every standard will talk about the presentation, how that particular item is going to be presented. And last, every standard generally talks about disclosures, what information we need to disclose in respect of that particular item. In preparation of financial statements, we need to disclose some information, right? So that information is given by the standard in respect of that particular item which is dealing with. Okay. So basically this is the format they will follow. Basic structure is this. So that's why you see the objective. What is the object of Ind AS 16? Simple. The basic object of Ind AS 16 is provide the accounting treatment for PPE. Accounting treatment for PPE. How I am going to do the accounting for PPE? What is PPE? They told. Then when PPE is going to be recognized, they will provide. At what value PPE will be recognized initially, they will tell. Measurement, subsequent measurement. In balance sheet, at what value PPE is going to be shown. How to provide depreciation. All these aspects they will cover. They are only nothing but accounting. So what is the basic object of Ind AS 16, sir? The basic object is to prescribe the accounting treatment for property, plant, equipment. And see, this standard will also give some useful information to the users of financial statements regarding how much an organization has invested in PPE, what changes it has made in the investment. For example, see, just now I told you disclosures. The standard at the end will provide some disclosures. In that disclosure, the standard says every organization at the end of the year, they need to prepare a statement showing how much each class of assets, what is the opening value, how much you purchased during the year, how much you sold, what is the depreciation you provided, what is the closing value. Like that you need to provide details in respect of each class of PP. So when I users of financial statement, when I look at the financial statements, I can easily understand, right? What is the opening balance of this asset, how much they have purchased during the year, how much sales happened, what will be the closing balance, I can easily know. See, in the entire balance sheet, where majority of the amount will be there? Fixed assets, right? So it's a huge investment. Company is spending lot of amount on the fixed assets. So that's why the standard provides information relating to how much an organization invested in its assets and what changes happened in this investment. Because once we purchase an asset, we will provide depreciation, we will provide impairment loss, and we will sell assets, we will acquire additional assets. So it will change. Those changes also, this standard will provide the information to the users of financial statements. So see this. What is the main, another object of Ind AS 16 to help users of financial statements assess the entity's investment in PP. How much we invested in PP and changes in such investment. How much changes happened during the year in respect of the assets will also provided by this standard. And this standard is address the principal accounting issues. What are the principal accounting issues relating to PP? Just now I told you. What are the principal accounting issues, sir? Recognition, when we are going to recognize PP, carrying amount determination, nothing but measurement, and depreciation, how much we need to provide, impairment losses, all these things are addressed by this standard. Not important, they are not going to ask what is the object of Ind AS 16. But you need to understand why the standard came, what the standard is going to address. So 3 points you need to remember. First, the standard is going to provide the accounting treatment for PPE. Second, this standard is help the users of financial statements by providing how much an organization invested in its PPEs and how much, what changes happened in this investment during the year. And also the standard is going to address all the principal accounting areas of property, plant, equipment. Okay. Next, scope of the standard, very important. There may be an MCQ possible. Sir, scope. Generally, sir, when it comes to scope, they will talk in a negative manner. Negative manner in the sense, they will tell this standard is not applicable in which cases. The standard is not applicable in which cases. So they will prescribe the list. In these cases, the standard is not applicable. That means remaining cases, the standard is applicable. So you need to remember this negative list. So you see non-applicability. That's why I have given a heading non-applicability. Sir, important sir, this standard is not applicable to. There are 4 things they said, sir. First thing, any property, plant, equipment classified as held for sale. Say this, PPE classified as held for sale is not covered under the standard. Why? I told you, when there is a specific accounting standard, that has to be applied. When a PPE is held for sale, that is covered in Ind AS 105. So therefore it is not covered in Ind AS 16. Next time in this standard I am going to explain one principle, sir. That principle is, whenever an organization wants to sell this particular plant and machinery, they want to dispose it, they held it for sale, then that is the point we need to remove that plant and machinery from the books, that PPE from the books. Because see, as long as PPE is giving future economic benefits, you will keep in the books. The moment it becomes idle and you want to sell it, definitely you need to de-recognize from the books. So that's why PPE classified as held for sale. See this, held for sale. We want to held it for sale. We don't want to continue for use in the organization. So therefore that kind of PPEs are not covered here. They are covered in Ind AS 105. Next, biological assets, important, related to agriculture activity other than bearer plants. Biological assets relating to agriculture activity, other than bearer plant, that means this standard is applicable to bearer plants, but it is not applicable to biological assets, that too relating to what? Agriculture activity, because it is covered in separate standard in Ind AS 41. So if there is any biological assets relating to agriculture, you need to follow Ind AS 41. Don't apply Ind AS 16. But other than bearer plant, if the plant is which plant? Bearer plant, then the standard is applicable. I am going to explain what is biological assets. We are going to discuss what is bearer plant. We are going to discuss it. First, negative list, you see, this standard is not applicable for any PP held for sale. Second one, biological assets relating to agriculture activity other than bearer plant. That means this standard is applicable to bearer plant. But any biological assets relating to agriculture is not covered under this standard, because there is a separate standard in Ind AS 41. Next one, any assets used in exploration and evaluation of mineral resources. Sir, any assets you are using in exploration of minerals, oils, all these things, I mean mining, you do mining, right? For doing mining, whatever the assets you use in exploration and evaluation of mineral resources, they are covered in Ind AS 106. They are not covered under this standard. And also any mineral rights, mineral reserves such as oil, natural gas, etc. If you got any right to explore oil, gas, mineral rights, natural resources, if you taken any rights to explore these natural resources, they are called wasting assets. Wasting assets means as and when you extract, they will reduce, they will got depleted. So if you got any mineral rights and mineral reserves such as oil extraction, natural gas extraction, all these things, if you got any kind of these rights, they are not covered under this standard, because this standard basically talks about tangible assets. These rights and all intangible items, basically rights, right means what? Intangible in nature, so they are not covered here. Okay, so tell me, Ind AS is not applicable to what cases? How many cases are there? 4 cases. What are those? So any PPE which is held for sale, not covered. Why? There is a specific standard, Ind AS 105. Next, biological assets relating to agriculture activity other than bearer plant is covered in Ind AS 41, agriculture. Next, any assets you are using in exploration, evaluation of mineral resources, covered in Ind AS 106. And last one, any mineral rights, mineral reserves, extraction like oil, natural gas, oil, all these things, they are not covered under this standard. Now see, this standard shall be applied in accounting for PPE except when another accounting standard requires or permitted different accounting treatment. This point I already told you. When there is a different accounting standard which is prescribing accounting treatment for any particular PPE, then that standard will be applied, not this standard. For example, relating to leases, there is Ind AS 116. So we will apply Ind AS 116. Don't apply Ind AS 16. Different accounting treatment is required by another accounting standard. Please follow that. Okay. Now next important, sir. Biological assets means what, sir? Biological assets means simple, sir. Biological assets means living animals and plants are called biological assets. Biological assets means living plants and animals. Sir, in agriculture, plants will be there, animals will be there. Animals will be used, plants will be there, right? So these are called biological assets. Whether these biological assets are PPEs, first thing is biological assets relating to agriculture not covered in the standard. So you need to tell that biological assets relating to agriculture is covered in Ind AS 41. Go there. But only one exception is there. What is that? Bearer plant. So in plants, there is one category of plants called bearer plants. Now this standard says bearer plant is PPE and we need to apply Ind AS 16. Hello. Sir, when we say plant is a bearer plant, guys, remember, very, very important. Bearer plant means what? See, three conditions must be satisfied to become a plant as a bearer plant. Bearer plant is a living plant, that is, first thing is, which is used in production or supply of agriculture produce. That plant is used in the production or supply of agriculture produce. Second thing is, which is expected to bear produce for more than one period. That plant must give produce for more than one accounting period. More than one accounting period means more than 12 months. And the last one is, there is a very remote likelihood of being sold as agriculture produce except for incidental scrap sales. If these three conditions are satisfied, then that plant is called what? Bearer plant. For example, take one mango plant, for example, mango tree. We will apply this definition. Mango tree, sir, first condition, is it used in production or supply of agriculture produce? Yes. Mango tree is grown for what? Mangoes. Mangoes is an agriculture produce. So this tree is used for production of agriculture produce. Here agriculture produce is what? Mangoes. So first condition satisfied. Second, expected to bear produce for more than one period. Is mango tree is going to give mangoes for more than 1 year or not? Yes. It is going to give agriculture produce, mangoes, for number of years. So it is going to give agriculture produce for more than one period. Second condition satisfied. Third, remote likelihood. Remote means rare. Remote means rare, not TV remote, AC remote. Remote means rare here. Rare chances, rarest chances, we will say na. Remote likelihood that it is being sold as agriculture produce. See, tell me, the mango tree is grown for its wood. See, mango tree we grow. We will cut down and we will sell. No. Why mango trees is grown? For its mangoes. That means remote likelihood of being sold as agriculture produce. That means very rarest chances that that plant is itself is cut down and sold as agriculture produce. For example, you take tree. Take tree, we will grow for its wood. Therefore, once it is grown to certain level, we will cut down and we will sell. Therefore, it is not a bearer plant because it is likelihood of being sold as agriculture produce. So, to become a bearer plant, that plant cannot be sold, cannot be cut down and sold. Generally, it is grown for its produce. Like for example, coconut tree you take. Why coconut tree is grown, sir? For its coconut, right? Coconut tree we will grow for its wood. Generally not. Generally not. Except for incidental scrap sales. See, incidental scrap sales. For example, once the life is over, sir, mango tree life is over. 40 years, suppose this mango tree, 40 years it has given agriculture produce. Now it is no more giving anything. So we decided to cut down and sold. that's okay. That cannot make the tree as other than bearer plant, except for incidental scrap sales. Once the life is over, we will cut down and we will sell that plant. So that cannot stop that plant to become a bearer plant. So tea plant, for example, tea plant, tea plant, tea leaves, tea plant, is it a bearer plant? First thing, first condition, to become a bearer plant, 3 conditions. Now, what is the first condition? Agriculture production. Is tea plant is going to give agriculture produce? Yes. What is that? Tea leaves. We are consuming tea daily, right? The tea powder came from tea leaves only, na? The tea leaves is given by whom? Tea plant. So agriculture produce. Second, is it going to give produce for more than 1 year? Yes. Tea plant is going to give tea leaves for number of years. Next, third, is it a remote likelihood of being sold as agriculture produce? Whether tea plant itself is cut down and sold as agriculture produce? No. The tea plant will give tea leaves. Those leaves we will pluck, we will use. Except for incidental scrap sales, that's okay. Once the life is over, we will cut down and sold. That's except incidental scrap sales. And also palm oil tree. Sir, palm oil tree, sir. Palm oil tree will give what? Palm fruits. Palm oil we are consuming. See, different kinds of oils we will use for cooking. Palm oil is also there, na? Palm oil is came from palm fruit. Palm fruit is given by whom? Palm oil tree. So palm oil tree, is it going to give agriculture produce? Yes. Palm fruit. Second, is it going to bear produce for more than 1 year? Yes. Third, is there a remote likelihood of being sold as agriculture produce? Yes. No chances that this palm oil tree will be cut down and sold. It is grown only for its palm fruit. Sir, some plants will be grown exclusively for its exclusively that plant itself is grown for its wood, or for directly we will cut down. Like for example, seasonal crops you take paddy, jowar, maize, all these things we will directly take, right? So they are not bearer plant. So to become a bearer plant, 3 conditions must be satisfied. And what is the final conclusion? Bearer plant is covered in Ind AS 16. Bearer plant is covered in Ind AS 16. So what is biological asset? Living animals and plant. But in plants, bearer plant is covered in the standard. Remaining plants covered in 41. You see here 41. And also, sir, there is one point in scope, that is investment property. An entity accounting for investment property and an Ind AS 40 investment property shall use which model? Cost model as prescribed in Ind AS 16. Actually, I told you what is investment property. What is investment property? Investment property means what? Investment in land or building, not for the purpose of using in business, but for the purpose of earning income, rental income or capital appreciation. See, if you purchase any land or building for the purpose of earning income or for the purpose of capital appreciation, that is called what? Investment property. And for investment property, I told you there is a separate standard. Which standard? Ind AS 40. Ind AS 40. Investment property. But this standard is saying, in respect of investment property, which is covered in Ind AS 40, they need to follow which model? Cost model as prescribed in Ind AS 16. What is this cost model? I am going to explain. Subsequent measure it will come. Okay. So this is the scope of the standard, sir. So we have completed the objective as well as the scope of the standard. So let me revise so far what we have discussed in this standard. So what is the standard we are discussing? Ind AS 16. Ind AS 16 basically talks about property, plant, equipment. First we discussed the definition of PPE, right? What is PPE? PPEs are tangible items held for use in production or supply of goods or services, or rental to others, or for administrative purposes, and expected to be used for more than 1 year, 1 accounting period. Stores, spare parts, service equipment, if they meet the definition of PPE, Ind AS 16, otherwise Ind AS 2. Okay. And next we have discussed the objective. What is the object of Ind AS 16? Accounting for PPE. Then how much we invested in PPE, what changes happened in this investment, which will provide information to users. Next, It covers all the principal accounting items of PPE, like recognition, measurement, depreciation, impairment loss relating to PPE is covered in this standard. Next, scope, non-applicability. Which cases the standard is not applicable? Any PPE held for sale and biological assets relating to agriculture activity other than bearer plant. Next, any mineral assets used in exploration, evaluation of mineral resources, mineral rights, mineral resources, Ind AS 16, 106, sorry. Last one, mineral rights, mineral reserves such as natural gas, oil extraction, all these things, they are not covered under this standard. And what is biological asset? Living animals and plants, right? And this standard is applicable only for Ind AS 16, applies only for bearer plants. What is bearer plant? 3 conditions. First, it must give agriculture produce for more than 1 year. Remote likelihood of being sold as agriculture produce. Best examples, mango tree, coconut tree, palm oil tree, tea plant, all these things. So, we have to be very careful when you are applying the definition of this bearer plant. Next, recognition of PPE. Okay, sir. In Ind AS 16, now we are entering into the major part, very, very important part, sir. From now onwards, the standard is very, very important, and the knowledge of the remaining part of the standard is absolutely necessary for solving the questions. Till now, what we have discussed, objective, scope, definition, these are all okay. Basic understanding is enough. You cannot expect any question from the topic so far what we have discussed. Maybe one MCQ they can ask relating to scope. But now onwards, whatever we are going to discuss is very, very important, sir. So in that, the first one is what, sir? Recognition of PPE. Okay, listen to me carefully. Sir, first time as a business enterprise, I want to recognize PPE. Suppose we purchased a plant and machinery. Can I recognize that plant and machinery in the books? The standard says 2 conditions must be satisfied to recognize in the books. So mere purchasing of plant and machinery doesn't mean that asset you have to recognize, it will become your PPE, you have to recognize in the books. Very interesting. The standard says 2 conditions must be there. So to recognize in the books, the first condition is probable future economic benefits. FEB, probable future economic benefits. Probable means more likely. From this PPE, whether I am going to expect benefits in future. If answer is yes, then first condition is satisfied. Sir, this PPE, I am not expecting any benefits, sir. There is no probability. Probable means more likely, more than 50% chance. Actually, nowhere in India they said what is the meaning of probable. Probable means more likely chances. More likely chances that this PPE is going to give me future economic benefits. Sir, what is future economic benefit? Future economic benefit means either it is going to generate some income, or it is going to save some cost, or it is help us to generate income, or it help us in the administration of the business. Somehow it is going to give me some benefits. Suppose this plant and machinery is there. This plant and machinery is going to give me what? Production. I can use production. This vehicle, I can use it in the distribution of goods. So like that PPE must give me some benefits. When? In future. In future, some benefits must be generated. More probable chances should be there. Benefit not only mean income, even savings in cost also. Even helps in administration also. Somehow for the overall supporting of the business activities also. Whatever. So first you need to see whether this PPE can give me future economic benefit. Yes sir, it is going to give sir. I am very confident sir, probable. Second condition, the standard says cost is measured reliably. Can you able to measure the cost reliably? Because in books we need to recognize the asset. When you want to recognize asset in the books, there must be some value to it. Cost. Can you able to measure this cost reliably? No sir, we don't know the cost sir. We got this asset, but this asset how much we spend we don't know. We got this asset freely sir. We don't know the cost sir. We are unable to measure the cost reliably. Sir, my lucky number is 7 lakhs I will write. No, standard says no. Reliable measurement should be there. That means you must be able to tell this is the value of this asset. I can able to measure it reliably. So if these two conditions are satisfied, then standard allows, okay, now welcome. We will recognize you as an asset in the books. One examination question I will explain here. In CA Inter, this question asked a number of times. Even I think CMA also, in CMA Inter, this question is there. CMA Inter level 1 question is there. See, I will tell you that question, very beautiful question. There is a company A Limited, sir. There is a company B Limited. This company A Limited entered a contract with B Limited for purchase of one mission. Purchase of one mission. This mission is exclusively customized mission as per the requirements of A. That means this mission does not have any use to any other. Only it is useful only to A Limited. So they entered a contract with B Limited to purchase this mission. Everything is done. Mission also ready. But what happened is, in A Limited, they have changed the production method. Production method they have changed. Delta symbol, the change. Production method changed. Now because of the change in production method, what happens is, this mission is no more useful to us. This mission is no more useful because we have changed the production method. Now exactly before delivery of this mission by B Limited to A Limited has done this. Because of that, this mission is no more useful to A Limited. Now tell me, A Limited, can it recognize this mission as PPE in its books? As an asset in its books, can it recognize? See, whenever I ask a question, don't say yes, no, yes, no. Apply the standard. What we are learning? Recognition. When will you recognize PPE? Two conditions. I told two conditions now. Apply it. What is the first condition? Probable future economic benefit. This mission is going to give any future economic benefits? No, it is no more useful to you. And you cannot sell it to anybody also, because it is made according to your requirements. Even if you want to sell it as a scrap, no scrap will come. Hello, 1 kg onions will come, that's it. If you give it to the onion seller, he will give 1 kg onions. In peak season, no, 1 kg tomatoes will come. Tomato cost 20 rupees or 30 rupees will come. Kg tomato how much? You don't know. You guys not married, right? I married, so I know very well. 20 rupees normal roadside. Reliance 30 rupees. So where you need to buy? Roadside. 10 rupees you can save. After being a family man, so you will know everything. Now you don't know about the tomatoes, onions. You are not worried now, because you need not require to purchase now. After marriage you have to purchase, right? That's why. Okay, so here in this case, A Limited, can they recognize this mission as their PP in the books? No, because the first condition, probable future economic benefits, is not there. Sir, some smart student says, sir, A Limited changed the production method. They know that this mission is no more useful. Then why they are taking delivery, sir? Sir, already agreement done, sir. You cannot say B Limited now, say we don't want it. Already everything is done, payment also done, everything. If you don't take the delivery, what happens? B Limited will file a case against you. Already there is a contract na. In that contract everything they will write. So don't ask all these kinds of doubts, silly doubts, please understand. Some students will take this personally also. Don't take it. So tell me, when you want to recognize PPE in the books, how many conditions? What are the two conditions? Probable future economic benefits associated with the item will flow to the entity, and I am not saying are, and what is the second condition? Cost is measured reliably. Reliable measurement of cost should be there. Sir, unscientific way of measuring things not allowed. Reliably you should be able to tell how much this cost. For example, there is a thief, sir. He has done a theft of a MacBook, suppose this computer, laptop. Somebody asked him price. What is the price? What he will tell? He says, okay, this cost I think 2 lakhs. He says. Estimation. Standard is not accepting that. No. Reliable measurement should be there. Okay. So recognition of PPE. Hope I explained it properly. You understand it, right? So it is not you purchased the PPE. Somehow I got the PPE. You need to see whether this PPE is going to give me benefits. Is it probable? Second, whether I can able to measure the cost. If these two conditions are satisfied, then I need to brought the PPE into the books. Otherwise, no entry board. Sir, this is our asset, sir. Standard says no. Asset means it must give some benefits. Na? If it is unable to give benefits, or you cannot able to measure the cost, no entry board will write. Right? Next, the most important area is measurement of PPE. Okay. Now, guys, please concentrate. What is the next concept? Measurement. Sir, first of all, what is measurement, sir? Measurement means how much value, how much cost it is. What is the value of this particular item? That is called measurement. Sir, okay, PPE you want to recognize in the books, right? When you want to recognize the PPE in the books, at what value you are going to recognize? That is called measurement. How to determine the cost? That is measurement. See, in measurement, as I told you, two things. One is initial measurement. What is initial measurement? First time when you want to recognize PPE in the books, at what value you are going to recognize? That is called initial measurement. Important. Please listen to me very carefully. Very technical, very interesting. This is where the questions comes. The standard says, sir, initially PPE will always be recognized at cost. That's it. Initially PPE will be recognized at cost. Now the question came, how to determine this cost? How to determine cost? Sir, the cost determination depends upon the mode of acquisition. Cost determination depends on what, sir? Mode of acquisition. What is mode? Mode means in what manner, what type you are acquiring PPE. Here there are 4 types are there in general, majority. How you are going to acquire PPE? First one, PPE acquired by purchase. PPE acquired by what? Purchase, sir. We will purchase PPE directly. Second, self constructed. Self constructed PPE. Sir, sometimes on our own we will construct the PPE. For example, we construct our own building, we construct our own factory, we construct our own plant and machinery. That is also one mode. Next, PPE acquired by exchange. Sometimes PP is acquired by what? Exchange. Exchange of assets. I will give my asset, you give me your asset. I am taking one asset, giving one asset. Exchange of assets. Next, PP acquired by deferred credit terms or deferred payment. Sometimes PP acquired by deferred credit terms. These are the major ways in which a PP is acquired. Okay. So tell me, what is the concept you are learning? Measurement of PPE. In measurement of PPE, first initial measurement. Initially, PPE will be measured at cost. How to determine the cost? Depends on mode of acquisition. In the mode of acquisition, what is the first mode? PP acquired by purchase. Okay, listen to me carefully. Sir, when PP is acquired by purchase, PP acquired by purchase. In this acquisition, what are the cost elements involved? Cost elements. Standard says there are 3 cost elements, sir. Very, very important. Please listen to me. There are 3 cost elements when you acquired PPE by purchase. First cost element. First cost element is purchase price. Purchase price. First, suppose when you purchase the PPE, you have to pay amount to the supplier, right? Purchase price. And to this purchase price, we need to add taxes and duties, right? Taxes and duties. And that to which taxes? Non-refundable. Important guys, non-refundable only we need to add. Suppose if there are refundable taxes, don't add. GST, suppose you are paying. GST refundable or non-refundable? Non-refundable, but we can take ITC. So, GST generally we don't add. Only non-refundable we will add. If it is refundable in nature, that tax we should not include in the purchase price. And also, sir, any trade discount, rebate given by the supplier, we will deduct. Okay. So this is the first element, sir. You will get the adjusted purchase price. So when you acquire PPE by purchase, 3 cost elements are there. First cost element, purchase price. To this purchase price, we should add all the taxes we pay at the time of purchase if they are non-refundable in nature. Any discount given by the supplier, deduct it. Next, sir, most important cost element is directly attributable cost. Directly attributable cost. Directly attributable cost. Sir, what is this directly attributable cost? Directly attributable cost means the cost which are directly related to bring the PP to its present location and condition as capable of operating in the manner intended by the management. Sir, suppose imagine, sir, there is a PP you purchased. There is a plant and machinery you purchased. Now, once you purchase, first you need to bring it to the factory. Further to transportation cost, loading cost, unloading cost, insurance cost will be incurred. Once it came to factory, in factory it has to be installed. So installation expenses, assembly expenses, trial run expenses. So from the purchase stage to the stage, yes, this asset is ready. Till that time, till that stage, whatever cost you are incurring, they are called directly attributable cost. Important. Directly attributable cost means the cost which are incurred to bring the PPE to its present location and condition, capable of operating in the manner intended by management. The management, how they want to use this asset, whether this asset is ready for its intended use. To bring to that stage, whatever the cost we are incurring, they are called directly attributable cost, and they all will be added. Like for example, I told you transportation cost, insurance cost, site preparation cost, trial run cost, all these things, insurance, all this cost will be added. So directly attributable cost means the cost which are incurred to bring the PP to its present location and condition. So two words are important, location and condition. To bring the PP to its present location and condition. Till that stage, present location and condition, capable of operating in the manner intended by management. Whatever the cost you are incurring, they are all what? Directly attributable cost. Next, you take all the directly attributable cost. Next, third one, very, very important, sir. Decommissioning cost. Decommissioning, restoration cost. Decommissioning, dismantling, decommissioning, dismantling, and renovation cost. Okay. Sir, what is this decommissioning, renovation and dismantling and renovation cost? See, for example, sir, once PP is installed, suppose there is a plant and machinery, we installed this plant and machinery in the factory. Okay. Suppose the life of this plant and machinery is 10 years. Sir, once 10 years is over, we need to remove this plant and machinery. Na? In order to remove this plant and machinery, some cost will be incurred. Na? That is called decommissioning cost, dismantling cost. And once you remove this plant and machinery, you need to restore, you need to renovate, not renovation, sir, this is dismantling, decommissioning, dismantling, restoration cost, this is restoration. You need to restore the land as it is, correct? For example, for the purpose of installation, you might have excavated the ground, right? You might have constructed some concrete floor. All this has to be removed. For that, some cost will be incurred. That is called decommissioning, dismantling, restoration cost. Okay. Now, this cost what we are going to incur in future relating to this particular PP, for removal of this PP, dismantling of this PP, restoration of the land where it is situated, that cost also will be included in the cost. Initial cost we are recognizing now. In that cost, this cost will also be included. But the point is, this cost is relating to future. So the standard says you need to bring it to present value. So this cost which we are going to incur in future, we need to convert into present value and we should add to the cost of PP. For example, we are estimating after 10 years we are going to incur 10 lakh rupees. So this 10 lakhs has to be brought to the present value. On the date of recognition, on the initial date, on which you are recognizing the PPE, on that date, what is the present value of this 10 lakhs? That will be capitalized. That will be capitalized. Important, they will ask a question. I'm going to solve one question also now. Important. So these are the cost elements. So can you tell me, initially when you want to recognize PPE, so you will recognize at a cost. Tell me, PPE is acquired by purchase. What are the cost elements? How many cost elements are there? How many cost elements are there? Three categories. What is the first one? Purchase price. For that, add all taxes and duties. Which nature? Non-refundable. Less trade discount rebates. That is the first category. Second category, directly attributable cost to bring the PPE to its present location and condition in the capable of operating intended by management. Site preparation cost to, initial delivery cost to, trial run cost to, installation cost to, all these cost. Now once the PPE is ready, till that stage, whatever the cost we are incurring, that will come under directly attributable cost. What is the last category? Decommissioning, dismantling and restoration cost. What is this cost? In order to remove this plant and machinery, in order to dismantle this plant and this PPE, in order to restore the land where it is situated, whatever the cost we are going to incur in future, that is called this decommissioning restoration cost. Now this cost will also be capitalized, but we should brought it to the present value. Should brought it to the present value. Sir, okay, you said, suppose, important guys, listen to me. Suppose 10 lakhs is the future value. I brought it to the present value, it becomes 8 lakhs. What is the difference? 2 lakhs. What we need to do? This 2 lakhs. What we need to do is we need to unwind over the next 10 years. This 2 lakhs we need to unwind over the next 10 years. Okay, I'm going to tell it. Wait. So, see this. Initial measurement. Initially, PP will be measured at what value? Cost. And what are the different situations in initial measurement? First, PPE purchased. When PPE is purchased, what are the components of cost? First, purchase price. For that, we need to add all the duties and taxes. Which taxes? Non-refundable. And less any trade discounts and rebate. This is the first category. Next, second, you see, directly attributable cost to bring the asset to its present location and condition. What cost generally will be included? Employee benefit cost. Important. What is this employee benefit cost? Sir, in the installation of this newly acquired PPE, we may use some of our employees, right? For them, we pay some salaries, wages. So, any salaries and wages we are paying to the employees, labor, who are directly involved in the installation of this PPE, that will also be capitalized. That is called employee benefit cost here. Okay? As per Ind AS 19. See, there is a separate standard Ind AS 19 which talks about employee benefits. Are you understanding, guys? Any labor, any employees you are directly involved in the PP installation to bring the PP to its present location and condition, that cost, whatever we are paying them, the salaries, the wages, the remuneration, the fees, whatever we are paying to our own employees who are involved directly in the PP installation to bring the PP to its location and condition, that will be capitalized. And site preparation cost. Sir, for example, we purchased a plant and machinery. So we need to install it some place. Now that place is not ready. So we have make it ready. Site preparation cost we may incur, that cost. Initial delivery and handling cost. Taking delivery of the PPE, transportation cost to, insurance cost to, loading cost to, unloading cost to, installation and assembly. Once the PPE came into the factory, we need to install it, we need to assemble it. Next, testing cost, important. Testing cost means trial run. Sir, once you installed the machinery, after that you need to see whether this machinery is working as per the manner intended by it or not. For that we will do some trial run, right? The trial run cost is also capitalized. Hello? But here one important point, sir. When you do trial run, sir, what happens? When you do trial run, some samples will be generated, na? Some samples. Suppose we produce 1,000 units in trial run. Some samples are generated, na? These samples are sold, right? Suppose we got some amount, sale value. This amount we need to reduce from the trial run cost. only balance cost will be capitalized. Important. For example, for trial run, we incurred a cost of 1 lakh, sir. The samples we generated, we sold in the market, we got 20,000. So 1 lakh minus 20k, so 80,000 we will capitalize. 80,000 we will capitalize. That way, see, net of sale proceeds from samples. Hello. Sir, suppose, see, this is the plant and machinery, sir. Installed. Okay. Tell me, the moment plant and machinery is installed, will you stop capitalizing? No, you need to, whatever the cost you incurred till the PPE to brought its location and condition capable of operating in the manner intended by management. Management wants to see whether this plant and machinery is working as per the requirement or not. So that means they do trial run also. So that trial run is also included in the directly attributable cost. Directly attributable cost means the cost incurred till the stage the asset is brought into the condition, location, capable of operating in the manner intended by management. To bring this asset to your purpose, whatever the cost you are incurring. Once the asset is ready for use, you should not capitalize after that. Hello. So trial run point you understood? Huh? They will ask. So what is the adjustment here? Any samples generated in the trial run, the sale of those samples amount will be deducted, only remaining amount will be capitalized in the directly attributable cost. And any professional fees we pay. Any, suppose for example in the acquisition of plant and machinery or acquisition of PPE we appoint any engineer, or in the installation of PPE we take the services of any technical person, for him we pay what? Professional fees. That professional fees is also directly attributable cost. We will capitalize. Okay. And last one is what? Estimated dismantling, decommissioning, restoration cost. At what value? Present value. At present value we need to add this. So therefore, now can you tell me what is the entry you are going to write, sir? What is the entry you are going to write here? PPE account debit. Hello? PP asset. When you acquire any new asset you are recognizing in the books, you debit na? PP account debit to cash or bank account or supplier account if you have not yet paid. To provision. Provision for what? Decommissioning, dismantling, restoration cost account. If you have any future cost relating to dismantling, decommissioning, for that you need to create a provision. Important. When you create a provision, you will credit na? Hello. For example, you purchased a machinery, cost 10 lakhs. You paid to supplier 10 lakhs. And in future, in respect of this PP, the cost you are going to incur for dismantling is for, and this provision is converted into what value? Present value. I told you we should write it in present value, right? Suppose the present value, for example, came 97,000. So 10 lakhs 97,000 is the value at which PPE will be recognized, capitalized. 10 lakh 97,000. In this 10 lakh 97,000, this provision, future cost is also there. See, this 97,000 is what value? Present value. So, by the end of the life, this has to become the future value. So, every year what we need to do? Some amount we need to unwind. That unwind amount every year we do, that is called interest. That will be treated as interest finance charge and we will transfer it to P&L account. So every year what we will write? Interest to provision, interest to provision, interest to provision. So finally provision will be equal to future value. And finally we will pay the amount, right? Dismantling, decommissioning cost we incur, right? Provision to cash or bank. So, okay, don't worry. Here I have given also, actually I will show you. See this. Accounting entries. For purchase of PP account debit, bank account or supplier account, provision for decommissioning, dismantling, restoration cost. For unwinding of discount, finance charge to provision for DDR cost, transfer to P&L. This finance charge we will transfer it to P&L account. Okay, let me solve one example. Come to everybody, see this example, important. Please concentrate. Let us see the concept. See, there is a company XYZ Limited, sir, which installs what? Power generator. When? 1st April 2024. So power generator is what? PP. What is the cost? 8 lakhs. Useful life? 5 years. See this. Estimated dismantling and site restoration cost after 5 years, how much? That means this power generator we will install now. After 5 years we need to remove it. For that we are estimating how much? 3 lakhs. What is the discount rate? 8%. Because to convert into present value I require discount rate. Hello? Tell me. Here first I need to decide what? Present value of DDR cost. Can you find out the present value? 3 lakhs is the future cost, right? Divided by 8%, 1.08 for 5 years. Sorry, in examination they will give you present value. Don't worry. Or even if they don't give, you know, 1 divided by 1 plus r whole power n. So 1.08 whole power 5. 5 years present value. Can you tell me the amount? How much came? 1.08 into 1.08, 1.08, 1.08, 1.08, sir. I think 1.4693. Correct? 1.4693 approximately. 3 lakhs divided by 1.4693. How much? 2,04,178. 2,04,180 I will write approximately. So this is the what? Present value of future cost. Future cost how much? 3 lakhs. What is the present value? 2,04,180. Now see, on 1st April 2024, what I will write the entry? Can you tell me? PP. Hello. Power generator. PPE account debit to cash, or suppose for example I have not yet paid, so I will write to supplier, to provision for DDR. Correct? Supplier how much, sir? 8 lakhs. What is the present value of the future dismantling cost? 2,04,180. So what is the total cost of PP? 10,04,180. This is the first entry I will write. Guys, are you understanding? Now at the end, come to first year end, 31st March 2025. At the end of the first year, what we need to do? We need to unwind the remaining difference. For example, you see here 2,04,180 is the present value, right? Future cost is how much? So how much gap is there? 5 years. This we recognized at the end of the beginning first. So first year end, second year end, third year end, fourth year end, fifth year end. By the time we reach fifth year, it should become how much? 3 lakhs. So therefore what we need to do? We need to unwind every year as finance charges. So finance charges or interest expenses you can write. Finance charges account debit to provision for DDR. How much? Simple. What is the opening balance you recognized? 2,04,180 into discount rate 8%. 2,04,180 into 8%. How much? 16,334. 16,334. And this will go to, this finance charge will go to P&L account. P&L to finance charges account. 16,334. 16,334. So like this every year I need to do. So by the end it becomes how much, sir? 3 lakhs. So if I write unwinding schedule, this is called unwinding schedule. Unwinding schedule. Suppose year. How many years? 5 years. Right? What is the opening provision? Opening, we are recognized 2,04,180, sir. What is the basic interest? I mean discount at 8%, right? Hello? At the end of the first year on 2,04,180, 8% means 16,334. So what will be the closing provision? Add both of them, sir. 2,20,514. Next year it will become opening, right? At the end of the second year again on this 2,20,514 apply 8%. 17,641. Add 2,38,155. Next 2,38,155 into 8% on this. 19,052. How much it becomes? 2 lakhs 50 207. 2,57,207 into 8%. 20,577. Add 2,77,784. 2,77,784. Final 3 lakhs balance, right? What is the difference? In the last year, because of the rounding off, no need to calculate directly. You see the difference. 22,216. Balancing figure I have taken. Even if you calculate, it will come, sir, approximately. How much came? 22,222. Some 8 rupees difference is there. That is okay. Rounding of errors will come. So that's it. That means every year how much we are unwinding? First year is this, second year is this, third year is this, fourth year is this, fifth year is this. What is the entry for unwinding up? Entry. Finance charge to provision. Finance charge to provision. Finance charge to provision. And last fifth year is also over. Now provision is how much amount? 3 lakhs. Now you pay the amount. Provision to bank. That's it. So dismantling, decommissioning cost concept you understood? So tell me what we are discussing. Elements of cost. How many elements? 3 elements. What is the first element? Purchase price. Second element? Directly attributable cost. Third element? Decommissioning, dismantling, restoration cost. It will be recognized at present value. Convert into present value and you will add. Remaining difference you need to unwind every year. That will be recognized as what? Interest. What is the entry for that? Finance charge to provision. By the end, provision will become exactly the future value and you will pay it. Hello? This concept you see. These entries will be repeated, sir. Every year same entry will come. This entry. Amount will be different. This is how initially it will be recognized. Now, one more important area, sir. One more important thing. Sir, you said cost elements. There are 3 cost elements. We understood. If you see India 16, this standard specifically says some cost you should not consider them. There are some costs which should not be included in PPE. Sir, which cost, sir? Listen to me very carefully. First, cost of opening a new facility, such as inauguration cost. Suppose you are starting a new factory. For that, some inauguration expenses, some puja expenses, some ceremony expenses are incurred. Can I capitalize that cost? The standard says no, you cannot. When you are starting any new facility, new factory, new branch, in India we have a tradition. Whenever we purchase any new item also, what we will do? Puja. We'll go to temple. Suppose we purchase a bike, we will go to temple. So we will perform puja. See, that's have been imbibed into our culture. That's our culture. We will see everything. It is given by the God only. So therefore we offer prayers to him, right? So, but standard says no. You are doing this for your sentiment, right? Please don't capitalize. You want to treat your inauguration cost as your asset. We don't allow. See this cost of opening a new facility such as inauguration cost. When you are inaugurating anything, any cost you incurred, don't capitalize. Second thing, when you are launching a new product or new service, you will incur what? Advertisement cost, promotion cost. That is also not allowed to be capitalized. Introducing any new product or service, advertising, promotion. For example, we'll see where some places, very soon restaurant is coming, very soon this business is coming, they will hoardings, so different kinds of advertisement they will give. That advertisement cost what they are incurring, we not allowed to capitalize. So opening a new product, you are launching a new product, new service, any advertisement cost, promotion cost you are incurring, we will not allow you to capitalize. Next, when you want to conduct a business in new location or with a new class of customers, for that you have given staff training cost, staff training. For example, some staff is there with you. For the staff you provide some training. So because they want to do business in new location or with a new class of customers, for that you provided training. For example, some amendments came in GST. Okay, your boss has given a training to you. Some cost is incurred. Whether that cost will be capitalized? No. The standard says no. You give training to your employees to serve the customers, new customers, or with a new class of new location, that will not allowed to be capitalized. Cost of conducting business in new location or with a new class of customers. And also admin and general overheads, any administration cost, general overheads. For example, head office rental expenses. Suppose we have taken one guest house for our suppliers. Whenever suppliers came or customers came, for them we have taken one guest house for their accommodation. Admin and general overheads cost, that will not be capitalized. And the most important thing is this one, sir. Initial operating losses when the asset is operating at a low level. Sir, when you start anything newly, will you get profits, sir? No. Initially, definitely you are going to get losses. So whether that losses is going to be capitalized, the standard says no. Suppose you started a business, you got the loss. Can I capitalize, sir? No. Initial operating losses. Even when the asset is operating at low level, that means even the asset is also not fully operational. Operating at low level. And initially you incurred some losses. When you start a business, you will get initial operating losses. Those losses we will not allow you to capitalize. And cost of relocating of employees and staff. For example, some of your employees, some of the staff who are relocated. You shifted from one place to another place. Some relocation cost is incurred. That is also not to be capitalized. So, sir, how to remember, sir? Remember the word new. Remember the word new. See this. New facility, new product, new location, new class of customers. So, can you tell me which cost we will not include as a part of PPE? First, new facility. When you are inaugurating any new office, anything newly you are doing, for that some inauguration cost you are going to incur, right? That will not be capitalized. Next, new product you are launching, advertisement cost, promotion cost, never be capitalized. Next, you given cost, new location with a new class of customers, staff training you given, cost of conducting the business. Next, admin and general overheads we will not allow. Next, initial operating losses we will not allow you to capitalize. Next one, relocation of employees and staff, for that you incur some cost. For example, transportation cost for the employees for relocating in one location to another location, that cost we will not allow you to capitalize. And the very interesting point I will tell you, these two, 7 and 8. Any incidental cost not directly related to installation. Sir, I think 8th point, 7th point, more or less the same, sir. See this. Let me first explain this point. 8th we'll see. I will ask you one question, you have to tell me. Okay. Suppose, sir, there is a land, that land there is a one old factory is there. Okay. Now in the place of this old factory, we want to construct a new factory. PP, nothing but. Okay. Now this old factory was demolished. From that some scrap generated, scrap, iron, all these things, and we sold it. We got some sale value. Now my question is, the sale of scrap of the old factory, we got a sale value of 10 lakhs. And the cost of the new factory is suppose 100 lakhs. Whether from this 100 lakhs, the cost of the new factory, whether the sale value of the scrap of the old factory will be deducted or not? Will it be deducted or not? First you understood the question, huh? There is a old factory. We want to demolish the old factory. In place of old factory, we want to construct a new factory. Old factory we demolished it, some scrap generated, that scrap we sold, we got some amount. Whether that amount is deducted from the cost of the new PPE, new factory. See, when you are going to deduct the income from the cost of the PPE, means generally cost will be added. If it is income, we will deduct it. When you are going to deduct, only if that income is directly related for the installation, acquisition, construction of this new factory. If it is directly related to it, then we will deduct it. Otherwise we don't. Here tell me, here the old factory, the new factory. The old factory we are demolishing for the purpose of the new factory only. Sir, see this. The standard says directly attributable income. Example, sale of scrap material on demolition in case of redevelopment, which is adjusted from the cost of PPE. That means in this case, this 1 lakh, 10 lakhs what we have generated, because of the sale of the scrap of the old factory, the demolition of which is required for the construction of the new factory will be adjusted from the cost of PPE. Suppose same example I will tell you, one more example I will give you. Beautiful. Suppose there is one site. This site we have given for car parking. Okay. Car parking. Right. Now in this site we want to construct a building. Want to construct a building. Now tell me, whatever the amount you are getting from the car parking, some amount you will receive, na? Will you reduce this from the building? Cost of the new building? No. Why? Is this income is directly attributable to the construction of the building? No. No way connected, na? Sir, there is a vacant land, sir. That vacant land we have given for car parking. You are generating some income by car parking, giving for car parking rental income you are getting. Whether that rental income is deducted from the building you are constructing on the site? No, because it is not directly related for the development or construction of this new PP. So here you see, not directly attributable to the asset. Example, car parking rental income recognized as normal income in the statement of P&L. So please understand, sir, when you are recognizing any PP, if there is any income, if that income is directly attributable for the newly constructing asset, deduct. Like in place of old factory, I am constructing a new factory. The old factory demolition scrap generated, the scrap I am selling, right? That is directly related to the new asset. How can you construct a new asset without demolishing old asset, sir? So that means both in case of redevelopment, the new asset construction is directly dependent upon the demolition of the old asset, right? So therefore that has to be adjusted. If it is like car parking rental income, it is no way connected, right? Not directly attributable to the new asset. So therefore it should not be capitalized. It should be treated as normal income. So bottom line is, in order to adjust the income from the cost of the new PPE, that income should be directly attributable for the newly recognizing PPE. Similarly, incidental cost not directly related to installation. Suppose you incurred some cost which is not directly related to installation. For example, see there is a site, okay, this is the old plant. Now this old plant I am giving away on exchange to somebody and I am acquiring new plant. Sir, first of all, in order to give this old plant, I need to dismantle, na? Hello. So dismantling some cost I am going to incur, right? Whether this cost of dismantling is included in the cost of the new plant. See, I am giving away my old plant to you and I am taking new plant from you. Old plant I dismantled. I given to you. I need to give it to you. For that some cost I am going to incur now. Whether that cost I am going to incur in the acquisition of new plant. No. It should not be included. Because it is incidental cost, not directly related to this new plant. Only the cost which is directly related to that particular PPE we will capitalize. Otherwise we don't. Hello. So that's it, sir. So which cost we will not include as a part of cost of PPE, sir? You understand this? So we have completed first concept. What is it? Measurement of PPE. In measurement of PPE, PPE acquired by purchase. When PPE is acquired by purchase, how many cost elements are there? 3 cost elements are there. We have discussed all the 3, and out of these 3, what is the most important one? Dismantling. That cost, that I have explained the concept also relating to that, right? Next. Okay. So we have seen the first mode of acquisition, sir, that is PPE acquired by purchase. Now next, what is the second mode? Self-constructed PPE. Now listen to this, self-constructed PPE. Basically what is self-construction means? We ourselves construct the asset. Sometimes we will purchase the asset and we will install it. Sometimes we construct our own asset, right? That is called self-construction. Sir, when an asset is constructed on our own, when PPE is constructed on our own, how we are going to decide the cost? Same manner, sir. Like when you purchase an asset, how you determine the cost? Just now we discussed 3 elements of cost we added, na? Same manner we need to do. Same principles which is applicable for PPE acquired by purchase, the same principles is applicable even for the self-constructed PPE also. When you purchase when you construct your own asset, the labor cost, the material cost, the overheads cost, okay, like any materials you purchase cost, any taxes relating to it, any discount you need to deduct, and site preparation cost, what is that, installation cost, trial run cost, whatever we discussed in PPE acquired by purchase, same provisions are applicable, sir. So that's why the cost of the self-generated asset is determined using the same principles as for a acquired asset. When you acquire any asset by purchase, what are the principles, how you are determining the cost? The same principles are applicable. But there are some special points we need to consider here, very, very important. Sir, what are the special points? See, listen to me carefully. Suppose, sir, you are constructing one asset, sir. You are constructing one building. Okay? Your organization is constructing one building. Self-construction. Okay. Now, some important points we need to remember here is, the first point, internal profits. Internal profits should be eliminated. We should not include internal profits. In determining the cost, internal profit should not be included. First of all, what is this internal profit? Internal profit means, suppose for example, this building is constructed in the organization, sir, by department A. Department A is constructing a building. There is another department in the organization, department B. This department B has supplied cement, because department B is directly engaged in cement manufacturing. So they have supplied some cement. Suppose for example 1000 bags of cement they supplied. Suppose each bag cost, for them the cost is 1000 rupees, but they supplied it 1200. So that means on each bag 200 rupees profit, right? So it was total 12 lakhs. But in this 12 lakhs, sir, what is the profit element included? 2 lakhs. Which is nothing but which profit? Internal profit, na? Because this building we are constructing is for the entire organization. Entire organization, this is the building, right? So within the organization, one department supplying to another department. And in this 1200 to 200 profit is there. So tell me, if I allow this 2 lakhs also be included as a part of asset, is it correct? No. That means you are unnecessarily overvaluing the asset, which is not correct, na? That means your balance sheet looks very strong, even though it is not strong. You appears like a strong person, but you are not strong. Are you understanding? So they don't want unnecessary, no overvaluation of asset. That's why they are saying internal profits. No. Another example I will give you. For example, department B has supplied one technical person, Mr. X, who is involved in the construction of this building, who is doing the technical services, technical work. Now he provided service for 3 months. 3 months. Each month department B charged 1 lakh rupee. 3 months means 3 lakhs. But in this 3 lakhs, the cost is only 2.5 lakhs. Remaining 50,000 they have added extra profit. So that means when you are determining the cost of the building, will you add 3 lakhs or will you add only 2.5 lakhs? 2.5 lakhs. Because that 50,000 is what? Internal profit. Within the organization, this is the profit, na? Don't include it. So when you are determining the cost of self-constructed PPE, the first point you need to remember is what? Internal profit should be eliminated. Don't include it. Hope you understand this concept. Hello, respond here. First point. Second point, sir. Another super point, abnormal wastage. Any abnormal wastage, or we can call it as abnormal loss, don't include it. See, there are two types of losses when it comes to inventory, labor, material, labor, overheads. There are two types of losses, right? What are those? Normal, abnormal, right? Abnormal. Standard says normal loss, okay, we cannot avoid it, so it can be included, but abnormal loss we don't allow. So if there is any abnormal loss relating to material, labor, overheads, that loss we should not include in the self-constructed PPE. For example, labor, every day 2 hours break, normal loss. They have taken 3 hours, that means 1 hour extra they are taking, na? But for that 1 hour we are paying what? Salary. So that 1 hour is what? Abnormal loss. So can I include that 1 hour salary? No. Abnormal loss of material, labor. Because the intention of the standard is, if it is allowed, na, what happens? Tell me. If it is allowed, what happens? Simple. Your weaknesses will become your strength. Abnormal wastage is what? Abnormal wastage of labor is what, sir? Your weakness, na? But you want to include in the asset value. That means you want to show it as my strength. How can your weakness will become your strength? For example, material wastage. Suppose in this construction you are using materials, sand, iron, bricks you are using, na? Normal wastage is 5%, but you wasted 10%. That means that extra 5% you are wasting. Whether that waste also included in the construction PPE value? No. No. How can your wastage will be your asset? Hello. Are you understanding, sir? Abnormal wastage. So please understand, sir, throughout any standard you take, whether it is inventory, whether it is this or whether it is any other standard relating to assets, abnormal wastage never be capitalized. Abnormal wastage never be capitalized. So this is the second principle you remember. Abnormal waste excluded from the cost. Don't include it. Next, borrowing cost is capitalized subject to Ind AS 23. See, there is third point, sir, which says borrowing cost, BC. Borrowing cost. Borrowing cost will be capitalized provided Ind AS 23 conditions are satisfied. In our syllabus, we have Ind AS 23 also. Say this, borrowing cost. So, when you take any borrowings from banks and those borrowed funds you are using for this asset construction, whether interest generated on the borrowings will be capitalized or not, subject to Ind AS 23. So if Ind AS 23 allowed, we will capitalize, otherwise we don't capitalize. So this point also you need to remember. That's why here I have given borrowing cost capitalized subject to Ind AS 23. So three important points, sir. So can you tell me the special points in respect of self-constructed PPE? First of all, how to determine the cost of self-constructed PPE? Same manner, like how a PPE acquired by purchase, same manner you determine. And there are some special points you need to take attention. What are those? First, any internal profits eliminate. Second, abnormal wastage of either material, labor or overheads, whatever, abnormal wastage never be capitalized because your weakness cannot be shown as a strength asset. Next, borrowing cost. Borrowing cost will be capitalized subject to provisions of Ind AS 23. Now one more point, sir, bearer plant. Sir, the standard says, bearer plant, whether the standard is applicable or not. Today we discussed bearer plant, the standard is applicable. And we have discussed when a plant can be called as bearer plant also. Now the standard says bearer plant is treated like a self-acquired PPE. The cost of bearer plant will be determined just like a self-constructed PPE. Self-constructed PPE. We are discussing that self-constructed PPE. Na? Suppose when you construct your own asset, how you are going to determine the cost? The same principles is applicable in case of bearer plant. So all these points, whatever we have discussed so far, these are all applicable to bearer plant also. Because bearer plant is accounted like a self-constructed PPE till ready for use. They may ask this as an MCQ. So if there is any bearer plant is there, it is just like a self-constructed PPE. Like how you construct your own asset. Because see, it's a plant, sir. Bearer plant means mango tree. I told you, mango tree, coconut tree, all these things. Definitely we need to take care of it. We need to grow it, right? So just like a self-constructed asset. When you construct your own building, same manner bearer plant. That plant you need to take care and you need to grow it, you need to look after it, right? So you have to do it. So that's why the standard says bearer plant is like a self-constructed PPE. You need to treat it like a self-constructed PPE and cost will be determined accordingly. So this is the second mode of acquisition. You understand that? Two we completed, sir. What is the first one we completed? PPE acquired by purchase, done na? Second, self-constructed. Next, only two things are there. Next I am going to discuss PPE acquired by exchange. Very interesting topic, listen to me. PPE acquired by exchange. Sir, first of all, what is exchange, sir? I will give one asset, I will take another asset from you. That is called basically exchange. Suppose, sir, there is a company A Limited, there is a company B Limited. Now this A Limited is having one machinery, sir. Let's call this as old plant and machinery. B Limited is having one plant and machinery, sir. Let's call this as new plant and machinery. See, A Limited is taking this new plant and machinery, giving their old plant and machinery. Sir, this is unfair, sir. B Limited is giving new plant and machinery, but you are giving only Old plant and machinery, how can they accept? Of course, some cash also will be involved. We will give some cash also. So that means here, tell me A Limited is exchanging what? Old plant and machinery, cash. What they are taking? This new plant and machinery, now we need to recognize in A Limited books. Sir, you should not forget what we are discussing. We are discussing measurement concept. That too, which measurement? Initial measurement. First time when you acquired an asset, you need to recognize at what value? Cost. Now we are discussing the concept of how to determine the cost in different cases. So here in this case, tell me A Limited point of view, think. A Limited point of view, what is the asset they are getting? New plant and machinery. So this is the newly acquired PP, right? And how they are acquiring this? Exchange. What they are exchanging? Old plant and machinery as well as cash. Now this new plant and machinery, at what value they will write in the books? Cost. How to determine the cost? That is what the standard says. Hey, you are telling the principles, tell me. I have not told, na? Just you are using your common sense. Please, when you are learning Indian accounting standard, please don't use your common sense. I am telling you, you will be in trouble. You are learning principles. What is there in the Indians, you need to learn. Of course, sir, it makes sensible for me. I am feeling so emotional. So according to me, this is correct. When you become old, you write your autobiography, right? In that autobiography, you put a separate chapter. Me and my Indian accounting standards. There you write all these things. Whatever you feel emotionally, all these things. According to me, India 16 should not be like this. It should be like this. I feel so sorry. You write it in your autobiography. But as of now, what our institute gave, what government has given us, we will try to learn it. Okay, please. See, whenever any PP acquired by exchange, the standard says you need to see one important thing, that is commercial substance. What is that? Commercial substance. Whether that exchange transaction had commercial substance or not. Guys, please focus. Whether that exchange transaction has commercial substance has not. You need to see whether there is a commercial substance or not. Now, answer could be yes, there is a commercial substance. No, there is a commercial substance. There is no commercial substance. So first of all, what is this commercial substance? Very simple. Commercial substance means the cash flows. The cash flows. Amount, risk, timing. Three things. Amount, risk, timing of cash flows. Because of this exchange, whether they are affecting or not. Whether because of this exchange, the cash flows of our organization, the amount of cash flows, the risk, the timings are affected or not. Yes, affected. There is a commercial substance. No, not affected. No commercial substance. Let me give you one simple example. In this case, tell me what we are taking. New plant and machinery. What we are giving? Tell me when you compare old versus new. Repairs. Which plant and machinery will have more repair cost? Old. Which plant and machinery will incur more maintenance cost? Old. Which will give you more output? New. That means tell me, because of this exchange, your cash flows are affected or not? Yes. Because you are getting now new plant and machinery. So your repair cost will reduce, your maintenance cost will reduce, your output will increase, so that your incomes will increase. So there is a commercial substance. So because of this new PP, what you are getting, definitely there will be effect on your cash flows. Let me give you one simple example, sir. Another example I will give you. So you are having one Oppo mobile. I am having one Apple mobile. I have given Apple mobile to you and taken Oppo mobile from you. Tell me, what is my experience? Whether I am going to experience great or whether I feel, say this is not good. See, when I am using Apple mobile, obviously my experience is different. Now I am using Oppo mobile, definitely my experience will be entirely different. That means there is a commercial substance here. I am not feeling the same way. Just for example sake I am telling. Similarly, when you exchange your assets, because of this exchange, your organization cash flows are affecting or not? Affecting, sir. Commercial substance is there. Sir, not affected, sir. For example, you see, I am giving old plant and machinery. I am taking also old plant and machinery. Both are equally same. There is no much difference. That means my cash flows are not getting affected. For example, I am having one Dell mobile, sir. Dell laptop I have. You have HP laptop. I given my Dell, I taken HP laptop. Both are 5 years old. There is much difference. There is no much difference. Tell me, is there any way I am going to affect, my cash flows is going to affect? No. 5 years old, 5 years old. Experience wise also same. Both Dell, HP, more or less the same. So therefore, there is no commercial substance. You understand what is commercial substance? Simple. Say, bottom line is, commercial substance means, for your understanding I am telling, if you are exchanging the same assets, homogeneous, same assets, there is no commercial substance. If you are exchanging different, heterogeneous assets, definitely there is a capability that they are going to affect the cash flows. So, because of this exchange, your cash flows are getting affected or not, you need to see. So that's why I given here, see this. What is, when we say a transaction has commercial substance, cash flows are different. The risk, the timing, the amount of cash flows from the asset you are receiving is not the same as the asset you are giving up. Asset you are giving up, asset you are receiving. The cash flows of both of them is different. Amount wise, risk wise, timing wise, they are different. In what matters? Cash flows. For example, sir, let me give you one more example. I am having one truck. This, our A Limited is having one truck. This is an old truck. Now I am taking a new truck from you in exchange. I am giving away this this old truck I am giving away. I am taking a new truck. This new truck is with the latest features, the GPS, everything is perfect, top notch. Now you see, whether there is a commercial substance, yes. Why? Because the old truck, frequent repairs, okay, we don't know when it is going to stop, huge maintenance cost. Every day it is like drinks, it is drinking petrol, diesel. But the new truck, cost friendly, environment friendly, less maintenance cost, lot of things are there. So therefore there is a commercial substance. So the standard says, when you are acquiring any PPE by exchange, you need to see whether there is a commercial substance or not. Yes sir, there is a commercial substance. Then the standard says, then important, when there is a commercial substance, the standard says, okay, the cost of acquired PPE, the PPE which you are getting now, the cost is first, simple, fair value. What is it? Fair value of asset given up. Whatever the asset you are giving up now, you are giving up, that asset fair value is the cost of the newly acquired PPE. So therefore here in this case, the old plant and machinery fair value is there now. That is the cost of the new plant and machinery we are acquiring. This is the first priority we need to give. What is the first priority we need to give? When there is a commercial substance, the newly acquired PPE cost is what? Fair value of asset given up. Suppose this is not available, sir, then the standard says fair value of asset received. Second option, fair value of asset received is the second priority. First, fair value of the asset given up, you take it if it is available. If it is not available, fair value of the asset received. Okay, sir, this is also not available, sir. Simple, WDV of asset given up. WDV or carrying amount of the asset given up. Here old plant and machinery is there now with us. That old plant and machinery book value, carrying amount or WDV, take it. That is readily available from our books. So this is the priority, sir. First you asset given up fair value available. If it is not available, asset received fair value. If that is also not available, WDV of the asset given up. See this. If the transaction has commercial substance, the following order of preference will be followed. First, fair value of the asset given up. Not available, fair value of the asset received. That is not available, WD of the asset given up. Sir, suppose there is no commercial substance, sir, in the exchange transaction. Then simple. WDV of asset given up. Whatever the asset you are giving up now, that asset WDV, also known as carrying amount. WDV carrying amount both are same. Nothing but book value. Whatever the asset you are giving up, that asset book value will be the cost of newly acquired PPE. Hey, don't forget what we are discussing. We are discussing what? Measurement of PPE, initial measurement at the time of exchange of asset. When you exchange, you are getting one asset now, one PPE now. That PPE cost we are deciding. How to determine? If there is a commercial substance, the newly acquired cost of PPE is what is how much? Fair value of the asset given up. If that is not available, fair value of the asset received. That is also not available, WD of the asset given up. Suppose if there is no commercial substance, WD of the asset given up. Simply take the WDV or carrying amount of the asset given up, you take it. Correct? See this. Recognize the PP acquired at the WDV of the asset given up. So there is a commercial substance, there is no commercial substance. Very simple now. Exchange of assets. Hello? Come to this example. Everybody see this example. PQR Limited exchange old mission for new mission on 1st April 2025. What is the carrying amount of the old mission? 4,20,000. What is the fair value of the old mission? 4,80,000. Fair value of the new mission? 5 lakhs. Cash paid by PQR Limited 20. Sir, what is fair value? Fair value is nothing but if this asset right now, if I can able to sell it in the market, how much it is going to give me? That is called fair value. Knowledgeable buyer, knowledgeable seller. In perfect market condition, at what price they are going to commit to buy or sell this asset? That is called fair value. Okay. Now you tell me, here we are getting what? PQR Limited is getting what? New mission. We are exchanging what? Old mission and also cash. Cash 20,000, old mission also we are giving away. Okay. Now you see here, whenever you exchange the mission, any asset, na sir, try to find out the profit or loss, I mean gain or loss on exchange. So let us discuss the gain on exchange. What is the gain on exchange, sir, here? What is the carrying amount of the old mission? 4,20,000. What is the fair value? 4,80,000. So see, I am taking new mission, I am giving old mission. And here there is a commercial substance, is there or not? There is a commercial substance. First you need to see this. Commercial substance is there or not? Yes, it is there. Unless otherwise provided, generally commercial substance is there. Commercial substance is there. When there is a commercial substance, what I told? What is the value at which newly acquired PPE will be recognized? Fair value of the asset given up. What is the asset we have given up? Old mission. What is the fair value? This 4,80,000 will become what? Cost of the new mission plus the cash we paid. If you pay any cash, that cash paid also will be included. So therefore here, say this, new mission account debit, the fair value of old mission given up plus cash paid. Two things we need to add here, correct? What is the fair value of the old mission? 4,80,000. Cash paid 20. Total? 5 lakhs. 5 lakhs we need to take. Okay? So to cash, how much cash we are paying? 20,000 cash we are paying. 20,000 cash we have paid. Overall what we got, sir? Gain or loss? We'll see. See, tell me, this new mission, old mission we have given for what value? 4,80,000. What is the book value? 4,20,000. How much is the gain? 60,000 gain. Correct? Sir, my asset value 4,20,000, sir, but I have given for you at 4,80,000. That means 60,000 is my gain on exchange. Right? So therefore here I will write to old mission. In my books, old mission book value is how much? 4,20,000. And gain on exchange? 60,000. Gain on exchange 60. This gain on exchange will go to P&L account. That's it. So the entry is new mission account debit to cash to old mission to gain on exchange. New mission is recognized at fair value plus cash paid. This is cash paid. This is old mission at carrying value. WDV nothing but. This is balancing figure, gain on exchange. How I got gain on exchange? Simple, sir. The asset I had value is 4,20,000, but I valued it for 4,80,000. 4,80,000. Hello? So this is how you need to do the transaction, sir. I mean, do the accounting in case of PP acquired by exchange of assets. You understand this? And the last one, sir. 4 cases I told, na, sir. 1 PP acquired by purchase we discuss. Second, self-constructed we discuss. Next, tell me exchange conclusion. Tell me, whenever you acquired any asset by exchange, first what you see? Commercial substance there or not there? When we say there is a commercial substance, amount, risk, timing of cash flows must be affected. Hello? One more point is also there, sir. I forgot to tell. I think this one, yeah. Value of business changes because of this exchange. Because of exchange, sir, the overall value of the business must change. That means when you are exchanging the same type of assets, there is no effect on cash flows or there is no effect on your business. So therefore, there is no commercial substance. When your business got affected or when your cash flows got affected, definitely there is a commercial substance. Tell me, when there is a commercial substance, what is the order I need to follow to recognize the newly acquired PP? Fair value of the asset given up. If not available, asset received. If it is, that is also not available, WDV of the asset given up. Second case, if there is no commercial substance, WDV of the asset given up. So last, the PP acquired on deferred payment terms. Sir, what is this deferred payment terms? Very simple, sir. What is this deferred payment terms means? See, suppose, sir, there is T Limited. Okay, there is a supplier S Limited. See, they are purchasing a plant and machinery. Okay, the credit period, normally the credit period given by S Limited is 3 months. Normally credit period is 3 months. But T Limited made a special request and we want 9 months credit period. We want 9 months credit period they have taken. This is called PP acquired by deferred credit terms. That means beyond the normal credit terms. Beyond the normal credit terms. Normal credit terms 3, but this time 9. Now tell me, when supplier given you 9 months, definitely is going to charge extra amount, right? So suppose for example the cash price, if you purchase directly by cash today, suppose 10 lakhs. In case of normal credit period, 3 months time, 10 lakhs you need to pay. Suppose since they have given you some extra time, they have added another 2 lakhs. That means 12 lakhs is the what price you are paying. But the standard says when you acquired any PPE beyond the normal credit terms, you need to recognize PPE at a price which is equivalent to only cash price. That means PPE will be recognized only at 10 lakhs. Don't recognize at 12 lakhs. This 2 lakhs will be treated as what? Interest cost. This 2 lakhs will be treated as interest cost. Just like in case of provision for dismantling, decommissioning, we created a present value. Every year we unwind the cost. Na? What is the entry we have written? Finance charges to provision. Same manner here the difference will be treated as finance charge and transferred to P&L account. So simple point, when you acquired any PPE by beyond normal credit terms, you need to recognize PPE only by price which is equivalent to cash price. Any difference between the cash price and the amount you are paying is treated as interest cost, and that is transferred to P&L account. Otherwise what happens, sir? Everybody will take special terms because they can recognize asset at more value. Na? I will ask the supplier, hey supplier, give me 90 months instead of 9 months. He says, okay, asset value 50 lakhs. Then I can recognize the asset at 50 lakhs if this provision is not there. But originally that asset cost is how much? 10 lakhs. This is one kind of fraud, na? In balance sheet, your asset original value 10 lakhs. Of course, you are showing at 50 lakhs. Of course, it is not allowed because there is one standard called impairment of assets. One standard is there, impairment loss. But anyways, say this. PP acquired on deferred payment terms, sir. If payment is deferred beyond normal credit terms, see this, beyond normal credit terms, then the cost of PP will be what? Cash price equivalent at recognition date. On the recognition date, what is the cash price equivalent? You need to find out. Sir, 12 lakhs is the cash price, huh? Here the cash price is how much? 10 lakhs. Cash price means right now if I purchase, how much I need to pay? That is called cash price. That I need to take. What about the difference? The difference between the cash price at recognition date and the total payment you are paying is recognized as interest over the credit period. So guys, they may ask a question relating to it. So whenever, tell me, you enjoyed any special credit terms? Can you recognize the PP value at the total payment you make to the supplier, or will you recognize at cash price? Cash price equivalent on which date? Recognition date. On the date you are recognizing the PP. That's it, sir. So therefore, I think we have completed all the initial measurement concept. We have completed, sir. Hello. So can you recollect for me for within 2 minutes time? Come on. Today what we have discussed in India study, India 16 relating to measurement. Initially PP will be recognized at cost. The determination of cost depends on mode of acquisition. What is the first mode? Purchase. In purchase, what are the cost elements? What are those? Purchase price. Purchase price. For that, what are the adjustments? Add direct, duties and taxes. That too non-refundable. Less trade discounts, rebates. Next, what is the second cost element? Directly attributable cost incurred to bring the PP to its present location and condition as intended by management. What included here? Employee benefit cost if they are involved in the installation, construction, I told you. Second, site preparation cost, initial delivery, handling cost, trial run cost, net of the sample sale proceeds. Okay, installation, assembly cost, all these cost, professional fees we will include. What is the third category? Decommissioning, restoration cost. At what value? Present value. Remaining difference we will unfold as a interest. Correct? And then self-constructed PP, how cost will be determined? Same manner as acquired PP. But what are the special points? 3. First, internal profit should be eliminated. Second, abnormal wastage should be excluded. We should not consider it. Third, borrowing cost. Borrowing cost will be included subject to Ind AS 23. Borrowing cost. Next, if it is a bearer plant, we need to treat it as what? Just like a self-constructed PPE. Okay? And then exchange of asset. PPE acquired by exchange of asset, what will you see? Commercial substance there or not? If there is a commercial substance, fair value of asset given up. First priority. Not available? Fair value of asset received. Not available? Liability of the asset given. If there is no commercial substance, liability of the asset given up. Okay? Next, if PPE acquired by beyond the normal credit terms, recognize the PP on recognition date at cash price equivalent. The difference between the cash price equivalent and the amount you are paying is treated as interest. That's it, sir. Okay. So we are discussing Ind AS 16, sir. I think in the last session relating to Ind AS 16, what we have discussed, let us revise first. Definition of PPE, then objective, scope of the standard, then initial recognition principle, then initial measurement. I think till initial measurement concept we have discussed. First, what is PPE, sir? Two conditions. PPEs are tangible items held for use in the production or supply of goods or services, rental to others, or administrative purposes, and which are expected to be used for more than one period. And spare parts, service equipment, standby equipment, if they satisfy the definition of PPE, then Ind AS 16, otherwise Ind AS 2 inventories we will apply. Then objective of Ind AS 16, the main object is to provide the accounting treatment for PPE, and also how much we have made investment in PPE, what changes happened in that investment, and also all the key principles relating to PPE accounting treatment is covered under Ind AS 16. Then scope of the standard. This standard does not cover any PPE which is held for sale, biological assets relating to agriculture activity other than bearer plant. The standard is not applicable, and also that any expenditure on the exploration, evaluation of minerals, mines, and also any mineral rights, extraction of natural gas, oil, for them the standard is not applicable. And if you remember, biological assets also we have discussed. What is biological asset? Biological asset means living animals and plants. The standard is applicable for what? The standard is applicable for bearer plant. When a plant is called bearer plant, three conditions. It is expected to, it is giving agriculture produce. It is expected to give produce for more than one period, 12 months. And there is a remote likelihood of being sold as agriculture produce, except for incidental scrap sales. Okay. So mango tree, coconut tree, all these are bearer plants, and they are PPs, and the standard will be applied. Scope of the standard we have discussed. Then we have discussed what is that? Recognition. First time when you want to recognize PPE, two conditions must be satisfied. Probable future economic benefits must flow to the enterprise, and cost is measured reliably. If these two conditions are satisfied, then PPE can be recognized in the books. Then we have discussed about measurement. In measurement, initial measurement, subsequent measurement. Initial measurement means first time when you want to recognize PPE in the books, at what value you recognize? Cost. Always at cost. Then how to determine the cost? The determination of cost depends upon the mode of acquisition. In that four modes, one PPE is purchased by PPE is purchased, second self-construction, exchange, and PPE acquired by deferred payment terms, deferred credit terms. So suppose when you acquire PPE, the cost, how to determine the cost? There are three elements in cost. One is purchase price, add any duties and taxes non-refundable, less any trade discounts or rebate given by the supplier. Second, directly attributable cost, to bring the PPE to its location and condition necessary for it to be capable of operating in the manner intended by management. Like for example, initial delivery, handling, installation, site preparation, trial run, net of sampling proceeds, all these things we will take in directly attributable cost. Next, third one, dismantling, decommissioning, restoration cost. That at what value? Present value. So that present value of the future cost we will create a provision, and every year we will unwind the remaining balance by writing an entry, finance charges account debit to provision, right? That one example also I have solved. And next, self construction. How which cost we will not include as a part of PPE? There are certain costs we will not include it. Like for example, when you are launching a new product, any advertisement cost, promotion cost, when you want to do business, cost of conducting business in new location or with a new class of customers, or initial operating losses. Okay, all these cannot be considered as cost. We will not include them as a part of cost of PPE. And next we have discussed self construction. How the cost of self constructed PPE is determined? Same like acquired PPE, but three important points I told. First, internal profits will be eliminated, abnormal wastage we will not consider, borrowing cost will be capitalized subject to the Ind AS. separate Ind AS is there na, relating to borrowing cost, that Ind AS. And also one more point I told that bearer plant is treated like a self-constructed PPE. Okay, this point also we covered. Next, exchange of assets. If PP is acquired by exchange of assets, I told we need to see the commercial substance. There is a commercial substance, there is no commercial substance. If there is a commercial substance, then fair value of the asset given up first priority, fair value of the asset received, or WTV of the asset given up. So this is the order we need to follow. If there is no commercial substance, then fair value of the WTV of the asset given up. And we also discussed the last one, if PP is acquired by beyond normal credit terms. So when you acquire any PP beyond the normal credit terms, you need to recognize the PPE at the recognition date at a price which is equivalent to cash price. So the difference between the cash price and the amount you are actually paid to the supplier, the difference will be treated as interest. So I think we have completed till the measurement concept, that to initial measurement. Okay. Now let us next topic let us discuss, sir. Now the important concepts now will coming, sir. Next concept is what, sir? Depreciation of property, plant, equipment. Depreciation of property, plant, equipment, sir. Let us talk about depreciation. First of all, can you tell me what is depreciation? Depreciation means loss in value of asset. PP is basically tangible asset, right? Any tangible asset, it loses its value over the period of time. So if you take PP, the value will be lost every year because of time, because of usage, etc. When you are using the asset, it will lose its value. When the time expires, it loses its value. Every asset will have only limited life, right? So definitely asset will lose some of its value every year. So you need to estimate how much amount of loss the asset lost every year. That is technically called depreciation. So depreciation is basically estimated loss. Sir, how to calculate depreciation, sir? See, in order to calculate the depreciation of PPE, you require cost of PPE. You require cost. What is the cost of PPE? You require residual value. You require residual value. You require useful life. These are the three factors which is required for calculation of depreciation. See, first, whenever you want to calculate depreciation of PPE, first you need to calculate depreciable amount. What is that? Depreciable amount. How to find out depreciable amount? Simple. Cost of the asset minus residual value. You will get the cost of the depreciable amount. Cost minus residual value. And once you know the depreciable amount, then you can calculate depreciation. Depreciation is equal to depreciable amount divided by useful life. So that means what is depreciation? Simple. Depreciable amount is allocated over the useful life. That is called depreciation. For example, cost of the asset is 10 lakhs. Residual value 1 lakh. So depreciable amount 9 lakhs. Life, for example, 5 years. So 9 lakhs divided by 5. So what is the depreciation per annum? 9 lakhs divided by 5. 1,80,000. Correct? Every year depreciation 1,80,000. Like that 1,80,000, 1,80,000, 1,80,000, 1,80,000. So basically this method is called which method? Straight line method. because in straight line method there is a constant charge over every year. Every year we are going to provide the fixed depreciation. Of course, there is one more method called WDV method, where we will provide depreciation on the WDV value, not on the original cost. Okay, sir, which method of depreciation we are going to select? We will discuss it. The method of depreciation we are going to discuss it, but let us discuss the basics of depreciation. So basically understand, depreciation is what? This is the estimated loss of an asset. Every physical asset will have a limited life, so therefore asset is losing its value every year. So that loss you need to calculate. That is technically called depreciation. Okay, so because of depreciation, what happening, sir? Asset is losing its value. Asset is losing its value. Okay, to calculate depreciation, what are the things required? Tell me. Cost of the asset required. Second, residual value. Third, useful life. Cost, we have understood how to determine the cost. Residual value means once the life is over, if this asset is sold, how much amount I am going to get? Kind of a scrap value, residual value. Because that amount is going to be recovered, right? So from the cost, that amount will be deducted. Only remaining balance is my loss. But that loss I cannot recognize in the first year itself. That's why divided by number of years. So see this. What is depreciation here? Depreciation is systematic allocation of depreciable amount of an asset over its useful life. What is depreciable amount? Cost minus residual value. Cost of the asset minus residual value will get depreciable amount. Residual value means estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal. For example, I purchased one asset, sir. The life is 5 years. Okay. After 5 years, suppose I purchased a car. After 5 years, if I sell this car, I am estimating I am going to get 1 lakh rupee. But in order to make the sale, I must incur some cost, right? Some selling expenses I need to incur. So suppose I am expecting 20,000 cost I am going to incur to sell this asset. So what is my residual value? 80,000 I need to consider. So residual value is nothing but estimated sale value of the asset once the life is over minus estimated cost of disposal. So for the purpose of sale, what are the costs we are going to incur? We need to deduct it. Next, what is useful life? Number of years the asset is expected to be available for use. The period over which an asset is expected to be available for use by the entity. Sometimes the life of the asset is measured by the number of units we produce. See, suppose this building is there. What is the life of this building? 20 years. Suppose there is a plant and machinery. What is the life of plant and machinery? 5 years. Or we can say that plant and machinery will give you 1 lakh units. So sometimes the life can be measured by number of units also. So either the number of years the asset is expected to be available for use, or the number of production units which is expected to be obtained from the use of the asset. Okay. Now the most important points now coming. Tell me, from which date onwards you are going to start providing the depreciation? Commencement of depreciation. When you are going to commence the depreciation? Suppose you purchased a plant and machinery. Okay, you purchased a plant and machinery, sir. Plant and machinery ready for use on 1st July 2025. The asset is ready, but actual date of use is 1st September 2025. Okay, asset is ready for use on 1st July, and what date onward you started using it? 1st September, right? So tell me, from which date onwards you will provide depreciation? When the asset is ready, or when the asset is actually started using for production? Ready for use. Always remember, The starting point for providing depreciation is the asset is ready for use, not the date actually you started utilizing. So therefore here asset is ready for use on 1st July. So you need to provide depreciation from 1st July onwards. Need not wait till the actual date of use. Okay. So commencement of depreciation. So when you are going to commence providing depreciation, sir? When the asset is available for use. That is when it is in the location and condition necessary for it to be capable of operating in the manner intended by management. Sir, when you are going to stop providing depreciation, superb, listen, important. So we understood when we are going to start providing depreciation, the date the asset is ready for use, not the actual date of use. Now when you are going to stop providing depreciation, tell me, think and tell me, come on, what's your answer? When you are going to stop providing the depreciation? When it is sold. Okay. When the asset is sold, it is no more available with us, so we will start providing depreciation. Any other answer? Useful life completed. Sir, by the time useful life is over, entire asset will be depreciated. So there is nothing to depreciate. Any other answer? When you are going to stop providing the depreciation? Business closed. Okay. Sir, the standard says they are telling two things. Whichever comes earlier, that is the point you need to stop providing the depreciation. Whichever is earlier. Important, sir. See this, depreciation of an asset ceases at the earlier of, see this, earlier, whichever comes earlier. What is that earlier point? Simple, listen. First, when the PPE retired and held for sale. PPE is held for sale. PPE what? Held for sale. Or PPE derecognized. Whichever comes earlier. PPE held for sale, PPE derecognized, whichever comes earlier, that is the point I need to stop providing the depreciation. Sir, what is PPE held for sale? For example, I will tell you, listen. Suppose, sir, there is a plant and machinery, sir. Okay. We are not using this plant and machinery. Not use. We kept it idle. Suppose on 1st July 2025 onwards, it is idle, this plant and machinery. Tell me, will you provide depreciation or not? Will you continue the depreciation or not? Because this asset is idle, we are not using. Simply putting the asset idle, you cannot stop providing depreciation. You have to continue the depreciation. The standard says when you are going to stop only when the asset is held for sale or the asset is derecognized. Any one of these two things should happen, whichever earlier. For example, here the asset is kept idle, but it is not held for sale. It is not yet held for sale. It is just held idle. Suppose, for example, it is idle. See, there is a difference between the asset kept idle and the asset we want to sell it. There is a difference or not? For example, I purchased a new mobile. Old mobile is there with me. See, that means old mobile I kept idle. I don't have the intention to sell this old mobile to anybody. As of now, I am not using it. Similarly, this plant and machinery organization kept it idle. Right now they are not using it, but they are not held it for sale. Then you should continue providing the depreciation. So that's why the standard says just because the asset is idle, you cannot stop providing depreciation. That asset must be held for sale. So you must held it for sale. If you want, you decided that you need to sell it as a scrap, or the PP is derecognized. Derecognized means actually sold. When the asset is actually sold, or when the asset is no longer generating future economic benefits, you will remove it from the books. Na? See, I told you recognition criteria. When PP will be recognized? Two conditions. What is the first condition? Probable future economic benefits. When the asset is no longer giving probable future economic benefits, it has to be derecognized. Or when you sell the asset, automatically asset will be derecognized from the books. So either the asset must be derecognized from the books, or the asset must be held for sale. Just because the asset is idle, you cannot stop providing the depreciation. You have to continue providing the depreciation. You understanding, guys? See here. Here the standard says, see this. Depreciation of an asset ceases at the earlier of the date the asset is classified as held for sale. See this. PPE held for sale as per Ind AS 105, we are going to discuss it. And the date the asset is derecognized. What is the difference between these two? Derecognition means removing the asset from the books. When you are going to derecognize? When you sell the asset, or when the asset is no longer generating future economic benefits. Hello? Derecognize. Or for example, asset is there, life is there, it is giving, it must give, it is giving benefits also. It is just that you kept it idle and you want to sell it. Then that's the first one. Just kept idle, you continue the depreciation. Kept idle doesn't mean that you held it for sale. Are you understanding the trick here? That's why I have given a note also. Therefore, you see, depreciation does not cease when the asset becomes idle or retired from the active use, but not held for disposal unless the asset is fully depreciated. That means you just simply because not using the asset doesn't mean that you stop providing depreciation. Okay, so asset is kept idle and held for sale. That is the trigger point. You need to stop providing depreciation. So tell me, when you are going to commence the depreciation? When the asset is ready for user, actual user, ready for use. Next, when you are going to stop? Whichever earlier. Two things, whichever earlier. What is the first one? Held for sale. Just because you kept idle, it is not held for sale. Second, when the PP is derecognized. Whichever comes earlier. Next, depreciation method, important. Sir, okay, you said every PPE will have a limited life. So by the time the asset loses, completing its life, definitely it is going to lose its value. Suppose when I said the asset life is 10 years, that means what? Over the next 10 years it becomes zero, right? That's why I am estimating and calculating every year depreciation. Which method I need to follow to provide depreciation? Depreciation is basically what? Loss. Basically what? Loss. Which loss? Estimated loss. Hello? Hello? This is estimated loss. This is not actual loss. This is estimated. Why we are calling it as estimated loss? Because here useful life is an estimation, right? Suppose this plant and machinery life is 10 years, I said. That is what? Estimation. Based on the facts available, information available, I am saying it. It can be more than 10 years also it may come. Or it may come less than 10 years also. We don't know. For example, this building life 20 years, I said. Maybe it can be more than 20. Can be less than 20. Correct? We don't know. So these are estimations. Residual value is also estimation. So this many estimations are involved. That's why depreciation is also what? Estimated loss. Estimated loss. Okay. When you are estimating the loss, which method you follow? Which method you follow? See, actually speaking, Ind AS 16, if you see, it is not prescribing any method. It only saying that depreciation amount you want to provide, right? This depreciation amount should be reflecting the pattern of future economic benefits. of the asset. From that particular asset in respect of which you are providing depreciation, what is the pattern in which the future economic benefits are consumed by the entity? Our depreciation amount should reflect that. That means if the asset is constantly giving same benefits, follow straight line method. Because when you are getting same benefits every year, depreciation should also be same. When the asset is giving gradually decreasing benefits, you follow WDV method, because in WDV method initially depreciation is high, gradually it will decrease. So therefore the standard says which method I need to follow, sir. That depends upon the pattern in which the future economic benefits are consumed by the entity from that particular PPE. Depreciation should reflect that. Suppose I am unable to establish any pattern, sir, the safest method is what? Straight line method. Or if you feel any other method is appropriate, you can follow that. Absolutely, there is no restriction. For example, I am getting future economic benefit from particular plant and machinery. Suppose every year I am expecting 10 lakhs, 10 lakhs, 10 lakh future economic benefits. Maybe depreciation could be every year 2 lakhs, 2 lakhs, 2 lakhs. That means the depreciation is reflecting the pattern. You see, here benefits are constantly same, depreciation should also be same. That means your loss should reflect the benefit. Your loss should reflect the benefit. That's how depreciation will be provided. See, depreciation is not something unscientific. They are saying that when you want to provide depreciation of any asset, you need to observe the pattern in which the future economic benefits are going to be consumed by the entity from that particular asset. Accordingly, you need to provide the depreciation. Actually, straight line method, WDV method, there are no such methods. Common sense. Straight line method means what? Every year same depreciation. Why? Benefits also same. Every year same depreciation means same, same benefit means same depreciation. Same amount should be there as a depreciation. Hello? So, see this. This is the first point I told. Very, very important. What is the principle here? Depreciation method shall reflect what? The pattern in which the assets future economic benefits are expected to be consumed by the entity. Recently in YouTube, in my channel, I have done one video. Patterns to break the failures. Pattern means what? When you are repeating the same behavior again and again, that becomes your pattern. Here also, how much depreciation I need to provide, that depends upon how that particular asset is generating the benefits. Constantly same benefits are, decreasing benefit are, increasing benefit are, accordingly you need to provide the depreciation. Okay, so based on this principle, what are the possible methods? It can be straight line method. In straight line method, what happens, sir? Every year same depreciation, correct? Constant charge over the useful life. In case of WDV method, sir, decreasing charge over the useful life. That means every year depreciation will decrease in WDV. Have you observed that? Sir, for example, plant and machinery there, sir, cost 10 lakhs, sir. Okay, I am providing depreciation under WDV method, sir. Suppose depreciation is 10%, sir. 10%. That means first year depreciation 1 lakh, sir. What is the WDV? 9 lakhs. Now second year depreciation I need to provide now at 10% on what? 9 lakhs. That means how much? 90,000. That means 8 lakhs, 10,000. That means first year depreciation 1 lakh. Second year depreciation decreasing na. Third year 81,000 will come. Hello? Because 8 lakh 10,000 into 10%. That means depreciation, what is happening to depreciation? Decreasing. This is called WDV method. Decreasing charge. Or units of production method. See, sometimes you provide depreciation based on the units it produces. So, any method you follow, standard is not putting any restriction regarding the method. Now come on, tell me, in interviews also they will ask this question. Okay, what is the depreciation method we need to follow? Don't tell SLM or WDV, there is no such thing. Now tell me the principle. Principle, what is the principle to provide the depreciation? Which method you need to follow? The method should reflect what? The pattern pattern in which the future economic benefits are expected to be consumed by the entity. You need to learn some technical words. You should not write your generalized language in the examination. You will not get marks. If you want to get the marks relating to accounting standards, you need to write the language of the standards only. Sir, I will write my village language. Will they allot marks? They won't allot. Here the word should be like this. Suppose some students will, here they will write like this generalized answer. Depreciation match with the incomes of the asset. Depreciation match with what? Incomes of the asset. They won't give marks. Sir, why sir? I have written correct only. No. You have written what you understand in your language. That may not fully reflect the intention of the accounting standard. So here the crucial word is what? Depreciation. Depreciation should, the method of depreciation should reflect, the word is reflect the pattern in which the future economic benefits, that is the word, future economic benefits which are expected to be consumed by the entity. That's why in the red ink, why we are giving, because those are the key words you need to at least remember. Hello. Next. So tell me, what is the method? Which method I need to provide? Depreciation. Any particular method? No. First, what I need to see? Future economic benefits of the asset. Pattern. My depreciation should reflect that pattern. Hello. So in that process, it can be straight line, it can be WDV, or it can be some other method. You decide which method. If I follow, my depreciation is reflecting the future economic benefits. Next, review. Sir, every year, sir, every company has to review its depreciation method. Not only depreciation method, sir, we need to review our useful life, we need to review our residual value also, because these are all what? Estimations, na? Useful life is an estimation. Maybe at the time, at the beginning of the year, at the beginning of the asset, when we acquired, based on the information available at that time, we will make estimations. But now the information change. As and when you get more experience, definitely you will make better estimations. For example, I purchased one bike. Initially, I estimated that this bike useful life is 5 years. But after using it for 2 years, I came to conclusion that no, it is not 5 years, it is only 4 years. Right? Similarly, residual value. At the beginning, I estimated residual value 1 lakh. But after using it for some period of time, I came to know that residual value is not 1 lakh, it is only 50,000. So therefore, since depreciation is estimation, it depends upon a lot of factors. You have to review every year. That's why, see, depreciation method should be reviewed at least every year end. We need to review the depreciation. Okay? And change in method. Come on, tell me. Can I change the method of depreciation? Sir, first I thought SLM is correct. But after some period of time, I came to conclusion that SLM is wrong. SLM is not reflecting the correct amount of depreciation. Therefore, I want to shift it to WDV. Can I shift? Yes. Allowed. Shift is allowed. But this is called what? SLM to WDV. This is called change in accounting. Change in accounting estimate. Change in accounting estimate. Actually, in our syllabus, we have first accounting standard. Change in accounting policies, one standard is there. There we are going to discuss it. But as of now, you remember that whenever a company changed the method of depreciation, that is called change in accounting estimate. And whenever there is a change in accounting estimate, the accounting will be done prospectively, no, not retrospectively. Whatever the period gone, don't think about it. In which year you have made the change. So from that year onwards, you need to provide depreciation based on the new method. Only prospective accounting, no retrospective accounting. Only which accounting, sir? Prospective accounting. What is prospective accounting? Only future. The date the change happened, now from that day onwards, you need to apply the new method. Don't retrospectively give the effect of this change. Hello? So see this. This is treated as change in accounting estimate and dealt with prospectively as per Ind AS 8. We have Ind AS 8 first standard. We are going to discuss it. Revenue based method. Sir, can I provide depreciation based on the revenue generated by the asset? No, not appropriate. Sir, you have to decide the depreciation method based on the pattern in which the future economic benefits of the asset are expected to be consumed by the entity. Simply, you cannot provide depreciation based on the revenue. So it is not appropriate because the revenue is affected by the inflation factors, price factors. For example, if I start providing depreciation on the sales, what happens when I increase the sale price? More sales amount will come. So depreciation will also increase. When the sale price drops, less sale value. So you provide less depreciation. That is not correct. And also inflation factor is there, inflation. Because of inflation, the prices are continuously increasing or decreasing. So therefore, I cannot provide depreciation based on the revenue, which is not correct. And the next point, depreciation on land and building. Come on, sir, tell me, is land is depreciable asset or non-depreciable asset? Generally, land is what? Non-depreciable asset. Why? Unlimited life. Is land is having any limited life? No. Generally, land we cannot provide depreciation. See, depreciation is provided only for assets which are having limited life. Suppose land is there. What is how many years the life of the land? We don't know. But there are some category of lands like mining, all these things, mines, all those things. If they have any limited life, then you can depreciate them also. So that's why here I have given land. Generally, the life is infinite. Land life is infinite. So you cannot provide depreciation. Suppose if the land life is finite life, there are natural lands, there are created lands. I mean, like for example, mining area, quarry, they call it as. These are all what? Land with a finite life. Then they will be depreciated. What about building? Obviously depreciable. This building is depreciable. See, actually right now this building is there. Na? This is actually two assets, building, land. Can you separate them? You cannot separate them physically, but in the books, when you are writing entries now, when you are recording assets now, land you need to write separately, building you need to write separately. So no sir, I will club both. That means you provide depreciation on land also, na? Which is non-depreciable asset, which is not correct. Hello. So therefore, practically land is separate, building is separate, sir. Land you cannot provide depreciation. Building only you need to provide the depreciation. Because land is having infinite life, building is having a limited life. So depreciation is allowed only on the building, not on the land. But some special category of lands are there. Quarries, mines. If they have, they definitely have only limited life. So they will be depreciated over the useful life. So I think I have completed the depreciation topic. You understand depreciation topic? Hello? Can I ask 3 questions only? I will ask. Will you answer? First of all, to calculate depreciation, what is required? Cost, residual value, useful life, generally. How to find out depreciable amount? Cost minus residual value. When to start providing depreciation? When the asset is ready for use, not actual use. Next, when to stop? Held for PPE, held for sale, or derecognized, whichever comes earlier. Which method I need to follow? The method should reflect the pattern in which the future economic benefits are going to be consumed with the entity. Change in depreciation method is what? Change in accounting estimation. Which accounting we need to do? Prospective or retrospective? Prospective accounting we need to do. Okay. And sir, let me give you some clarity regarding depreciation, sir. See, relating to depreciation, sir, there are 2 methods, sir. To provide depreciation, there are 2 methods. See, I am talking about accounting. Accounting of depreciation. 2 methods. I think you know this. What is the one method, sir? First method. Depreciation is directly charged from the asset. So whenever you provide depreciation, you will write entry. What is the entry you will write? Depreciation to asset account, correct? Depreciation to PPE you will write. This is one method, sir. Okay. There is one more method, sir. In this method, depreciation is not directly charged to asset. Rather, depreciation is transferred to separate account. Depreciation account debit to accumulated depreciation account. Accumulated depreciation account, also known as provision for depreciation. Accumulated depreciation or provision for depreciation, both are same. Now, once you provide depreciation, depreciation is basically what? Loss. That loss will be transferred to P&L account. So P&L to depreciation. Here also depreciation will be transferred to P&L to depreciation. See, what is the basic difference between these two methods? In first method, we are not maintaining separate account for depreciation. Accumulated depreciation we are not maintaining. Directly depreciation we are recognizing and adjusting from the asset. That means depreciation loss is directly deducted from the asset value. So when you prepare balance sheet here, in this method, see this, balance sheet, asset side, liability side if I write. For example, you know, there is a PPE. The cost of the PPE is 10 lakhs. First year you provided depreciation. In this method, 2 lakhs suppose depreciation, you directly deduct it. So therefore it will be 8 lakhs. Correct? 10 lakhs, 8 lakh, 2 lakhs depreciation I deducted, 8 lakhs. That means directly here in the balance sheet, PPE will appear at 8 lakhs. Because you purchased 10 lakhs, cost 10 lakhs, sir. Depreciation for the first year 2 lakhs. 8 lakhs it will appear in the balance sheet. This is called what? First method. I mean, this is one way. Suppose if you follow the second method, in this case, here you see PP 10 lakhs less accumulated depreciation 2 lakhs. So it will be 8 lakhs. That means here this depreciation we are transferring P&L to P&L account directly. Here also depreciation opened and this depreciation will be transferred to P&L, but you know we are maintaining a separate account relating to depreciation called accumulated depreciation account. To this account every year we transfer the depreciation. That means asset is maintained at what value? Cost. Asset will be reflecting at its original cost. Relating to this asset, whatever the depreciation every year we provide, that is transferred to a separate account. In the balance sheet when you are showing, sir, cost minus accumulated depreciation, you need to show the WDV value. So here the basic difference is, in first method depreciation is directly deducted from the asset, but in the second method we are not deducting the asset value, we are transferring to a separate account called accumulated depreciation account. Accumulated depreciation account. Important, sir, this is. So which method you follow, that's you select, but majority of the questions they will give this only based on this. Hello, you understand this? Tell me, when you provide depreciation, there are how many possibilities are there for accounting? 2. What is the first possibility? Depreciation is directly adjusted to asset. What is the entry when you provide depreciation? Depreciation to PPE, and this depreciation will be transferred to P&L account because it's a loss. So in balance sheet PPE will be shown at what value? WDV. Correct? What is the second method? When you provide depreciation, what you do? Depreciation will be transferred to accumulated depreciation account. Every year same entry you will write. Whenever you provide depreciation, depreciation to accumulated depreciation, depreciation to accumulated depreciation. That means you are not adjusting to the asset value. That means asset is always shown at what value? Cost. Depreciation is accumulating in separate account. Therefore in the balance sheet you will show the asset at cost, accumulated depreciation separately. So can you show this accumulated depreciation on liability side? No, because this accumulated depreciation, nothing but provision for depreciation, is an adjustment against what? Asset. It is like provision for doubtful debts. Provision for doubtful debts, what you are doing? You are deducting from the debtors. Same thing you need to do here. Sir, only presentation difference. Ultimately, effect is same. Are you understanding, guys? Here also 8 lakhs, here also 8 lakhs. But here depreciation is directly adjusted from the asset. Here depreciation is transferred to separate account. P&L account is also affected. Same. Only difference is this. Please observe, because when you are solving the questions, majority of the cases this will come. Hello. Actually, this is already you know in CMA inter-level, but I covered it. Okay. So we have completed which topic? Depreciation topic we have successfully completed. Next, one of the most important topic in India 16 is subsequent measurement. Okay. Okay, sir. Next, after depreciation, the next concept we are going to discuss is subsequent measurement of PPE. Very, very important, sir, which requires your full attention to understand this concept, subsequent measurement of PPE. Sir, if you understand what we are discussing in a very structured, systematic manner. I told you in respect of measurement, there are two stages. One is initial measurement. You tell me, initially, first time when you want to recognize a PPE, what is the value at which you are going to recognize? Cost. So this is already we have done. We know how to determine the cost. We have seen it. Now next, subsequent measurement. Sir, what is this subsequent measurement? Subsequent measurement means at what value you are going to show the PPE in balance sheet. Sir, every year you are going to prepare financial statements, na? In financial statements, balance sheet is there, na? In balance sheet, asset side you need to show PPE, na? At what value you are going to show? That is called subsequent measurement. Sir, initially we recognized the cost, na sir? So asset is there at cost in the books and we are providing depreciation on that. So at the end, whatever the balance is there, that value we will show in the balance sheet. But the standard says, sir, in order to make subsequent measurement, there are two models available. For subsequent measurement, there are two models. What are the two models, sir? One is cost model. Another one is revaluation model, which is very, very important. Most of the students lacking proper knowledge in revaluation model, and if you see the past examination questions of CMA Institute, everything relating to revaluation model only. We are going to see the questions also. Examination questions, you will understand it. Cost model, revaluation model. Cost model, very simple, sir. What is this cost model? See, in cost model, first you will take the cost of asset, original cost you will take. Okay. And till now, how much is the depreciation accumulated? If you are maintaining accumulated depreciation account, total depreciation in the accumulated depreciation account, you will deduct it. And also, if there is any accumulated impairment loss, what is that? Impairment loss. We are going to discuss impairment loss. As of now, you understand that what is impairment loss? Simply speaking, loss in value of asset due to reasons other than depreciation. See, why an asset loses its value? Only two reasons. One is depreciation. Another one is other than depreciation. That other than depreciation is impairment loss. For example, take this building, sir. How this building is losing its value? By time. That is normal depreciation. Suppose due to any other technical, market, external reasons, if it loses its value, impairment loss. For example, this building, this area, okay, right now where this building situated, this area, has become very heavily polluted. So it has lose its value. Possible? Or for example, some damage, accident happened. this building damaged, it loses its value. So please understand, sir, an asset may loses its value either due to depreciation or due to any other reason. That any other reason is basically impairment loss. And we are going to cover it in a separate index. We have a separate index also relating to impairment loss. There we are going to discuss it. So if there is any impairment loss is there in respect of that asset, that will also be deducted from the cost. Then you will get what? The value at which the asset will be shown in balance sheet. This is called subsequent measurement. Under which model? Cost model. So in cost model, how to measure the PPE? Tell me. What is the formula? Cost of the asset, original gross value minus accumulated depreciation minus accumulated impairment loss. You know this accumulated depreciation, which is nothing but we are following this method. I told you there are two methods of accounting for depreciation. In one method, depreciation is transferred to accumulated depreciation account. So at the end of the year, whatever amount is there in the accumulated depreciation against this asset, that has to be deducted. And the remaining value you need to show as the asset value in the books. For example, the cost is 100 lakhs. Accumulated depreciation, suppose for example 20 lakhs. So nothing impairment loss. So 80 lakhs is what? 80 lakhs is what? The value at which the asset will be shown in the balance sheet. This is called subsequent measurement under which model? Cost model. Now, okay, cost model is very simple. We initially determine the cost, from that till now whatever the depreciation accumulated, till now whatever the accumulated impairment losses, that is deducted. Come to revaluation model. The standard says PPE can be measured at fair value, revalued amount. That means assets may be revalued. Assets may be subject to revaluation. See, at the time of purchase you are determining the cost, right? But every year end, if you want, you can revalue that asset. Revaluation model. For example, suppose this building is there. For example, this building when I purchased it, suppose 3 years back I purchased. At that time the cost is 100 lakhs. Now at the end of the third year, I want to make sure this asset will be properly valued. Maybe in the market this building value is only 80 lakhs, but I am showing in the books 100 lakhs, for example. So maybe I am showing excess 20 lakhs, right? So therefore I need to set right that. What I need to do? Revalue. Sometimes there is a possibility that assets may be overvalued or undervalued. That overvaluation, undervaluation is affecting my financial statements, right? I need to remove that situation. Therefore the standard says, okay, you have cost model, or alternatively you can follow revaluation model. That means you can revalue the PPE. When I do the revaluation will be done at what value? Fair value. At the end of the year when I am doing the revaluation, whatever the fair value of this asset is there, at that value I will revalue the asset. That is called revaluation model. So in revaluation model, how to determine the value at which I need to show the asset? Simple. Take the fair value of the asset. Fair value at the time of revaluation. Whenever revaluation happened, sir, at the time of the revaluation, what is the fair value? Take it. And after revaluation, any subsequent after revaluation, whatever subsequent accumulated depreciation is there, deduct it. After revaluation, any subsequent impairment loss is there, deduct it. But what is the basic difference between cost model and revaluation model? In cost model, you are taking cost as the base. From that you are reducing the accumulated depreciation and impairment loss. But in revaluation model, you are taking base of what? Fair value at the time of revaluation. When was the last time you done the revaluation? At that time, what is the fair value? After the revaluation, what is the subsequent accumulated depreciation of that asset? Subsequent impairment loss of that asset you deduct. Then you will get the value at which the asset will be shown under which method? Revaluation model. Now I want every one of you to focus this. Tell me, come on, what we are learning? We are learning subsequent measurement. Subsequent measurement, how many models are available? 2 models. What are those models? Cost model, revaluation model. In cost model, how PPE will be shown? Cost of the asset minus accumulated depreciation minus accumulated impairment loss. Under double revaluation model, fair value at the time of revaluation minus subsequent accumulated depreciation minus subsequent impairment loss. Here, why they use the word subsequent? Subsequent means after revaluation happened, what will be the accumulated depreciation? What will be the accumulated impairment loss? That you need to deduct. Now I am going to explain the accumulated depreciation treatment in case of revaluation model, which is one of the superb topics. You will enjoy it. Okay. So revaluation model, cost model. Okay. Sir, that means, see this. Let me give you one simple, okay. Revaluation model, sir. Yeah. You see this. Here I have given. So measurement models, either cost model or revaluation model. Cost model, cost minus accumulated depreciation, accumulated impairment loss. Revaluation model, fair value on the date of revaluation minus subsequent accumulated depreciation minus subsequent accumulated impairment losses. Now, sir, next concept, sir, consistency. So, sir, which model I need to follow? Your choice. You can follow either cost model or revaluation model. But the standard says you need to, for the same class of asset, you need to apply the same model. Within the class, selective application is not allowed. For example, buildings. Either you follow cost model or revaluation model. For example, you have 5 buildings. Sir, one building cost model, another building revaluation model, not allowed. Because buildings of the same class, same category, same class. In I think in income tax you will do block of assets concept. Na? Block of asset means assets of the same nature will comes under one block, right? Same here also. Assets of same nature, same use, same nature. You should follow the same model. Within the class, selective application is not allowed. I will give you one beautiful example, examination question. This is CA inter examination, CMA final examination question. This is, you have to tell me. See, there is a company A Limited, sir. Okay. This company is having office buildings. So, office building in Hyderabad, Chennai, okay, Delhi, for example. And they have industrial buildings. Industrial buildings. They have industrial buildings, sir. Where they have industrial buildings? Gujarat. They have one industrial building. Kolkata. One industrial building is there. For example, Vizag. Industrial building is there. Suppose this company wants to follow, for office buildings, they want to follow cost model. For industrial buildings, they want to follow revaluation model. Correct or wrong? Good question, right? Tell me. Same model. I mean, see. For industrial buildings, they want to follow revaluation. Industrial building means factory air. Office building means these kind of buildings are called office buildings. For office building, cost model. Industrial buildings, revaluation model. Tell me. Correct or wrong? Actually, this is correct only. Why? Same class of assets. Office buildings is one class. Industrial buildings are one class. They are not of the same class, na? Nature wise, use wise, they are different. Sir, whether factory building or office building same, sir? Factory building is different. Office building is separate. So therefore, here they want to apply cost model for entire all office buildings allowed. Suppose, for example, if this company take a decision that Hyderabad office building we follow cost model. Chennai office building revaluation model. Is that correct? No, not correct. Within the same class, different models not allowed. Very simple here. So see this. Whichever model is followed, it should be applied entire class of PPE. What is class of PPE? Group of assets of similar nature and use. Similar nature and use. Plant and machinery, similar, one group of assets. Office equipment, one group of assets. You follow the same model, either cost model, revaluation model. One model only allowed. Within the class, different models allowed? No, not allowed. For example, land and building, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment, bearer plant. These are all what? Different class of assets. Different class of assets. For example, ships. Our company got ships. Ships is a PPE for you. For all ships, you follow one model. Aircraft, follow one model. Motor vehicles, one model. Within the motor vehicles, for example, we have 10 motor vehicles. Can I follow different models? No, not allowed. Okay. Sir, you understood? So, whichever model you follow, you need to maintain what? Consistency. Right? Selective application is not allowed within the same class. Next. Sir, next question, sir. Okay. We are following revaluation model. How frequently we need to do revaluation? For example, superb. Actually, I am enjoying. Whether you are enjoying or not, I don't know. Suppose take one plant and machinery, sir. One plant and machinery. Suppose we are following revaluation model. Sir, following revaluation model means? In revaluation model, what we do? We will revalue the asset to fair value. How frequently? We need to do it. Suppose in respect of this plant and machinery, I am following revaluation model. Whether every year I need to do revaluation, or once in every 2 years I need to do, once in every 5 years I need to do, once in every 10 years I need to do, how frequently I need to do revaluation? Standard says the frequency of revaluation depends upon how volatile the changes in the fair value of this asset is. If there are volatile changes, significant changes in the fair value of the asset, then frequent revaluation is required. That means annual revaluation every year. For example, this building is there. This building I am following revaluation model. Every year this building fair value, market value is changing. Every year. Then do annual revaluation. Sir, there are no frequent changes, sir. There are no significant volatile changes, sir. Then the standard says once in every 3 years. Once in every 3 to 5 years you do revaluation. So therefore, the frequency of revaluation I need to select, I need to see whether this asset I am following revaluation model, the fair value of this asset, is it having a volatile significant changes? If answer is yes, annual revaluation. Otherwise, once in every 3 to 5 years. So this they will ask this in MCQ. Definitely they will ask this. So it depends on frequency of revaluation, depends on what? Volatility in the fair value. So if there are significant changes, annual revaluation. Volatile and significant changes, annual revaluation. Insignificant changes, volatile, but they are not that much frequent significant changes. Then revaluation in once every 3 to 5 years. You decide. Once in every 3 years, 4 years, 5 years, you do the revaluation. For example, this building is there, sir. Right now, the city where this is situated, is it any significant changes in the market value of this building? No. So therefore, maybe once in every 3 years, maybe 5 years, you do revaluation. Hello? That's it. And this point I already told. When you are following revaluation model, you need to follow what approach? Class approach. That means entire class of PP is same model. If an item of PP is revalued, the entire class to which this asset belongs will be revalued. Suppose if I am following revaluation model for industrial buildings, all the industrial buildings, I need to follow revaluation model. Okay. Next concept, very, very important. Guys, are you understanding what I am speaking? See, till now I told you 3 important points. What are those? Revaluation model. First, class approach you need to follow. That means selective application within the class is not allowed. Frequency I told you. Frequency depends upon the volatile significant changes. If there are volatile significant changes, once in every year, annual. Otherwise, every 3 to 5 years, you do the revaluation. And I also told you how to calculate the revaluation model, cost, value determination. Okay. Now next, very, very important, guys. reset attempt, I think in June 2025 attempt, I will show you the examination question. 7 marks question they have asked from this topic. Now after listening this topic from me, you go and solve that question. You can solve it in 2 minutes. Okay, but listen to me very carefully. Important topic this is. Okay. Sir, first of all, what is this topic? We are discussing what? Revaluation model. Correct? We are discussing revaluation model. Now the topic I am discussing is accounting treatment of accumulated depreciation at the time of revaluation. What is it? Accounting treatment of what? Accumulated depreciation at revaluation date. That means asset revalued. In respect of that asset, what is there? Accumulated depreciation is there. What is the treatment? I am going to do it. First of all, this accumulated depreciation, how it came? Tell me. Because there are two models for two methods to provide depreciation. One method is directly depreciation is adjusted to the cost. Second method is depreciation is transferred to accumulated depreciation. So this accumulated depreciation appearing in the books means company following which model? Second model. That means the asset is they are transferring to depreciation, they are transferring to accumulated depreciation. They are not adjusting directly to asset. So accumulated depreciation. Sir, at the time of revaluation, please remember, at the time of revaluation, any accumulated depreciation is there. What is the accounting treatment? Sir, listen to me. The standard has given two methods or two techniques for accounting treatment of accumulated depreciation at the time of revaluation. One technique or one method is restatement approach. What is that? Restatement approach. Let us, I am going to explain this concept with one example, beautiful example, so that you will understand this. One approach is what approach, sir? Restatement approach. There is one more technique, sir, that is elimination approach. What is that? Elimination approach. Elimination approach, restatement approach. You can note down it. Important. Restatement approach, elimination approach. Okay. First I am going to explain technique 1, that is restatement approach. Okay. Restatement approach. Cost, accumulated depreciation, WDV. Suppose there is a property plant equipment, sir, PPE. Cost, sir, 1000 lakhs, 1000. Accumulated depreciation 400, sir. So what is the WDV? 600. Common sense, net book value. Sir, cost 1000 lakhs, sir. Accumulated depreciation 400 lakhs. WDV 600 lakhs. This is the PPE. Now we are doing the revaluation. Fair value. At the time of revaluation, sir, fair value is suppose 1500 lakhs, sir. Say this, important. What is the fair value at the time of revaluation? 1500 lakhs. Now you tell me what we need to do. I am doing revaluation. Fair value is 1500. In my books, what is the asset value? 600. Sir, this is before revaluation position, sir. Now I am doing the revaluation of this asset. I told you now, in revaluation we need to take the asset value to its fair value. What is the fair value? 1500. Okay. Now that means asset value should become how much? 1500. That is what I told now. See this revaluation model will start with what? Fair value at the time of revaluation. So now onwards we will start with this value. Now I am making the asset as 1500 lakhs. But in my books how much is there? Net book value 600 is there. Of course, cost 1000, accumulated depreciation 400, 600. Now I need to brought it to 1500. Now see, the standard says how much is the accumulated depreciation? 400. Now I am telling the accounting treatment for this. The standard says restatement approach. What is the first technique? Restatement approach. What the standard says now, whatever the increase is there in the this here, proportionately you increase the cost and accumulated depreciation also. That means you see this PPE after revaluation, what you can do is, sir, tell me sir, come on everybody, please concentrate here, concentrate. Sir, if my WDV is 600, what is the cost, sir? 1000. If it is 1500, how much cost? Find out it. Tell me how much? 2500. Simple. Hello? Sir, simple, sir. 1000 into 1500 divided by 600. Hey, basic mathematics, sir. Once again I am telling. See, if your cost is 1000 na, WDV 600 na, if your WDV is 1500, I mean fair value, what will be the cost? Find out it. 1000 into 1500 divided by 600, you will get it na. How much? 2500. Similarly, accumulated depreciation also you do the same thing. See this, if your WDV is 600, accumulated depreciation is 400 na. If your 1500 is there, what will be the accumulated depreciation? 400 into 1500 divided by 600. How much? 1000. That means what we have done? 400 into 1500 divided by 600. So tell me, 2500, 1000. How much value will come? 1500. So here what happened? Can anybody tell me? Before revaluation, what is the PPE cost? 1000. After, how much increase? 1500. Before revaluation, what is the accumulated depreciation? After, how much increase? 600. So 1500 to 600. 1500 minus 600. How much is the difference? 900. That is exactly the revaluation surplus. 600 has become 1500 na? That means how much increase? 900. That is called revaluation surplus. That is called revaluation surplus. Because 600 asset value, you make it as 1500. So therefore, in restatement approach, what we need to do is, proportionately we need to increase the cost and accumulated depreciation. That means, see this, what is the entry we are going to write here? Simple. Everybody, please concentrate. Everybody, please concentrate. PPE account debit. How much increase? 1000 has become 2500. How much? 1500. To accumulated depreciation account. Sir, accumulated depreciation basically which balance? Credit balance. I am increasing means I need to credit again. How much increasing? 400 has become 1000. That means 600. The balance is nothing but revaluation surplus. Revaluation surplus or revaluation gain. How much? 900. This is one approach. This is the treatment of what? Accumulated depreciation at the time of revaluation. So at the time of revaluation, this is how the accumulated depreciation will be treated. So now onwards, what will be the total accumulated depreciation? 1000. Now onwards, what is the accumulated depreciation, sir? 1000 will be the accumulated depreciation. So this is one approach, sir. You understand the restatement approach? So tell me, in restatement approach, what you do? Cost, accumulated depreciation, both will be restated according to the fair value. So here 1000 has become 400 has become 1000. 600 has become, actually this is the thing, 600 has become 1500 now. This is 900. This is the revaluation surplus, 900. Actually this increase only we proportionately increases. Actually, you know, 600 has become 1500 now. That means I think 150% increase, correct? This is how much increase, sir? 150. Sir, 600 has become 1500, sir. That means how much increase, sir? 900. Find out in percentage. 900 divided by 600 into 100. How much, sir? 150. Same thing you can apply. 1000 into 150%. 2500. 1500 increase. Correct? Here 400 into 150. 600. 1000. If you apply this, 1500 will come na increase. Here, if you apply 150% of 400, you will get 600. So 1000 plus 1500, 2500, 400 plus 600, 1000. That means whatever the 150 increase is there, the same increase I applied to the cost as well as accumulated depreciation. This is called proportionate increase. This is one technique. So here what is the entry will come, tell me? Asset value will increase, PPE. Next, accumulated depreciation will be created. Balance will be transferred to revaluation surplus. So see this, actually. Here technique number 1 is gross restatement. Gross carrying amount is adjusted in a manner that is consistent with the revaluation of asset. That means here the entry is asset account debit, accumulated depreciation account debit to revaluation gain. Revaluation gain. There is another technique. Sir, you understand first technique? Technique number 1 you understood? Second technique. What is second technique I told? Elimination approach. This is very easy. Elimination approach means simple. Elimination approach. Sir, elimination approach says eliminate accumulated depreciation directly from the cost of the asset. Then asset will be brought to the fair value. That means 2 entries will come here. Same example I am taking, sir. In this example, before revaluation, what is accumulated depreciation? 400. First, this 400 is adjusted to the cost of the asset. That means accumulated depreciation to PPE. This 400 accumulated depreciation is there na? Eliminate it. Elimination means debit it against the asset. Now the accumulated depreciation will become 0. Asset value is decreased by 400. Now asset value has become how much? 600. Brought it to 1500. Increase 900. That means the second entry is asset to revaluation surplus. 900, 900. Simple. See, elimination approach says first you eliminate the depreciation. Whatever accumulated depreciation is there, eliminate it first. That means accumulated depreciation, if I eliminate, I need to debit it na. Because accumulated depreciation is basically what? Credit balance. If I eliminate it, I will debit and I will adjust to asset. How much? 400, 400. Second entry. Now tell me, in my books, what is the asset value? 1000 is there now, cost. Now I adjusted accumulated depreciation means it has brought to how much? 600. But what is the fair value? 1500. Because I am doing revaluation, right? Now this I need to brought it to 1500. That means how much I need to increase? Increase it. When you increase the asset, asset value will be debited. Revaluation surplus account will be created. 900, 900. Simple technique, say this. Which approach is better? I think elimination approach is easy. Hey, very simple here. What is there here? Simple. In elimination approach, completely eliminate the accumulated depreciation against the asset first. So accumulated depreciation to asset. Then asset is brought to fair value. See, ultimately net effect is same only. Net effect is same only. See this, here revaluation surplus how much? Here also 900. But what's the difference here? Here accumulated depreciation has become 1000. Here accumulated depreciation has become 0. Here cost of the asset has become 2500. Here cost of the asset has become 1500 now onwards. That's it. There is no, I mean, you follow any technique you want, either technique number 1 or technique number. Hey, you know, you understood technique number 2 or not understood? What is technique number 2? Tell me. Elimination approach. What do you do in elimination approach? Accumulated depreciation is adjusted to the cost of the asset. What is the entry? Accumulated depreciation to asset. Now that means asset has been reduced by accumulated depreciation. Now asset should be brought to fair value because you are doing revaluation, right? What is the entry for revaluation? PPE to revaluation surplus. See, this is the entry. These are the techniques we are following for what? Accounting of revaluation, accounting for accumulated depreciation. We are doing accounting for what? Accumulated depreciation. So these are the two techniques. See here, technique number 2, elimination method. Here, accumulated depreciation is eliminated against the gross carrying amount. That means cost of the asset is adjusted against the accumulated depreciation. So two entries will come, sir, for here. First, accumulated depreciation to asset, then asset to revaluation surplus or revaluation gain. First, accumulated depreciation is adjusted against the asset, sir. Then asset is brought to fair value. The difference is nothing but revaluation surplus. Hello. Now relating to this accounting for accumulated, this one, yeah. See this example, everybody. Okay, next, after learning this accounting treatment of accumulated depreciation at revaluation date, let us see the accounting treatment of this revaluation gain or loss, sir. Sir, okay. When we got surplus, we are transferring to revaluation surplus account, sir. Okay. Revaluation surplus we are transferring, right? See here, when you are doing revaluation, important, listen to me carefully. Suppose I am doing revaluation, sir. First time I am doing revaluation. First time. Either I will do upward revaluation or I may do downward revaluation. There are two possibilities, right? Upward revaluation means overall increase in the value of asset. In our example, 600 has become 1500. That is which valuation? Upward. Suppose if the asset value decreasing, downward. Either there is an upward revaluation or downward revaluation, right? Now what is the treatment, sir? When I do the upward revaluation, downward revaluation, if it is an upward revaluation, revaluation gain. If it is a downward revaluation, revaluation loss. What is the treatment? Where I need to transfer that revaluation surplus or revaluation loss? Where I need to transfer? What is the accounting treatment? See, important, sir. Here 4 cases will come, sir. Listen to me very carefully. See, first time, subsequent. First time revaluation, subsequent revaluation. Okay. Sir, first time when you do revaluation, what are the possibilities? Either upward, downward, right? Suppose first time you have done upward revaluation. Okay. Tell me, if it is an upward revaluation, what will come? Gain or loss? Gain. Revaluation gain or revaluation surplus. Where will you transfer this revaluation gain? OCI. What is that? Other comprehensive income. OCI means other comprehensive income. We need to transfer to OCI. Where this OCI is there? Where OCI is there, sir? In P&L account, sir, division number 2, P&L account. P&L account format. In that P&L account format, you will get this OCI. Let me show you. Wait. I want every one of you to look at this. See, this is the first standard I am discussing. That's why I am telling all these things. Please learn it properly. I know many students, they don't know what is OCI. Very unfortunate. Okay, anyways, look at this. What is this? P&L account, correct? This is what? Division 2 of schedule 3. I told what is division 2? What is division 2? Financial statements of companies which are following Ind AS. First class. Don't become Gajani. In P&L account, generally what items will come? Incomes, expenses. Only to that extent you know. But learn the new things also. Look at this. In the P&L account, look at this 14th item. What is there? Read it. Other comprehensive income. In shortcut, call it as OCI. In OCI, there are two categories. What are those? Items that will not be reclassified to P&L. Second, items that will be reclassified to P&L. Now I will show you one beautiful thing here. See this. Other comprehensive income. I want every one of you items that will not be reclassified to P&L. Look at the first item. Changes in revaluation surplus. That's it. So whenever you got any revaluation surplus, transfer it to OCI. Any changes in revaluation surplus will go to where? OCI. OCI in that classified to P&L or not classified to P&L? Not classified. That means NR. Not non-resident. Not reclassified. One step. Okay, if you learn this. Okay, pa. Basic stuff this is. So tell me, whenever you do any revaluation, first time you done the revaluation, upward revaluation you have done. So you got what? Revaluation gain. Where will you transfer that? OCI. Where, with this OCI? NR. Not reclassified to P&L. Okay. First time upward revaluation I done. Subsequent also upward. Subsequent also. Suppose we have done the revaluation upward. Same thing. Can happen, right? Again, when you do revaluation, what happens? Upward revaluation. You will get revaluation gain. Whenever you get revaluation gain, you will transfer it to OCI. No change. This is case number 1. Case number 2. First time you done upward. You will get what? Revaluation gain. Where will you transfer it? OCI. Subsequent, you have done the revaluation. But you have done downward revaluation this time. Downward. Downward means what? Revaluation loss will come. What you are going to do? Whenever first time you have done the upward revaluation, second time there is a downward revaluation is there now. This loss, whatever you got, previously whatever the balance, whatever the balance is there in this revaluation gain which you transfer to OCI, that balance from this loss you transfer it to OCI. Remaining loss will be transferred to P&L account. That means, let me give you one simple example. First time you have done, you have got revaluation gain of 100. Second time you have done the downward revaluation, you got a revaluation loss of 150. What you need to do? In this 150, 100 which is previously transferred to OCI, now adjust to OCI only. Remaining 50 balance transferred to P&L account like a normal revaluation loss. Hello? Important pa. You understand this? So first time upward, second time downward. So whenever downward revaluation happened, what you do? Previously, whatever the revaluation gain you booked na to the OCI, in that OCI, see here you do one mistake. Listen. Previously, how much is transferred to OCI? Now, how much you need to reverse here? 100 only na. But remember, the standard says this 100, whatever the balance left at the time of this revaluation, only to that extent you need to reverse OCI. That means suppose for example in this 100, suppose 20 reduced, only 80 is there, you need to adjust only 80. Whatever the balance in the revaluation OCI relating to this revaluation gain is there, only to that extent it will be reversed. Understood? Important. Case number 2. So that means case number 3, sir. First time downward, upward 2 cases completed. Downward. Whenever you do downward, what happens? Tell me. Revaluation loss. What do you do? P&L account. Whenever there is a revaluation loss, P&L, transfer it to P&L account. Second time also downward, you will get what? Revaluation loss, transfer it to P&L account. That's it. Whenever there is a loss, transfer it to P&L account. Fourth case, first time downward, sir. You got what? Loss. What you are going to do? P&L account. Suppose second time you got upward revaluation. You will get revaluation gain. Yes, say this. Second time you got revaluation gain. Okay. Now, when you got a revaluation gain, same. For example, previously you got a loss of 100, revaluation loss. You transfer it to P&L. Second time you got revaluation gain of 150. In this 150, 100 adjust to P&L. Previously, how much you transfer to P&L account? 100. Now also out of this 150, 100 transferred to P&L account. Remaining balance 50 will be adjusted to OCI, other comprehensive income, OCI. You transfer it to OCI. That's it. So you understand this? Very simple. So I told 2 important things. Accumulated depreciation techniques I told. Accumulated depreciation, how we are going to account it at the time of revaluation. How many techniques are there? 2. What are those? Restatement approach or elimination approach. That is accounting treatment for accumulated depreciation on revaluation date. Now when you do the revaluation, either you may get what? Revaluation gain or loss. That gain or loss, what you are going to do? First time when you do revaluation gain came, where will you transfer? OCI. 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 Not classified to P&L, not reclassified to P&L. First time downward revaluation you have done, you will get revaluation loss, transfer it to P&L account. First time upward, second time also upward, no change, OCI, OCI. First time upward, second time downward. Now whatever the balance is there in the OCI in respect of this revaluation gain, first adjust it, remaining transfer to P&L. First time downward, second time upward. Whatever the revaluation gain came now, already how much you transfer it to P&L account, revaluation loss. First reverse it. Then balance you transfer it to OCI. Same I have given here. See this. Whenever you will get the material, you will see this. This 4 cases I have covered here. All the 4 cases, these are the 4 cases we have covered. Now, the last point relating to subsequent measurement. Sir, we are discussing subsequent measurement concept. So subsequent measure last concept, very very beautiful concept, sir. This concept also definitely you are going to enjoy it. Sir, okay, we done the revaluation. Please listen. We do the revaluation. When we do the revaluation, when there is an upward revaluation, what we got? Revaluation surplus or revaluation gain. Whether that revaluation gain will be continued in the books, or is there any situation this revaluation surplus will be transferred, will be closed? Because this revaluation surplus you created for the asset, right? PPE. Suppose if that PPE is sold, for example, against this building you done the revaluation. Now you got revaluation surplus. Suppose this building you sold it. What happens to revaluation surplus you already booked? That is also be transferred. That is also be closed. How will you close it? Simple. Transfer that revaluation surplus. You already transferred this revaluation surplus to OCI, right? From OCI, it will go to retained earnings. It will go to retained earnings. reserves and surplus, retained earnings is there na, you need to transfer it. When the entire asset is sold, in respect of the asset, whatever the revaluation surplus is there, that you need to transfer it to OCI. Let me explain you this concept. For example, sir, there is a plant and machinery. Important guys, please listen. In respect of this plant and machinery, you have done the revaluation. Okay? And because of the revaluation, you got revaluation gain. This revaluation gain you transfer it to OCI. Suppose in this OCI 10 lakhs is there, revaluation gain. Now this plant and machinery you disposed it. You disposed or de-recognized it from the books. De-recognized from the books. Now tell me, use your common sense and tell me, sir, when the asset is no more with you, what is the revaluation gain? What is the revaluation gain you booked against this asset? This will also be what, sir? Closed. How you are going to close it, sir? Simple. This will be transferred to retained earnings. Retained earnings. Actually, revaluation surplus is a restricted reserve. Now it has become retained earnings of the organization. That means it will shown in the reserves and surplus of the organization in the balance sheet. In reserves and surplus, other equity is there, na? In that other equity, we will show retained earnings. Hello? There it will be transferred. So, whenever, see this, transfer of revaluation surplus to retained earnings. When whole surplus is transferred, entire revaluation surplus of that particular PPE will be transferred. When the asset is retired or disposed. When that particular asset is retired from the use or when that particular asset is disposed, then entire revaluation surplus of that asset will be transferred to retained earnings. They will ask a question, come on, tell me, revaluation surplus, what you are going to do? Entire revaluation surplus you are going to transfer it to retained earnings. When the asset is retired or disposed. And this is not optional, sir, this is compulsory. Whenever you dispose the asset, whenever the asset is retired from the books, definitely whatever the revaluation surplus is there against that asset, that has to be closed and transferred to retained earnings. But there is one more optional point is also there, very interesting point. Case number 2. Some of the surplus, not the entire surplus, some of the surplus may be transferred to the retained earnings. This is only optional, sir, not compulsory. Guys, important. This is only optional, not compulsory. If you want, you can do it also. Sir, what is this optional, sir? See, suppose, sir, there is a plant and machinery, sir. I have done the revaluation. There is a revaluation surplus. Suppose in this plant and machinery, okay, this revaluation surplus, how much is there revaluation surplus? 10 lakhs. When this plant and machinery is entirely disposed, this entire 10 lakhs will go to retained earnings. The whole surplus is transferred to retained earnings. Suppose standard is giving one more option. It is just an option for you, not compulsory. What they are telling is, you can transfer part of the revaluation surplus to retained earnings also. Part, no need to transfer entirely. Sir, what is this part? How much part? Simple. Excess depreciation. Excess depreciation, to that extent of the excess depreciation, you can transfer from revaluation surplus to retained earnings. Sir, what is this excess depreciation? Simple. If there is no revaluation, what is the original depreciation? Because of revaluation, what is the depreciation? The difference is nothing but excess depreciation. See, that means they are talking about upward revaluation. When you do the revaluation, sometimes asset value increasing, na? When the asset value increasing, you provide more depreciation, na? That means if there is no revaluation, what will be the depreciation? After the revaluation, what is the depreciation you are providing? The difference is what? Excess depreciation. So that excess depreciation every year, if you want, you can transfer from revaluation surplus to retained earnings. For example, I will tell you best example. See this. Suppose depreciation per annum, original, if there is no revaluation, depreciation per annum is 1 lakh, sir. Because of revaluation, the depreciation came to 1,20,000. That means what is the excess depreciation? 20,000. So this you can transfer from revaluation surplus to retained earnings. but this is only optional, guys. In such case, the amount of the surplus transferred would be the excess depreciation. What is excess depreciation here? Depreciation based on revalued carrying amount minus depreciation based on original cost. Depreciation without revaluation, that means on the original cost, what is the depreciation? Because of the revaluation, what is the depreciation? The difference is excess depreciation. That excess depreciation, if you want, you can transfer from revaluation surplus to retained earnings. I think this is a wonderful point, beautiful point. Again, I will explain. Simple. See, the standard says subsequent measurement. That means balance sheet date. We are giving you two options, either cost model, revaluation model. In revaluation model, what you need to do? You need to take the asset to fair value. That means either you do upward revaluation, downward revaluation. Asset value may increase or decrease. If asset value increasing, revaluation surplus. Revaluation surplus. So you created revaluation surplus. This revaluation surplus, when the asset is disposed, this revaluation surplus will go to retained earnings. Suppose even the asset is not disposed, this revaluation surplus, part of the revaluation surplus, you may transfer it to retained earnings. This is optional to you. How much is that part? Simple, excess depreciation. After revaluation, how much depreciation you are providing? Without revaluation, what will be the original depreciation? The difference is what? Excess depreciation. That means this situation is applicable only when there is upward revaluation. When there is a downward revaluation, there is no excess depreciation, sir. Hello. So therefore, the standard is saying that this is optional to you. If you want, you can transfer also. Good point or not? Definitely. So tell me, when the whole surplus, revaluation surplus is transferred to retained earnings? When the entire asset is retained or disposed? When part of the surplus can be transferred? Part of the revaluation surplus can be transferred to retained earnings only to the extent of excess depreciation. And this is compulsory or optional? Optional. Which is compulsory? When the entire asset is sold, disposed, then you have to anyway transfer the revaluation surplus to retained earnings. But this is only what? Optional. Hey, are you capable to hold this much weight? You understood the concept? So I think we have completed subsequent measurement. Very good concept, sir. Hope I have explained in depth. Look at this example, everybody. Revaluation surplus example. Everybody, please concentrate here. See, there is a PPE purchased, sir. What is the cost of PPE? 100 lakhs. Life? PPE revalued when? Second year. How much? 75 lakhs. Now, look at this. So, what is the original cost? 100 lakhs, right? Less depreciation. First year depreciation 100 divided by 5. How much is the depreciation? 20 lakhs per annum. And 2 years completed, right? Hello. So much? 40. That means what is the value? 60. This is the WDV at the, or we can call this as what? Carrying amount. We can call this as what? Carrying amount at the end of second year. At the end of the second year, what is the WDV? 60. Now you have done the revaluation, right? Revalued at, that means 75 lakhs is what? Revalued amount. That means how much is the revaluation surplus? This is revaluation surplus. So now onwards, this is the carrying amount. This is the carrying amount after the revaluation. After the revaluation. So now onwards, you need to provide depreciation on this 75, correct? So depreciation is equal to 75 lakhs divided by, what is the total life? 5. How many years completed? Still how many years is there? 3. This 75 is depreciated over the next 3 years. Correct? So what is the depreciation? How much? 25 lakhs. So tell me, this is depreciation for which year? Third year. What is the balance left? 50 lakhs. Now depreciation for fourth year. Same na? 25 lakhs. See this. So what is the balance? Now see, standard says simple. The standard says, tell me how much is balance is there in revaluation surplus? 15 lakhs revaluation surplus is there. Correct? How much is there in the revaluation surplus? 15 lakhs. Now, when the asset is disposed, this entire will go to retained earnings. Or else you have one more option, that you see the excess depreciation. Suppose tell me, without revaluation, what is the depreciation per annum? 20. Because of depreciation, what is the because of revaluation, what is the depreciation per annum? 25. 25. That means excess depreciation per annum is 5. 2 years means 10 lakhs. Hello. So therefore, excess depreciation here means depreciation on the carrying amount after revaluation 25. Without revaluation on the original value 20. So how much? 5. Every year you can transfer this 5 lakhs to retained earnings. This is optional. Anyway, once the life is over, you have to transfer entire surplus to retained earnings. But if you want this, you can transfer this excess to retained earnings. That means every year how much you will transfer? 5. Third year 5, fourth year 5, fifth year 5. The entire revaluation surplus will go to retained earnings. Guys, have you understood this? That's it. I think I have explained the concept of subsequent measurement. So you understand subsequent measurement? Okay. So next concept we are going to discuss is component accounting, sir, after subsequent measurement. Sir, what is this component accounting? Very simple concept, sir, but important concept. See, there are some PPEs. In that PPE, there are different parts, different components. Each component is significant in cost when compared with the total cost of the PPE. For example, sir, you take suppose a private jet, or for example aeroplane, for example you take it, right? Now in that aeroplane, engine and then body of the aircraft, body of aircraft and this engine of aircraft, both are separate components. Agreed or not? Because this engine is having what? Significant cost, right? In the overall cost of this aircraft. Of course, see, aircraft engine, aircraft body, together one PP, one asset. But in that asset, each one is significant. Aircraft body is having a significant cost in relation to the total cost of the aeroplane. Engine is having a significant cost in relation to the total cost of the aircraft. Similarly, there are some more assets. Like for example, we have one large plant and machinery. In that plant and machinery, for example, one item called turbine is there. See, there is a large plant and machinery. In that plant and machinery, turbine is one of the part, but which is very significant in cost when compared with the total cost of the asset. For example, you know, suppose this plant and machinery entire cost is 1000 crores. And this turbine cost is, for example, 600 crores. So which is a significant cost, right? Now the standard says, if you have any kind of these assets, the assets which are having components, each component is significant and having significant cost, then what you can do is, you can provide them depreciation separately. According to their life, you can provide depreciation. For example, you know, this turbine life is 5 years. And Generally, remaining plant and machinery life is 10 years. In that, this turbine, whatever is there, component, this is having only life of 5 years. So therefore, you need to provide depreciation separately. This is called component accounting. Recognize separately, provide depreciation separately. Remaining asset, you provide depreciation separately. Similarly, here, engine, aircraft engine, suppose the engine life is 10 years, sir. Aircraft, body of the aircraft life is, for example, 15 years. Then what the standard says is, this component is significant, right? It is having separate useful life, right? You provide depreciation separately. This is called component accounting. Okay, sir, suppose this component and remaining components, same life, sir. Same life means same amount of depreciation will be provided. No need to separately provide the depreciation. When they are having different lives, obviously you need to provide depreciation separately, because each component is what? Significant in relation to the total cost of the asset. So this is called component accounting. So see this. PPE consisting of different components. Any component that is significant in cost compared to the total cost shall be depreciated separately. For example, separate depreciation of airframe and engine of the aircraft may be appropriate. So in a aircraft, engine is a separate component. Aircraft body is a separate component. If they are having separate lives, we need to provide depreciation separately. This is called component account. Okay, see, important. Sir, whenever any component, okay, any significant component you have replaced, okay, what we are going to do? See, when a significant component is replaced, whatever the carrying amount of the replaced component is derecognized from the books, and the cost of the new component is recognized. Old component carrying amount will be removed. New component cost will be added. For example, you take the WDV of the existing asset. Carrying amount of the existing asset you take. Whatever the part you are replacing, component you are replacing, that part you remove it. WDV of that part. WDV of the old part, remove, because you are derecognizing it. New part cost you add, then you will get the revised WDV of the PPE. Simple. See this. For example, aircraft is there. This aircraft WDV 1000 crores. In this aircraft, engine is there, engine. In this aircraft, engine is also there. That engine, suppose you are replacing. Whenever you are replacing, sir, the old engine, WDV on the date of replacement, you remove it. Old engine, WDV carrying amount on the date of replacement. Suppose the old engine WDV is 300 crores is there. Remove it. And you are adding new engine, new component. Cost will be there, na? Suppose new engine cost is 600, add. So what is the revised WDV of the asset? 1300 crores. This is called revised WDV of aircraft. Hey, important here. You understanding what I am discussing? Whenever any component, whenever any significant component is replaced, what you are going to do? Tell me. First, you take the WDV of the entire asset on the date of replacement. Further, from that you need to reduce one thing. What you are going to reduce? Old component WDV value. Which one you need to add? New component cost. Then you will get the revised WDV of the PPE. This is called component accounting. So component accounting is very simple, sir. So in a asset, if there are any significant component, significant parts, any part which is having a significant cost in relation to the total cost, then you provide depreciation separately. And whenever you replace that part, okay, WDV of the old part will be reduced, cost of the new part will be added to the asset. Correct? For example, you see, everybody come to this example, see this example. Suppose there is a company ABC Limited, sir, which purchased a jet aircraft on 1st April 2020 for how many crores? 100 crores. Useful life of the aircraft? 20 years. Oh, no, sir. 1 minute. This is the next concept example. Yeah, this example you see. Component account. XYZ Limited purchased a private aircraft, sir, on 1st April 2023. What is the cost? 120 crores. What is the useful life? 12 years. Aircraft has two significant components in that. Engine cost is 30 crores. Life 6 years. Body cost is 90. Life 12 years. Now you see, this is one asset, private aircraft. In that asset there are two components. What are those? Engine and body. What is the cost of the engine? 30. Life 6 years. What is the body cost? 12. Therefore, two separate components. So we need to provide depreciation separately. So therefore here depreciation on engine, 30 divided by 6. How much, sir? 5 crores per annum, right? Suppose for example depreciation on body. Depreciation on body 90 divided by 12. 7.5 crores. 7.5 crores per annum. So therefore at the end of the year, sir, you know, engine, body. If I take separately, what is the cost of the engine? 30. This is 90. Less depreciation. 5, 7.5. That means this is 25. This is 82.5. This is the WDV, correct? Or we can say carrying amount at the end of first year. At the end of the first year. So at the end of the first year, this is the value, sir, of both of them, correct? Now suppose we have replaced it, sir. Imagine this engine we have replaced at the end of the first year. So what you are going to do? First you take the private jet WDV. What is the WDV of the private jet? You need to add both of them. Private jet means part of engine as well as body, right? Sir, 25 plus 82.5. 107.5. Take the WDV 107.5. What I told? Less old engine WDV. Old engine WDV how much? 25. Correct? What we need to add? New engine cost. Suppose new engine cost is example 40 crores. Example 40. Add 40. What is the WDV? 107.5 minus 25 plus 40. How much, sir? 122.5. 122.5. This is the WDV, revised WDV of the asset. 122.5. So in this 122.5, can you tell me the breakup? 122.5, what is the breakup here? In this 122.5, what is the breakup, sir? 82.5 aircraft body. And engine, new engine cost is how much? 40. And this 82.5 will be depreciated over the remaining life. What is the remaining life? Total how many years? 12. And this will continue. What is the depreciation? 7.5. So depreciation for the second year 7.5. This 40, this is the new asset, right? Suppose the remaining life is 6 years, for example. So 40 divided by 6. How much? 6.67. Sir, this is not the old one, sir. This is the new one. New one has to be depreciated over the remaining new life. Already old one, first year we provided depreciation 5, right? Everybody. But this first one already replaced, na? Now the new one came 40, which is, suppose the life is 6 years. So 40 divided by 6 means 6.67. So this is the depreciation you need to provide. You understand component accounting? So tell me, what is the crux of component accounting? Can you able to solve? So component accounting, when you follow component accounting, in a asset there are multiple parts. But can each part be component? I mean, component account will be applied. It must be what? Significant cost in relation to the total cost. And definitely if it is having separate useful life, you need to provide depreciation separate. But whenever you replace the part, first you take the WDV of the entire asset. The entire. For that, what you need to do? Old part WDV will be less, new part cost will be added, and you will get the revised WDV. And you need to provide depreciation by separately for each component. Okay. Now come to next concept, sir, impairment loss. Actually, sir, relating to impairment loss, there is a separate standard, I told you. What is that? Ind AS 36. So there I am going to explain it in detail, sir. Ind AS 36. We are going to discuss it elaborately. But as of now, I am going to tell you simple basic formula of impairment loss. How to calculate impairment loss? Listen to me carefully. In order to calculate impairment loss, you need to compare two things. What is that? You need to compare the carrying amount of the PPE with the fair value. I'm sorry, recoverable value. Two things you need to compare. Carrying amount, recoverable value. If carrying amount is more than the recoverable value, carrying amount is more than the recoverable value, then there is a impairment loss. Carrying amount means in your books the asset value, suppose 100. In the market the recoverable value is only 80. That means how much excess? 20. That is called impairment loss. Recoverable value 80, carrying amount 100. That means ideally your asset value should be maximum recoverable value. Recoverable value should be, but you are showing more than recoverable value. That means your asset has lost its value. You are showing high value in the books, but in the recoverable value is only 80. Example. So therefore asset has to be brought to its recoverable amount. Then when you are reducing the asset value, obviously that is what? Loss. So that is called impairment loss. So impairment loss is nothing but the difference between carrying amount and recoverable amount. What is carrying amount? You know how to determine the carrying amount. Cost minus depreciation. You will get the carrying amount. I told you cost model, revaluation model, how to determine the carrying amount. Recoverable amount means the standard says, Ind AS 23 says, 36 says, carrying amount recoverable amount means two things you need to take. Whichever is higher you need to take. Fair value and value in use. Whichever is higher. Take the fair value of the asset, take the value in use of the asset, whichever is higher you take, you will get the recoverable amount. Fair value means market value. If I sold this asset, how much I am going to get? That is called fair value. Which there is a separate standard Ind AS 113 which talks about fair value. According to that standard, we will understand what is fair value. How to find out value in use? Value in use is nothing but the present value of the future cash flows from that particular asset. From that asset, what are the cash flows we are going to generate? Convert them into present value. So the present value of the expected future cash flows of the asset. Then you will get the value in use. So compare this value in use with the fair value. Automatically you will get the recoverable amount. Compare this recoverable amount with the carrying amount. If the recoverable amount is more than or equivalent to carrying value, there is no impairment loss. Impairment loss will come only when the carrying amount is more than recoverable value. So first try to remember the formula. Impairment loss will come only when the carrying amount of the asset is more than the recoverable amount. If the carrying amount is below or equal to recoverable amount, there is no impairment loss. Common sense, sir. In my books I am showing 100 rupees, but in the market or the recoverable amount is only 80. That means 20 rupees I am excess showing, na sir. That is not correct. That has to be brought to 80. So that loss 20 rupees is impairment loss. So therefore carrying amount minus recoverable amount. Carrying amount is the book value, I know. Recoverable amount means fair value, value in use. Fair value I will determine. Nothing but if I sell this asset in the market, how much I am going to get. What is the value in use? The present value of the future cash flows from the asset. This asset, what are the cash flows I am going to get from this asset in future? Convert this into present value. You are going to get the value in use. So tell me, what is the formula for impairment loss? Carrying amount minus recoverable amount. What is recoverable amount? Fair value or value in use, whichever is higher. Value in use means present value of the future cash flows. And subject to Ind AS 36, we are going to discuss it. And then next concept, subsequent cost. Very simple concept. Very easily we can complete this. Sir, once you recognize the asset in the books, whatever the cost you are going to incur on the PPE, what we are going to do it? For example, sir, day-to-day repairs and maintenance cost. See, in the factory there are so many machineries, right? Plant and machineries. Daily some kind of servicing repairs we need to do, right? Daily repairs. There is a large plant and machinery, sir. Daily some repairs will come. We will do routine checkup, routine repairs will do. Standard says this daily repairs and maintenance cost, whatever you are incurring, na sir, that should not be capitalized, because there is no value addition. There is no future economic benefits. Asset value is not increasing. Therefore, entire day-to-day repairs expenses must be transferred to P&L account. See, these do not increase the future economic benefits. So therefore, they will be charged to P&L. Next important, sir, replacement of parts. Sir, this concept is exactly similar to component accounting. Just now I discussed, sir. Whenever any part is replaced, what we need to do? What we need to do? Whenever a new part is replaced in the machine, what we need to do? Old part WDV will be removed, new part cost will be added. Same point. See this. When a part or component is replaced, component accounting is applied. The carrying amount of the replaced part is derecognized. That means the old part WDV will be derecognized. Cost of the new part is recognized. And last one, major inspections and overhauls. This is important, sir. Major inspection and overhaul. Sir, some assets requires inspection. Overhaul means complete examination. For example, you take aircraft, sir. There is a law which may says every 5 years every aircraft must be completely inspected. Without inspection, it is not possible to run the aircraft, because very dangerous, na sir. If the aircraft is not in condition, if no proper inspection has been done, so many lives who are traveling in that, very, very dangerous. That's why some law will be there. There are some provisions are there, legal provisions, which may says some assets requires what? Major inspection. Once in every 5 years, once in every 3 years, once in every 5 years, maybe frequently. What we need to do that cost, this inspection cost, overhauling cost, what we need to do? Will you add to the asset, capitalize, or will you charge it to P&L account? First you understood this, major inspection cost, sir. Servicing, inspection. There is a ship, there is a aircraft. Those things must be once in every 3 years or once in every 5 years or once in every 1 year. What we need to do? Inspect it. Some cost will be incurred now for that. What you are going to do with that cost? Same like component accounting. Same like component accounting, what we have done? Old component WDV will be derecognized, na? Here nothing but old inspection cost WDV will be derecognized, new inspection cost will be added. See, major inspection cost is treated as a separate component of PPE. Component accounting is applied. The carrying amount of the previous inspection is derecognized. The cost of the new inspection is added. Same concept will be applied. Okay. Relating to this major inspection and overhaul, one beautiful point is there. that point will come in problem solving. I am going to explain it at the time of solving the problem. See, same here. It is one example I have taken, right? See this example. See, there is a aircraft, sir. When we purchased this on 1st April 2024, how many crores? 100. Useful life 20. Major inspection is mandatory. Every 5 years mandatory inspection. For each inspection, what is the cost we are going to incur? 10 crores. Now you see, this jet aircraft total cost how much? 100 crore, correct? See this. In this 100 crores, what is the inspection cost? 10 crores. What is the remaining asset cost? 90 crores. Both has to be depreciated separately. Suppose this inspection has to be done once in every 5 years. So depreciation is 10 crores divided by 5. Every year 2 crores. This 90 crores. Suppose the remaining life of the asset may be, for example, here 20 years. So this is depreciated by 20. 4.5 crores. Okay. See, you may ask a doubt, sir. You take an aircraft 100 crores. Okay. In that inspection 10 crores. How you taken this? You said inspection will be done in every 5 years. So in the first 100 crores also that inspection is included. Yes, it is assumption. It's pre-assumed that, see, when we acquire an aircraft, obviously they will deliver only after inspection. So this 100 crores includes this 10 crores also. That's the assumption we'll take. So therefore, in this 100 crores of aircraft, there is an inspection cost of 10 crores, which is depreciated by 5 years. Why 5 years, sir? Because inspection is done every 5 years. It is like a separate component, sir. In component account, what we are doing? In aircraft example, I told na, engine life is different, body life is different. So engine is depreciated separately, body is depreciated separately. Correct? Same happens with inspection also. So in case of inspection and overhauling, the assumption is that whatever the cost of the asset is given, in that cost itself, the inspection cost is also included. So you need to separate it and you need to depreciate the remaining balance separately. If there are different lives, for example, here inspection is every 5 years, so divided by 5. Remaining life 20 years, remaining asset divided by 20. Hey, understood? Important. So tell me, conclusion, daily repairs cost, what do you do? Charge to P&L account. Replacement of parts, component accounting. Inspection, component accounting. Old will be derecognized, new will be added. When you are derecognizing, how much you derecognize? WDV. When you are adding, cost. Component accounting you follow. That means component accounting means you need to depreciate it separately according to its life. Important. And finally, there is one concept called derecognition. This point already you know. Derecognition means when the asset is sold or when the asset is no longer generating future economic benefits. So you need to remove it from the books. Opposite to recognition. We have learned recognition criteria. When the standard is allowing to recognize the asset, probable future economic benefits. Now there are no probable future economic benefits. So remove it. Or you sold. When you sell the asset, automatically it has to be removed. And see, whenever you derecognize the asset from the books, na sir, important sir. Ind AS 16 says you need to recognize the gain or loss. Sir, what is this gain or loss? Simple. At the time you want to derecognize, what is the carrying amount of that PPE? What is the NRV of that PPE if it is sold in the market? Compare it. If the NRV is more than the carrying amount, there is a gain. Otherwise, there is a loss. For example, there is a plant and machinery. See this. There is a plant and machinery, sir. See, there is a plant and machinery. This plant and machinery life is over. No future economic benefits. That means it has to be derecognized. On that date, the carrying amount of this plant and machinery is 1 lakh. And if I sell it in the market, I am going to get, after reducing the expenses, I am going to get 1,20,000. So can you tell me the gain? 20,000. This gain you need to recognize. Because the asset book value how much? 1 lakh. If I sold, how much I am going to get? So how much is the gain? 20. Imagine suppose NRV is only 80,000, then loss how much? 20,000. This gain or loss we need to recognize whenever you are de-recognizing the asset. To get the gain or loss, what we need to compare? Simple, carrying amount with the NRV. Common sense. See this, gain or loss on de-recognition shall be included in P&L. Gain or loss is equal to net disposal proceeds minus carrying amount. That's it, sir. I think we have completed all the concepts. So subsequent measurement, component accounting, impairment loss, subsequent cost, de-recognition, and finally disclosures. Relating to Ind AS 16, what disclosures we need to make in the financial statements? Actually, disclosures will be made where? Financial statements. I told you now, every standard will give you some disclosure requirements relating to that particular item, that standard dealing with, what points we need to disclose in the notes to accounts given here. So whenever you have a free time, you read all these things. They are not important for examination purpose, just you read it. Okay, that's it. So we have completed the entire Ind AS 16. Okay, so we have completed discussion relating to Ind AS 16, property, plant, equipment. So let us revise this standard once and then we will solve the questions, sir. So in Ind AS 16, first we have seen the definition of property, plant, equipment. Property, plant, equipment are tangible items held for use in the production or supply of goods or services, or rental to others, or for administrative purposes, and which are expected to be used for more than one accounting period. Spare parts, standby equipment to service equipment, if they satisfy the definition of PPE, then apply Ind AS 16, otherwise Ind AS 2 inventories. Then we have seen the objective of Ind AS 16. The main object of Ind AS 16 is to provide the accounting treatment for PPE. And how much you have invested in PPE, what changes happened in the investment in PPE during the period, and also all the principal issues regarding accounting of PPE are covered in this standard, like recognition of PPE, how to determine the carrying amount, impairment losses, depreciation, how to calculate, all these things are covered in this standard. Then scope of the standard. See, the standard is not applicable when PPE is held for sale, and also biological assets relating to agriculture activities other than bearer plants, because they are covered under Ind AS 41, and also any assets used in exploration, evaluation of mineral resources, which is covered in Ind AS 106. And the next, any mineral rights, mineral reserves such as oil, natural gas, etc., wasting assets, this standard is not applicable. And what is biological assets? Living animals and plants. And the standard is not applicable for this biological assets, but bearer plant, the standard is applicable. What is bearer plant? 3 conditions. It must give agriculture produce for more than 12 months and very remote likelihood of being sold as agriculture produce except for incidental scrap sales. And then we have discussed the recognition. When PPE will be recognized, 2 conditions must be satisfied. Probable future economic benefits must flow to the enterprise from that PPE, and cost is measured reliably. Then we have seen the measurement of PPE in that initial measurement. First time you need to recognize PPE at a cost. The determination of cost depends upon the mode of acquisition. We have discussed 4 modes here. One is PPE purchased. Second, PPE self-constructed. Third, exchange. Fourth, deferred payment terms. When PPE is acquired, purchased, cost elements, there are 3 cost elements. One is purchase price. For that you need to add all taxes and duties which are non-refundable in nature, and less any trade discount or rebate given by the supplier. Then directly attributable cost to bring the PPE to its present location and condition capable of operating in the manner intended by management. Initial delivery, handling goods, site preparation cost to installation cost to assembly cost to trial run cost after deducting the proceeds from samples. Okay, all these things are comes under directly attributable cost. Next, present value of the dismantling, decommissioning, restoration cost will also be part of the PPE. Then we have self-constructed. In case of self-constructed PPE, how cost will be determined? Same manner like how PPE is acquired, but except that 3 points we need to remember. Any internal profits we should ignore, we should not include it. Abnormal wastage we should not consider it. Borrowing cost subject to Ind AS 23 we will add, we will capitalize. Then exchange of assets. In case of exchange of assets, how the cost of the PPE will be determined depends upon whether there is a commercial substance or not. If there is a commercial substance, then fair value of the asset given up, first priority. If it is not available, fair value of the asset received. It is not available, WDV of the asset given up. If there is no commercial substance, WDV of the asset given up. Then if any PP is acquired by deferred payment terms, that means beyond the normal credit terms, then PP will be recognized at a price which is equivalent to cash equivalent price. If there is any difference between this cash price and the amount you are paying, you need to treat it as interest, finance charges. And next we have discussed depreciation. What is basically depreciation? A systematic allocation of depreciable amount over the useful life. What is depreciable amount? Cost minus residual value. What is residual value? What is the estimated amount I am going to get if I sell this asset once the life is completed after deducting any cost of sales. Okay. And commencement, when I am going to start providing depreciation when the asset is ready for use, not actual date of put to use. If the asset is ready for use, we can start providing the depreciation. Next, when we are going to stop, earlier of the following, when the asset is held for sale, not just kept idle. It is kept idle and held for sale, or the asset is derecognized, whichever comes earlier. Then which method I need to follow? Actually, Ind AS 16 is not suggesting any particular method. The method should reflect the pattern in which the future economic benefits are consumed by the entity from that particular PP. Accordingly, you select the method. And whenever you want, you can change the method. And that change is called change in accounting estimate. And we need to do the prospective accounting, no retrospective accounting. And in case of land and building, land basically non-depreciable asset if the life is infinite. If the life is finite, then we need to provide depreciation. Building obviously depreciable asset. Next to subsequent measurement, very very important. See, PP will be shown at what value in the balance sheet. There are two models, cost model, revaluation model. In cost model, we will take the cost of the asset, from that accumulated depreciation, accumulated impairment loss we will deduct. In revaluation model, fair value at the time of revaluation minus subsequent accumulated depreciation, subsequent accumulated impairment loss. And whichever model you are following, you need to follow consistently the same model. Okay. Revaluation model, how frequently I need to do revaluation, that depends upon the volatile changes, significant changes. If the changes are very significant, once in every year annual revaluation, otherwise once in every 3 to 5 years. And when we are selecting revaluation model, you need to follow class approach. Within the same class, different models not allowed. For the same class of assets, same model will be applied. We have discussed it. And what is the accounting treatment for accumulated depreciation at the time of revaluation? There are two techniques I told. One is restatement approach, another one is elimination approach. In restatement approach, the cost of the asset, accumulated depreciation, will be restated in proportion to the fair value, increase in the value of the asset. And then in elimination approach, what we are doing, accumulated depreciation is first reduced from the cost of the asset, then cost of the asset is brought to fair value. And then what is the accounting treatment for revaluation gain or loss? Suppose if you got any revaluation gain, revaluation surplus, that is transferred to OCI, other comprehensive income, NR, non-recognized, it is not classified to P&L account. If there is a revaluation loss, P&L account. Okay. And then treatment of revaluation surplus, what we need to do? When whole of the revaluation surplus is transferred to retained earnings, when the PP is derecognized or when the PP is disposed. It is compulsory, but there is one more option to us. What is that? Excess depreciation. If you want, you can transfer from revaluation surplus to retained earnings. How to calculate excess depreciation? Depreciation based on the carrying amount, revalued carrying amount, minus depreciation based on the original value. If there is no revaluation, what will be the depreciation? If I consider the revalued amount, what will be the depreciation? The difference is excess depreciation. To that extent, if you want, you can transfer from revaluation surplus to retained earnings. But this is not compulsory. This is only optional. We have discussed it. Then we have discussed a concept called component accounting. What is this component accounting? In a PP, there are some significant parts. Each part is having significant cost in relation to the total cost of the PP. Then that part, that component has to be depreciated separately. over its life. And whenever you are replacing any existing component of the PPE, old part WDV will be deducted, derecognized, new part cost will be added. This is what we have discussed. Then impairment loss, I told. Impairment loss other than depreciation. How to calculate impairment loss? Compare between the carrying amount, recoverable value. If the carrying amount is greater than recoverable value, then we say there is an impairment loss. How to calculate recoverable amount? Recoverable amount is equal to higher of the fair value or value in use, whichever is higher. Value in use, fair value, whichever is higher is recoverable amount. So you compare the carrying amount and recoverable value. If the carrying amount is more than recoverable amount, then there is an impairment loss. If the carrying amount is less than recoverable value, there is no impairment loss. And I said we are going to discuss it in Ind AS 36. Then subsequent cost, 3 cases we covered. One is day-to-day repairing. See, if you incur any day-to-day repairs, maintenance cost, generally that is charged to P&L account, because these expenses do not increase the asset value. It is not going to give any future economic benefit. So simply we need to transfer it to P&L account. Next, replacement of parts. If you replace any component, any part of the asset, just like component accounting we need to follow. If it is a significant part, component account has to be followed. Same major inspection and overhaul also I explained. If you do any major inspection to the asset, overhauling also means inspection only, inspection to the asset, whatever the cost you are incurring now, just to treat it as like component accounting. Like whenever you do any kind of inspection, the old inspection carrying amount will be deducted, derecognized, new inspection cost will be added. And in this here I also told one important point. What is that? Generally we make an assumption that whenever we purchase an asset, in respect of that asset, if there is a major inspection is there, in the opening cost itself, the cost in the cost itself, we assume that this inspection cost is included, and accordingly we need to depreciate separately, like how we are doing in component accounting. We need to provide depreciation. Then derecognition, once the asset is disposed or it is no longer generating future economic benefits, definitely we have to do derecognition. Right? And at the time of derecognition, any gain or loss is there, that gain or loss will be transferred to profit or loss account. We need to compare the net disposal proceeds with the carrying amount. If the net disposal proceeds is more than the carrying amount, then gain, otherwise loss. That gain or loss we need to transfer it to P&L account. And then disclosures. Okay, so this is the revision. So only 10 minutes time it has taken to conduct the revision. Now let us solve the questions. Please open the question bank. Okay, see the problem number 1. Sir, in the question bank, questions I have divided into 3 categories. One is problems from study material, our ICMA study material questions, first category. Second category, problems from workbook. Actually ICMA has released one workbook. In that workbook there are some questions are there. If they are there, I have included, otherwise not included. That is the second category, problems from workbook. Third category, problems from MQPs and PYPs, model question papers and previous year papers. Like this 3 categories we have in the question bank. Okay, and we are going to see all the 3 categories. Yeah, come to question number 1, sir. Problem number 1. X Limited set up a plant at the purchase price of 5 lakhs plus GST at 18%. Freight paid 20,000 plus GST 18%. 10,000 paid as employee expenses for installation of the plant. After the plant was put to use, maintenance cost incurred 5,000. Measure the initial cost to be recognized and pass journal. Estimated dismantling cost 30,000, present value 12,000. Okay. So see this question, everybody. So this company is purchasing a plant, sir. What is the purchase price? 5 lakhs. First we will take it. They are asking us to determine the initial cost. So take the purchase price 5 lakhs. Will you add GST? No, because non-refundable. Refundable. GST we can claim ITC. So therefore 5 lakhs plus GST, they are saying that GST please ignore. Freight paid, will you include? Yes, directly attributable cost. I told now whenever we acquire any PP, any directly attributable cost like transportation, all this cost will be added. So add 20,000. On this freight also you paid what? GST. Don't include GST. 10,000 employee expenses for installation of the plant. Will you include? Yes. I told any employees involved directly in the installation, for them if you pay any wages or salary, that is also directly attributable cost. So include 10,000. After the plant was put to use, maintenance cost incurred 5,000. Sir, once the plant is put to use, that means ready. After that you incur any expenses for maintenance. We discussed any repairs and maintenance. Day-to-day repairs and maintenance will not be capitalized. They will be charged to P&L account. So this 5,000 will be charged to P&L. And estimated dismantling cost 30,000, present value 12,000. So dismantling cost will also be included. At what value? Present value. So 12,000 will be included. So you add all these things, you will get the cost of the PPE plant. So 5 lakhs, 20,000, 10,000, 12,000. That's it. 5 lakh, 42,000 is the cost of PPE. Okay. See this 5 lakh 42. See, GST maintenance cost is not recognized in initial cost of asset. They are also asking us to pass the entry, sir. So how you are going to pass the entry in this case? Come on, tell me. Entry. Don't look at the solution. Tell me the entry. See, we are getting plant, right? So plant account will be debit, right? At what value? 5 lakhs 42,000. In this 5 lakh 42,000, provision for dismantling, DDR, provision for decommissioning, dismantling, restoration. How much? 12,000 provision we create. And how much we amount due to supplier? Or for example, if you assume you have paid the amount. And also, sir, we need to pay GST, right? Input CGST, input SGST, state central. How much is the GST? 18%. 5 lakhs into 18%, sir. How much, sir? 90,000. See, you need to calculate GST state central wise. See here, if I split state central, 18% GST, right? In that 9% state will take, 9% central will take. So 45, 45. Similarly, whatever GST you are paying on freight, 20,000 into 18% you are paying now, 3,600. That is also split, 1800, 1800. Hello? So that means total GST for central how much will come? 46,800. For state 46,800. So 46,800, 46,800. And also we are incurring what? Maintenance expenses will be debited. Debit all expenses, right? How much maintenance expenses? 5,000. So 5 lakh 42,000 asset, 46,800, 46,800 GST, 5,000 maintenance. Total 6 lakhs 46,600 minus provision for DDR you deduct. Then how much amount you incurred in the form of cash, sir? 6 lakhs 28,600. 628,600, sir. That's it. This is the entry you are going to write. Sir, this is asset, so you debited. Maintenance expense is an expense. Debit all expenses. Debit. GST is what, sir? it is input tax credit. So this amount you can claim against the output tax. When you pay GST, whatever GST now you are paying, this is your input tax na. This can be credit, this can be taken as credit from the output tax. GST classes started or not started? Not started. Okay, anyways, they are going to be started. Very simple. So business organizations, whenever they pay any GST, so that GST they can claim as ITC against the tax which they are going to pay. Correct? Okay, output tax. So that's what they have given, sir. So this is first question, sir. You understand this? Very simple. So what is the main point in this question, sir? This one. Mostly students will do mistake here. Dismantling cost. They won't take the present value. And GST also, most of the students are sometimes what they are doing, adding. And now they will make an argument. Some students, sir, whether GST, ITC available or not available, shall we require to check GST Act and all? Hey, that much drama not required here. Simply make an assumption that ITC is available unless otherwise provides generally. So that's why inputs CGST, inputs SCST has taken. Come to problem number 2. Important question this is. Please see this question carefully. This question actually is also there in MQP set to December 2024 attempt. See this question, everybody. B Limited has incurred the following transactions in respect of acquiring a plant in exchange of old plant. Say this. B Limited incurred the following transactions in respect of what, sir? Acquiring a plant in exchange of old plant. So they are giving old plant, they are getting new plant. The old site was dismantled at a cost of 8,000. The old site where the old plant is there, they need to dismantle it. If I need to exchange with you, I need to dismantle, right? For that they incurred a cost of how much, sir? 8,000. Okay. No estimated dismantling cost was capitalized for the old plant. No estimated dismantling cost was capitalized for the old plant. Actually, we need to capitalize the dismantling cost, right? Any dismantling cost we are going to incur, we are adding to the asset. That is also one of the cost component. But no estimated dismantling cost was capitalized for the old plant. Okay. Scrap from the old site sold rupees 1,000. So when you dismantle the old site, old plant, some scrap generated, na, that scrap we have sold it for 1,000. Okay. So this is the first point. Second, the new site was constructed at a cost of 48,000. So since we are acquiring the new plant, right, that new plant has to be installed. For that new site is constructed. Site preparation cost, generally it will be capitalized. Next, the supplier of the new plant agreed to take away the old plant at a fair value of 1,26,000. Sir, the supplier of the new plant will take the old plant of ours. He is agreed the old plant at what value? 1,26,000. 1,26,000 is the value at which he is ready to take the asset. Okay. New plant price is how much, sir? 3,20,000. The carrying amount of the old plant is how much? 1 lakh, sir. Old plant carrying amount is 1 lakh. So that means old plant carrying amount in the books 1 lakh. See this, 1 lakh. And what is the estimated dismantling cost which we have not capitalized? 8,000. Now you add it minus, for removal of this old site, what is the cost we incurred? Any cost we incurred? No. This dismantling cost, sorry. And what is the scrap we generated? 1,000. Deduct it. So 1,07,000 is the old plant which we exchanged it for 1,26,000. So 19,000 is what, sir? Profit on exchange. Correct? Once again I am telling, very simple. See, the old plant value given in the books is 1 lakh, sir. Correct? And first point they told that this old site was dismantled at a cost of 8,000. No estimated dismantling cost was capitalized. Actually, we need to capitalize, but we have not capitalized. So therefore, this 8,000 now I have capitalized to the old site, old plant. So 1 lakh plus 8,000, it becomes 1 lakh 8,000. Minus, once I dismantle the old site, I got some scrap. That scrap I sold for 1,000. This I will deduct from the PP because this amount I have recovered now. So therefore, my value will become how much? 1 lakh 7,000. This is the value carrying amount of the old plant. This 1 lakh 7,000 worth of the old plant is taken by the supplier for 1 lakh 26,000. That means 19,000 is what, sir? Profit on exchange. Profit on exchange. Profit on exchange of the old plant. Correct? Next. The present value of the estimate of the dismantling the site is how much, sir? 16,000. What is this? This is the new plant dismantling cost. We will capitalize to the new plant. Wages paid for the installation of the plant 4,000. For trial run 1,600. Freight paid how much? 8,000. GST applies on supply of the plant 18% and on freight 18%. We will ignore GST. Loss amounted to 40,000 for low capacity utilization of the plant after installation. Important. Sir, after installation, we got a loss of 40,000, sir, because of the low capacity utilization. Whether this loss will be capitalized? I told you, initial operating losses. If the plant is operating below the operating capacity, that cannot be capitalized. So therefore, this 40,000 cannot be capitalized. Next, rupees 10,000 was paid as cost of launching the product to be produced from the plant. Tell me, any cost incurred for launching a new product, I told it should not be included, capitalized. So recognize the asset value and pass journal entries. See, they are asking us to recognize the asset value. Asset value. See here, very simple, sir. Problem number 2, if you see, here there is old plant, there is new plant, correct? They are asking us the value of the new plant. We need to determine the value of new plant. Correct? This new plant, you know, we acquired it. What is the new plant price, sir? 3,20,000. This is the price we paid for new plant. So, price of new plant 3,20,000 plus regarding new plant, what is the cost we incurred, sir? New site was constructed at a cost of 48,000, right? So site preparation cost how much? 48,000. Relating to new plant, what else we incurred, sir? See this, present value of estimate of dismantling cost, correct? Present value of dismantling cost, how much? 16,000. We need to capitalize to the new plant, right? Next, also we paid wages for installation of the plant, trial run. Wages and then trial run. Both will be capitalized, right? Wages for installation, how much? 4,000. Trial run 1,600. Both will be capitalized. Next, freight add. How much? 8,000. Capitalize. Correct? Next, will you take GST? No. Loss? No. 10,000 advertisement cost? No. So I think this is the cost of the new plant. Tell me. 3,97,600. See, here please understand, this 3,20,000 is the cost of the new plant they are given. That means This new plant we acquired by exchange of the old plant plus cash. It is not just giving our only old plant. Sir, please understand, sir, why he has given the new plant price separately 3,20,000. His intention is you are exchanging your old plant and taking new plant, right? You are exchanging your old plant and he is taking old plant at what value? 1,26,000. That means remaining amount you have to pay. Correct? You are giving, see, you are the supplier. I am giving my old plant to you. You are taking at 1,26,000. But the new plant cost is how much? 3,20,000. Na? That means remaining amount I need to pay through cash only. Correct? So here exchange involves, from my side I am giving old plant plus cash. I am taking new plant. So the new plant original cost I need to take 3,20,000. This is what? Site preparation cost, present value of dismantling cost, wages for installation, trial run, freight. All these cost I need to add. So I will get 3,97,600. Now if I write the entries, here, they're asking journal entries, right? Journal entries. See here, new plant I am getting now, machinery. Hello? Machinery new. Tell me at what value I will debit new plant? 3,97,600. Right? To machinery old. Old machinery. 1 lakh is the book value, right? For the dismantling cost 8,000 we added. Scrap of sale of the old plant 1,000. So the book value is 1,07,000. Correct? Old plant. And we got a profit on exchange. How much, sir? Profit on exchange of old plant. How much profit we got? Actually we have exchanged it for 1,26,000. Book value. So therefore what is the profit, sir? 19,000. We will credit. Later we will transfer it to P&L account. And to supplier, or if you pay it to cash, supplier, how much we need to pay? Tell me. Supplier, sir, how much we will pay? 3,20,000 is the cost, right? Minus 1,26,000 we have given in the form of plant. 1,94,000. 1,94,000, sir. Remaining expenses all we paid in cash. And provision for dismantling, we will create a provision, right? What is the provision we create for dismantling? 16,000. Can you tell me the cash? These expenses like site preparation cost 48,000, wages 4,000, trial run 1,600, freight 8,000, total 61,600. $48,000 plus 4,000 plus 1,600 plus 8,000. Okay, total 61,600. Sir, this 8,000 and 1,000 also you can write an entry. Like for example, you estimated dismantling cost, if you add anything you are adding to the asset, what we need to write? Asset account debit to dismantling cost, correct? Asset to cash. Then scrap value generated 1,000 now, that will be deducted from the asset value. Anything you are deducting from the asset value, asset account will be created. Correct? Cash to asset. So here guys, please understand, Here, don't confuse yourself. Very simple question. Only thing is that you need to analyze it properly. So once again, how you are going to solve this question is very simple. New machinery you are getting, right? How you are going to get this new machinery? You are going to give up the old machinery. At what value? 1,26,000. Obviously remaining will be cash. The new machinery cost is how much? 3,20,000. Common sense. Anybody having common sense will understand this. 3,20,000. You are giving old machinery at 1,26,000. Supplier is taking at 1,26,000. So 3,20,000 minus 1,26,000. How much? 1,94,000 is what? Cash we pay. That's what I have taken here. See this. Supplier. Okay. If it is already, we assume that it is not paid. So that means supplier account we will credit. Later when we pay, supplier to cash we will write. Okay. This is how we got this 1,94,000. One thing. Second thing is, whenever there is an exchange, sir, you need to find out the profit or loss on exchange. So the old machinery you are exchanging for 1,26,000. But what is the carrying amount of old machinery? Carrying amount of the old machinery is, in the books it is 1 lakh. And estimated dismantling cost they have forgotten to add. Now we adding. Minus scrap value generated from the sale of the old plant, old machinery, 1,000. So therefore 1,07,000. Sir, tell me, 1,07,000 worth of asset, if somebody is taking at 1,26,000, obviously you are on the profit side, right? So what is the profit on exchange, sir? 19,000. So that is what I have recognized. See this. Profit on exchange. 19,000. Profit on exchange of old machine. And this profit will go to P&L account. This is one thing. Simple. Next what? Next what is remaining? Remaining expenses. Remaining expenses you paid in the form of cash. What are the remaining expenses you incurred? Definitely you need to pay the remaining expenses now. Because see, you are the supplier, sir. I am giving old plant, I will give the remaining amount. This freight, site preparation cost, wages, trial run, freight, I need to pay to the different parties, I paid it. Hello. So therefore these things, 48, 4,000, 1,600, 8,000 cash, total 61,600. That's it. This is how the answer should be. You understood? So entries you see. Old machinery to cash, dismantling of the old. Whenever they dismantle, the dismantling cost, they capitalize it to the asset. And the scrap value they deducted from the old machinery. Now the old machinery will become 1,07,000. So this 1,07,000. So new machinery came, old machinery gone. Profit we got 19,000. We paid to the supplier 1,94,000. We can assume here that we paid also. If you assume that it is not paid, supplier. If you pay, cash. And then remaining expenses, freight, in construction of the site, freight, installation expenses, all this. And liability for dismantling. So see here, loss of 40,000 and cost of launching product 10,000 are charged to P&L account. GST account has not been shown. Here the assumption is GST is what, sir? Refundable. ITC we can claim, right? So that's why we have not considered it. Any doubts? Guys, tell me, have you understood this? That's it. This is one question, sir. Okay. Next, problem number 3, sir. See this question. This question also there in model question paper set to December 2025. Okay. A Limited purchased an aircraft at a price of 6,300 crores, sir, that requires major inspection and overhauling every 4 years. So they purchased one aircraft, sir. That aircraft requires inspection and overhauling every 4 years. Once in every 4 years we need to do the inspection overhauling. Estimated life of the aircraft is 15 years, sir. The aircraft was purchased in 2015 and major inspection and overhauling made in 2019 at a cost of 100 crores. See, Aircraft is purchased in 2015, sir. Major inspection and overhauling is made in 2019 at a cost of 100 crores. In 2020, A Limited further incurred repairs and maintenance in the engine to raise its capacity by 10% amounting to 70 crores. See, whenever you are solving any questions relating to PPE, dates are very, very important. Which year, what happening is very, very important. So tell me in which year they purchased aircraft? 2015. When they have done the inspection? 2019. When they have incurred further expenditure to increase the capacity? 2020. So 2015, 2019, 2020. These are the events happening in different years. One worn out component in the wing was replaced in 2020 at a cost of 80 crores. Next, in the year, same year 2020, sir, they have replaced the old part. The carrying amount of the old component is 30 crores. Scrap realized 12 crores. Find the amount to be recognized as expense and as asset in 2019, 2020 and also show the carrying amount. The aircraft residual value is estimated to be 300 crores. Guys, you have to be very careful. First of all, when you are solving any question, sir, see the requirement. What they are asking. Here they are asking, find out the amount to be recognized as expense and also asset value. When 2019, 2020 and also carrying amount they are asking. So they are asking how much is the expenses you are going to recognize in 2019, like depreciation is an expense. 2020 expense as well as the asset value and also carrying amount. And they are saying that this aircraft residual value is how much? 300 crores. So take your time, read 2 minutes question, try to tell me the answers. Come on, think everybody. Okay. So this question is relating to component accounting, sir. See, in this question what they are asking, sir? Problem number 3. You know, generally, normally I will solve first, sir. Then I will see relate with the solution which is given in the study material. First, you see the facts of the question, sir. When we purchased the aircraft, sir? 2015, right? So 2015, here they are following calendar years, 15, 16, 17, like that, because based on the information given you can see this. So take first purchase price. What is the purchase price? 6,300 crores, right? Rupees in crores. The aircraft was purchased in 2015. Major inspection and overhauling was made in 2019. That means 15, 16, 17, 18. 4 years is over. In 5th year, inspection was done. Right? So, less depreciation. First 4 years I need to provide depreciation, right? Depreciation for 16 to 18. Sorry. 15 to 18. 15, 16, 17, 18. 4 years. Tell me depreciation. 6,300 minus residual value given. See this. 300. Divided by 15. 6,300 minus 300 divided by 15. How much, sir? 400 is the depreciation per annum. That is per annum. 400 into how many years? 4 years. How much? 1,600, sir. So what is the book value? 4,700. This is the WDV, carrying value, right? Carrying amount at the end of 2018, right? Next, what happened? 2019 inspection was done, right? Inspection cost, what we need to do? Like a component accounting, we need to add, right? So inspection cost, how much inspection cost, sir? 100. So after inspection cost, it will become 4,800. Now 2019, anything happened? Any other thing? No, only this one, right? So you need to provide depreciation for 2019. Hello? Depreciation. Can you tell me the depreciation? Normal depreciation is how much? 400. So depreciation on aircraft 400. Next, depreciation on inspection cost. Inspection cost how much, sir? 100 divided by 4 years, 25. So depreciation is 425. Correct. 2019 depreciation, 2 components. Inspection cost you added na in 2019 beginning. So at the end we need to provide depreciation. Inspection once in every 4 years. So 100 divided by 4. So 25. Normal depreciation as usually 400. So total 425. Tell me. How much? 4375. So this is the carrying amount at the end of 2019. Next to 2020, right? 2020 important, sir. What happened in 2020, sir? We have incurred 70 crores for which increases the capacity by 10%. See, whenever you spend any expenditure which increase the capacity of the asset, it should be capitalized. So therefore, here expenditure, how much? 40? 70? 70 crores we should add. Okay. Expenditure which increase the capacity will be capitalized, sir. Okay. Next, one more thing happened, sir. What is that? See this, important. In 2020, old part was replaced. Whenever old part replaced, what I told? Old part carrying amount. Old part is derecognized. Which one you add? Cost of new part, right? Cost of new part you add. Old part carrying amount you need to deduct. So carrying amount of the old part, cost of the new part will be added. Can you tell me what is the carrying amount of the old part? See this. The carrying amount of the old part is 30 crores, right? So 30 we will deduct. What is the cost of the new part? 80 crores, correct? Add. After all these things, what is happening? Tell me. 4375 plus 70 minus 30 plus 80, correct? 4495. 4495. Then 2020 we need to provide what? Depreciation. Depreciation. Depreciation on normal aircraft. Simply see this, 400. Depreciation on inspection cost 25, correct? 25. And then depreciation on newly added value. Newly added, how much can you tell me? 70, 80 minus 30, correct? 70 minus 30 plus 80, how much? 120, which is depreciated for remaining life. This is because this year only it is added, na? Total how many years? 15 years. How many years are already over? 5. 5 over, na? 15, 16, 17, 18, 19. This is 2020. That means total 5 years over. So remaining this 120, whatever added in the year 2020 will be depreciated by remaining life 10. So 120 divided by 10, 12. So what is the total depreciation? 430, 437. Deduct it. How much you got? 4058. This is the carrying amount at the end of 2020. Carrying amount at the end of 2020. But actually, this I solved only to make you understand. But in examination, what they have asked is, they have asked what will be the expenses, how much you are going to recognize, what is the carrying amount. See here, everybody please concentrate. Tell me the answers here. 2019, what will be the expenses? See this, expense means depreciation, 425. 2020, what will be the expenses? Depreciation, 437. And also 2020, one more thing is there. What is that? We have replaced the old part, right? The scrap value of the old part, we have sold it. Sir, see here. The carrying amount of the old component 30 crores. Scrap realized how much, sir? 12. That means book value 30. You sold it for scrap 12. That means how much is the loss? 18. That 18 crores is also expenses to be recognized in the year 2020. Important. Sir, here old component was replaced, na? That old component book value 30 crores, na? But we sold in the market as a scrap, we got only 12 crores. So that means 18 crores loss is there in the year 2020. So in the year 2020, depreciation is one expenses, sir, 437, and also loss on sale of old component or old part. How much is the loss we got, sir? Simple. What is the carrying amount, sir? 30. And what is the amount we got, sir? Sale value 12. How much is the loss, sir? 18. This loss will be charged to P&L account. This is also expenses, na? So that's why in the year 2020, total expenses to be recognized is 18 plus 437 total. Depreciation 437, loss on sale of the old part 18. Every year, can you tell me 2019 what is the carrying amount? 4375. 2020, 4058 is the carrying amount. Hello? So you should not confuse at all. Very simple concept. So in the beginning 6300 is the aircraft value. In the year 2019 inspection happened. Right? So first 4 years normally we provided depreciation. 5th year onwards this is also added. So this will be depreciated over next 4 years. Inspection cost, every 4 years we need to do inspection, so it will be depreciated by 4 years. I told inspection cost is just like a component accounting. We need to depreciate it separately. Its life is different, right? And next year 2020 you have to be very careful. Whenever new things happen, you provide depreciation for the remaining life. This 70 added this year, this cost new part added this year, old component derecognized. So therefore net cost added to the asset is 120. This will be depreciated over the remaining life. But look at the presentation which is given in study material, sir. See 2018 depreciation per annum, this is expenses per annum, sir, 400. This is the carrying amount. 2019 actually, you see, depreciation 425, inspection cost they have added to the asset, so carrying amount 4375. 2020 you see depreciation how much? 425. Actually depreciation I think they have considered only this one. Here they have taken 437. See this, I think here you take 437, sir. And also you see, sir, old component derecognized, loss on disposal of the old component, how much we got, sir? 18. So that's it, sir. I think see, repairs and maintenance and replacement of the old component depreciated at straight line for residual value, that is 10 years. That's anybody done correctly? Where you have done the mistake, tell me. So this is problem number 3, sir. Now come to problem number 4, sir. See this question. X Limited purchased a mission at a price of 1200 lakhs. It paid freight 40, installation cost 80, IGST 18%, sir. Share of general overhead ascertained for the trial run of the mission 30 lakhs. The labor cost and direct expenses for the trial run 60 lakhs. The mission was put to use on 1/4/2019. The estimated dismantling cost of the mission at the end of the useful life 10 years is 400 lakhs. The discount rate to be applied 5%. Present value of the estimated cost 246. What they are asking, say this. The mission requires major overhauling every 2 years at the cost of 26 lakhs. Sir, this mission requires major overhauling every 2 years at the cost of 26 lakhs. Show accounting treatment for the year 1920, 2021. Okay. First see the question carefully. So there is a company X Limited, sir. They are purchasing one mission, sir. What is the purchase price, sir? 1200 lakhs. How much freight paid, sir? 40. Installation, sir? 80. IGST 18%. Share of general overhead ascertained for the trial run of the mission 30 lakhs. Will you add this? Share of general overheads ascertained for the trial run of the mission. Sir, directly attributable cost. The cost which is directly related to bring the asset to its present location and condition necessary for it to be capable of operating in the manner intended by management, we will capitalize. Here, this is the share of general overhead expenses. So therefore, generally this type of expenses are not directly related, directly attributable. So therefore, we cannot include it. But this one, see this labor cost and direct expenses for the trial run 60 lakhs. This we will capitalize. See, in order to capitalize the directly attributable expenses, that must be directly related to the asset to bring the asset to its present location and condition. So here, this 60 lakhs we will capitalize, but this share of general overhead expenses is not directly related, so we don't capitalize it. Okay? And when it comes to dismantling cost, you will take the present value 246. Come on, tell me. I think this is a very simple question, sir. Tell me the answer, what they are asking. Can you tell me the accounting treatment for 1920 and 2021? Come on, first read the question. Okay. Problem number 4. Tell me. So first, if I decide the cost of the asset, first I need to take what? Purchase price, right? What is the purchase price of the asset? 1200 lakhs, right? Rupees in lakhs. Freight we will add, right? Freight, directly attributable cost, add how much? 40. Next, installation, add. Next, general overhead, share of general overhead expenses? No, they are not directly related. IGST? No. Labor and direct expenses for the trial run? Yes. Labor and trial run, both will be added. How much? 60. Next, present value of dismantling cost, right? Dismantling cost. Present value given, given how much? 246. Tell me how much? 1626. See, tell me what is the asset here? Mission, right? This mission requires what? Major overhauling every 2 years at the cost of 26 lakhs. See here, this is the cost of machinery. This is the cost. Now here they have split this into two. Overhauling 26, machinery 1600. This overhauling will be done once in 2 years. So life 2 years. What is the life of the machinery? 10. Correct? 10 years given. 10 years. So what will be the depreciation? 13. This is 16. So in the year 1920, first year, what will be the depreciation? 13 plus 16, 20. This is 160, right? Yeah. 173. 2021 also 173 depreciation. See here, important sir. If you observe the study material answer, you know, initial cost recognized, say this 1626. In this 1626, overhauling cost 26 they have separated it. Remaining balance they have taken the machinery value. This is depreciated over 10 years. This is depreciated over 2 years. I told you now when my theory discussion. So component accounting. Here major overhauling. We assumed that this overhauling cost in the beginning included in the asset value itself. So therefore in this 1626, this 26 overhauling is also there. And we need to do overhauling every once in 2 years. So therefore this 26 is depreciated over the 2 years. Remaining 1600 will be depreciated over 10 years. So the annual depreciation will be 173. 173. Okay. That is the important thing. So here please understand sir, assumption sir. Generally in case of overhauling inspection we made an assumption that that cost was included here. Sir, then you may ask a doubt, sir, in the last problem also why you have not taken such kind of assumption? Problem number 3, come on tell me. Problem number 3 also, inspection we need to do once in every 5 years, right? So in this aircraft of 6300 cost, this 100 also included na? Why can't you separate it and depreciate it separately? First of all, are you understanding what is the question I am asking? See, in this question, problem number 4, they have split it. 1626, 26 overhauling, remaining asset value, they split it now. Why you have not done the same thing for problem number 3? Not done in same years. But we have solved it accordingly na? Like this. 6300 depreciation for the first 4 years, like that. Suppose sir, like in problem number 3, if I split and do, what happens, tell me? 6300 na? In this, what is the inspection cost? 100 crores. Remaining 6200. And there is a residual value. What is the residual value here? 300. This residual value belongs to this one na? So what is the balance? 5900. This is depreciated over 5 years. This is depreciated over 15 years. Can you tell me? This is 20, right? 4, yeah? Okay. How much? 25. This one? 393.33. 418 it is coming, right? 33. But we have taken depreciation how much? 400. 400 per annum now we have taken. So therefore, see here in the last problem, what you need to understand is they are not talking about the initial cost measurement. They're in between, they are asking na, in the year 2019 2020 they are asking, and the asset was purchased in the year 2015. So that's why we are not bothered about the initial measurement. Suppose like in this problem they are asking about the initial cost measurement, initial cost recognized. But we are acquiring the machine now and we are determining the cost. So that's why in the initial measurement of the cost we split it. Actually this is correct, this is the way you need to do it. At the beginning itself you need to split. This is the inspection cost, this is depreciated over for 2 years, this is the normal asset balance, this is depreciated over the life. Same manner we need to do it here, but here we are acquiring the asset 2015, but we are determining the expenses in the year 2019 2020. That's why our intention is what? After 4 years what is the carrying amount, that is what we need to determine. That's why in this problem we have taken like this. Sir, I will split, sir, I will do, sir. We don't know in the beginning what might have they have done. Their intention is different. So accordingly, depending upon the question, you need to flexible and you need to solve the answer. Hello, you understand the difference between 3 and 4, sir? Yes. So this is one question, sir. I don't know why they have given this unnecessarily, sir, not required. Because anyway, at the time of determination of the initial cost, we need to take only what? Present value of the estimated dismantling cost, which is given in the question itself. That's it, sir. This is one question, sir. Question number, problem number 4. Okay. Now see the questions from MQP and PYP. First, PYP December 2024 attempt question, sir. Mohan Limited purchased a machinery on 1/4/2019 costing 4 lakhs. Useful life of the machine 10 years, sir. Company decided to charge depreciation and straight line method. Accordingly, on 1/4/2023, dates important, sir. Machinery purchased on 1/4/2019, sir. Now we are in 1/4/2023. That means 1920, 2021, 21, 22, 22, 23. So 4 years already done. The carrying amount of the asset given, sir. See this, gross carrying amount 4 lakhs, accumulated depreciation 1,60,000, net carrying value 2,40,000. This is the position on 1/4/2023, sir. Next, what happened, you see. On 1/4/2023, company performed revaluation of its plant and machinery. On that date, the fair value of the machine under consideration was 3 lakhs. Fair value is 3 lakhs, sir. That means revalued amount 3 lakhs. And the total useful life, however, remains unchanged. Show how the company should account for revaluation and depreciation per annum subsequent to revaluation. After revaluation, they are asking what will be the accounting treatment for revaluation and depreciation. If the company decides that 1, gross carrying amount of the asset will be adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. That means they are saying that company decided gross carrying amount of the asset will be adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. That means restated approach. Correct? They want to change the asset value in accordance with the revalued amount. Second, the accumulated depreciation is eliminated against the gross carrying amount of the asset. That means Elimination approach. Elimination approach. The answer should be supported by the journal entries. Narration not required. So they are asking entries, sir. So tell me first of all, this question belongs to which area? Huh? Which area? Which area they are asking accounting treatment, sir? Revaluation with, accounting for accumulated depreciation. At the time of revaluation, how to do the accounting for accumulated depreciation? How many approaches are there? Two approaches. What is the first approach? Restatement approach. So you know how to do it, right? Simple na? So this is December 24 attempt question. First, if I do the restatement approach, I want cost, I want accumulated depreciation, I want WDV. Can you tell me what is the cost? No need to. See, simple. They have given what is the gross carrying amount? 4 lakhs. That is nothing but cost. Gross carrying amount, nothing but. Sir, gross carrying amount means cost only, original cost. 4 lakhs. What is the accumulated depreciation? 1 lakh 60. What is the WDV then? 2 lakh 40. Now they want to do the revaluation, right? What is the revalued amount? Revalued amount 3 lakhs. Tell me now. You need to proportionately increase the gross carrying amount as well as accumulated depreciation. Tell me how much you will increase the asset value? 4 lakhs. See, this is simple. If the cost is 4 lakhs, the WDV is 2 lakh 40 na? Now how much is for 3 lakhs? If WDV, if the fair value is 3 lakhs, what will be the cost? Find out it. 4 lakhs into 3 lakhs divided by 2 lakh 40, correct? How much? 5 lakhs, sir. Or else you can do one more manner also, I explained, sir. How much increase happened, tell me? 60. Find out the percentage. 60,000 divided by 2 lakh 40 into 100. 25%. That's it. 4 lakhs into 25%. 4 lakhs into 25%. 1 lakh. So 4 plus 1, 5 lakhs it becomes. Correct? Accumulated depreciation also. 1 lakh 60 into 25%. That means 40,000. Or else you can do like this. 1 lakh 60,000 into 3 lakhs divided by 2 lakh 40. How much? 2 lakhs. So that means how much is the increase, sir? Cost of the asset 1 lakh 40,000 accumulated. That means revaluation surplus 60. So therefore, what is the entry you will write in restated approach? Come on, tell me. Machinery value should be increased, right? How much? 1 lakh. Machinery account debit 1 lakh. Accumulated depreciation will be increased by 40. What is the difference? 60. That will go to revaluation surplus. Very simple. Hello? This is the first treatment. And now tell me, once revaluation happened, now onwards, if I want to provide depreciation, what is the depreciation amount? Come on, tell me. Depreciation is provided on this 3 lakhs. Hello? Total useful life 10 years, na sir. Already 4 years done. That means this 3 lakhs is depreciated over the remaining 6 years. 50,000 is the depreciation. There is no residual value here. Hello? So depreciation is, now onwards the asset carrying amount is 3 lakhs divided by remaining life 6 years. So depreciation is 50,000 per annum. Hello? Suppose if there is a residual value, you will deduct it. 3 lakhs minus residual value divided by number of mining life. This is one approach, sir. Very simple approach, na? Same you can do it in which manner? Elimination approach. Elimination approach also you can do, sir. Very simple. In elimination approach, what we do? Whatever the accumulated depreciation is there, that is adjusted against asset. No need to calculate accumulated depreciation, they have given in the question. Can you tell me? 1 lakh 60. So accumulated depreciation to machinery. 1 lakh 60. Now machinery to revaluation surplus. How much is the revaluation surplus? 60. Correct? 60,000. Correct? Wrong? Original cost how much, sir? 4 lakhs. You are reducing how much, sir? 1 lakh 60. So 4 lakhs minus 1 lakh 60 means 2 lakh 40. What is the revalued amount? 3 lakhs. So 60,000 you need to increase. That's what we have done. See, under both the approaches, the net effect is what? Same. This is elimination approach, sir. Sir, look at this. This is asked for 7 marks, sir. How easy it is. Once you know the concept, I think 7 marks is in your hand. There is nothing great here. If you follow my concept carefully, I think you can solve this question in just 3 minutes in the examination. So look at the answer, sir. See this. This is the first method. Plant and machinery, accumulated depreciation, revaluation reserve. See, here I have written correctly. See this. And then depreciation also. Second method also, see this. Depreciation same na, 50,000. Because here once revaluation happened, sir, depreciation is provided on the revalued amount. Revalued amount is 3 lakhs. 3 lakhs divided by remaining life 6 years. So under both the approach, depreciation per annum is same. How much? 50,000. This is one question they tested, sir. See this. Since the revalued amount is the revised gross block, the useful life is to be considered is the remaining useful life, which is 6 years. Thus the same depreciation charge per annum is 50,000. Sir, you have to respond. Have you understood this? That's it. So this is one question, sir. June 2025 examination question, we solved it already. Next, question number 3, sir. This was MQP question. Model question paper set 1. Very simple question. I think this type of question already, I think this is dismantling provision. This type of question already I have solved in a concept question. When I am explaining the concept itself, I solved it. Provision for dismantling restoration cost is there now. Relating to that, sir. Very simple. See this. On 1/4/2020, Vishnu Limited installed a mission in the rented premises at a cost of 25 lakhs. So in the rented premises, they installed one mission, sir. 25 lakhs. Life 3 years, sir. As per the rental agreement, the mission should be decommissioned and the building should be brought into original position. Once life is over, sir, this mission has to be dismantled, decommissioned. And the company should incur 4 lakhs at the end of the 3rd year to restore the premises into original position. That means how much cost company is going to incur for this dismantling, decommissioning? 4 lakhs. Assume borrowing rate is up 10%. Record the journal entries. Tell me, in future how much cost you are going to incur? 4 lakhs. What we need to do? We need to find out the present value. Present value of this dismantling cost, and we need to capitalize to the asset. Come on, tell me what entries will come. I told you already. Machinery account debit to provision for DDR. Correct? How much amount you create provision? Tell me. What is the future cost? 4 lakhs. divided by 10% of 1 plus 01 whole power 3. Find out the present value. How much we got? 3 lakhs. 3 lakhs. 3 lakhs 525. 3 lakhs 525, sir. Actually, original cost 25 lakhs, sir. For that, we will add this 25 plus 3 lakhs 525. So total it is 28 lakhs 525. Remaining we will pay to supplier. Correct? 25 lakhs. Right? What about the difference gap, sir? This is the provision we created, right? Future cost is how much? 4 lakhs. I told we need to unwind. We need to unwind as a financing charges. So at the end of the first year, what we will do on this 3 lakhs 525, we will apply 10%. How much? 30,052. Right? This will be first year unwind. What is the entry for this? Finance charge account debit to provision for DDR. 30,052. Second year, same. But second year, when you are creating provision, you need to create on the this one plus this. Hello. Next year, when you are unwinding this provision for DDR, already first initial you create 3 lakh 525 na, first year 30,052. So total 3 lakhs 525 plus 3 lakhs 52 on the 10%. How much, sir? 33,057. Hello. See, this is not something new which already we have done it. See, this is first year end, sir. This is second year end. And same manner, third year end. Third year end balance we will meet, correct? What is the balance, sir? 36,000. 366, correct? That's it. Actually, journal entries they have asked, we have written. So this is at the beginning, sir. Sir, you understand this? This is balancing figure I have taken. So if you add all these things, it will be equal to 4 lakhs, which is nothing but provision for DDR. So initially you need to recognize provision at present value, sir, and you need to add it to the cost of the asset. Every year you need to unwind the balance, right? So this is at the beginning of the year we write the entry. Sir, this is not new, already we discussed it, sir. Same thing we discussed already. See, you know how we got this 3 lakhs 525 present value? Yeah, that's it, sir. I think this is the question number 3. So here actually entries they have not written, but I have written entries also. You understand these entries? So see this is the present value. So the total cost of PPE is 28 lakhs 400. Hey, they got 3 lakhs 400, huh? Oh, they have rounded it off, right? Yeah, no problem. If you take the original amount, you will get 3 lakhs 525. That's it, sir. This is question number 3. So all the questions we have completed, sir. So mostly, sir, the best way to crack CMA is focusing more on the study material questions and the MQB questions. Mostly they will repeat in the examination. More chances that they are going to repeat. Okay? You see examination question, 2 examination questions, both are easy only. If you solve that illustration problem number 5, I think June 2025 attempt you can easily crack. And if you know the concept, December 2024 attempt question you can solve. Right? That's it, sir.